Hello, is everyone on? I hope everyone is on. Hello, you can actually respond. It's an interactive session.
Yes, we are on.
Yes, please. Yeah, we are on.
That's fine. So you're all welcome to the Management Accounting live exam rush for the March 2024 exam. I hope you are all excited to be here. Now, management accounting is one of the headaches for a lot of students. I don't know why management accounting is a headache, but please, you mute your mic until you have a question, okay? Then you'll be allowed, you put up your hand and you'll be allowed to talk. I hope that is okay. Just mute so that everybody will benefit. Okay, so management accounting is one area that, hello, I hope you can all hear me. Can you hear me? Hello? Can you hear me? Hello? Yeah, Julius, your hand is up. You can speak. Hello, Julius, your hand is up. Hello, Kim.
Okay, Prof. Good evening. You muted us. That's why we're not responding. But we can hear you loud and clear. Hello, Prof.
If you have a question, just put up your hand and I'll call you. Is that okay? I hope that's a good idea. Okay, so you are all welcome to the management accounting session. Actually, when it comes to management accounting in the ICA exam, let's have a syllabus overview. Okay, let's look at how I structure the syllabus. So let's look at the syllabus overview. So what is management accounting itself about? This paper is actually performance intensive. Okay, so it's basically performance management. Everything around this paper is around performance. Okay. So we commit our meeting into the hands of God. God, come and take absolute control. Okay, without him, we are nothing. He's going to take absolute control and you are going to be guaranteed your pass mark. But then you have to be strategic between today and tomorrow morning. I hope that is okay. So if you look at the syllabus itself, it starts with what? The contemporary approaches to management accounting, right? And this contemporary approaches to management accounting is basically the modern approaches to management accounting. Are we okay? Now, these modern approaches to management accounting starts with what management accounting actually is. So you have to look at the introduction to MA, what management accounting is, okay? Then we have to look at the concept of planning, controlling, and what? Decision making, because that's what a management accountant does, okay? Use financial and non-financial information to assist management in planning, controlling, and decision making. So you must know what these three things mean. Okay, what is planned? Set objectives and show how they should be achieved. Controlling, also where you set targets, also and ensure corrective actions are taken where your expected deviates from your target, right? Then decision making is where what you make a choice from decisions. These are the three main things that what a management accountant does. So as a management accountant, these are the things you will be playing with throughout your syllabus, right? Planning. So they can ask you what techniques are under planning. And as a student, you must know when it comes to planning, you can use costing. Cost estimation is planning, right? Budgeting is planning. Okay, budgeting is planning. These things are techniques under planning. Controlling, you use variance analysis, you use performance metrics, right? For control decision making, you have short-term and long-term decision-making models, right? All these things are techniques under these that you have to know. So they can ask you basically theory around planning, controlling, and decision-making. So as I go along the syllabus, I will be treating the topics, right? I'm not going to list everything. So as we go, I'll be treating. So that's the first area, introduction to management accounting. And you must know these three things, planning, controlling, and decision-making. I realize that a lot of students, when it comes to management accounting, they only think calculation. Management accounting is not only calculation. Management accounting has a lot of theory, okay? The paper is actually mostly structured to be 60% calculation and 40% theory. And any paper with the word management in it actually has a lot of theory attached to it as well, right? So this is the first area, which we'll come and talk about, right, as we go along. Now, the next area after this area is to know ethics in management accounting, right? Ethical behavior. So with ethics, I'm going to teach you everything you have to know to be able to maneuver ethics this time. Be ready to deal with ethical scenarios. So with ethics, we have what? The professional code or the fundamental principles, okay? So when you hear the fundamental principles of ethics, you are talking PICO, right? Professional behavior, integrity, confidentiality, competence, and due care and objectivity. And you have to also know the threats, right? Or the things that may lead somebody not to comply to this, right? So you can use as if, okay? That's advocacy, self-interest, self-review, intimidation, and familiarity threats. Then we can look at what? Some consequences, I get in it, of unethical behavior. So if you behave unethically, there are some things that they can ask you, okay? So at least when you know these ones and you know how to double between ethical scenarios or ethical dilemmas, you should be fine. Then the next area that is part of your contemporary approaches, okay, is actually the models of evaluation. Now, these models of evaluation, you can actually break it into two, okay? There's one that you can talk about what? These are models we use to evaluate performance. That's why I say models of evaluation. We have those under modern costing techniques, okay? So here we have modern costing techniques, okay? Modern costing techniques, and then you have what? Appraisal techniques. So when we say appraisal techniques, we mean that techniques that we use to appraise performance, okay? That is how I break it. So what the modern costing techniques, the very first technique you need to know about is activity-based costing. Now, everyone doing management accounting should be aware of activity-based costing. Then two, we have what? You must know about what? Throughput accounting, okay? Throughput accounting. Throughput accounting, very important. We must know environmental management accounting, right? So environmental management accounting is very important, especially be very much aware. We are going to go through those techniques, right? Then you can have things like target costing. Somebody will say, but prof, target costing is not in our syllabus. Yes, you don't see directly on the syllabus, but as part of cost control and cost reduction, target costing is part of it. Okay, so these are all modern techniques and life cycle costing. because as part of environmental management accounting, one of the techniques in there is environmental life cycle costing, meaning life cycle costing could still feature as part of your syllabus, okay? I hope you are writing something down. So these things are very important for you to deal with when you are dealing with such questions, right? Now, when it comes to the appraisal methods, these are the models of evaluation, the ones that we actually use to assess performance. And the first model that I'll talk about is the balance scorecard. Know the balance scorecard, right? Learn how to deal with the balance scorecard too. We can talk about the Porter's value chain, okay? The value chain analysis. 3, we talk about quality management, right? Quality management, which includes quality cost and then continuous improvement, okay? So continuous improvement comes with total quality management. You can look at business process reengineering, okay? Business process reengineering. And as part of all this is cost reduction and cost control, okay? So cost reduction and cost control, okay? So when you know these things, at least I could say that the contemporary approaches, you should be fine, okay? And here, the max here for contemporary approaches is 15 marks, but sometimes ICA can extend it to 20 based on how deep the question is, right? So that they will take from other parts and bring it here. So with contemporary approaches to management accounting, these are the areas. I hope everybody is okay now. I hope everyone is okay with the contemporary approaches to management accounting. So just open your eyes, be ready to deal with it, okay, when they come. So if you want room to write it down, well, you are free to put it down. Any questions so far? You can ask questions. Just put up your hand, you'll be called, and then you ask questions. Because of the noise when people join, I want it to be uniform. Yes, please. Do you have any question for me? If you have no question, to kindly put it in the chat section for me that you have no questions so that we can carry on to the next area of the syllabus. Kindly put it in the chat box for me. Are we all okay? You can give me a thumbs up quickly so that we can move. We don't have time at all. It's almost 7. Yes? Shall we proceed to the next area of the syllabus? Hello? Okay, so it seems we can proceed. Okay, so that's the first area. That's the first area that we have to be able to deal with. I think we can proceed. Okay, so the next area has to do with management decision making. Okay, so with management decision making, that's what the syllabus calls it. Let's call it variance analysis, right? Okay, it's part of control mechanism. So let's say variance analysis and standard costing. Okay, so when it comes to variance analysis and standard costing, this is an area where students are usually scared because of the method that they use for variance, right? So you can use a method that you have to think so much to adopt a lot of variances. Okay, I'll teach you a simple way you can do variances to capture all the marks, especially the focus of your syllabus is mostly on reconciliations and also mix and yield and sales mix variances and work back because those are advanced variance techniques. So here, first of all, you must understand the role of standard costing. So understand standards itself. What is a standard? A yardstick that we use to measure performance, right? Something we can measure performance against. So standards, you could say there are 4 main types of standards, right? We have what we call a historic or basic standard. This means that something that a yardstick or a threshold you have achieved over and over and over again that it has become demotivating to achieve, right? We have what we call the current standard, and the current standard is what you are currently working to achieve, right? What you currently work to achieve, what you do on your day-to-day basis, right? Then we have attainable standards. So with attainable standards, it means that this standard can be achieved, right? But it's a little bit challenging than the current. That does not mean you cannot achieve. Let's say if you produce 5,000 units, let's say you got 50% in management accounting, right? The next time you are doing strategic case study and we say, okay, this time we want you to make 75. This is not demotivating. Somebody can actually make 75%, right? This is attainable. This is current, what you're actually doing. You get the idea? Then we have what we call the ideal standard. Now, ideal standard is a standard that is so ideal that it is devoid of any errors, devoid of any machine breakdowns. This is so ideal, meaning it is too perfect, right? That it can be demotivating to people. At least if you are telling me to get 100% in management accounting, it will demotivate me. I can't, or get 100% in all my ICA papers. It's not possible, right? It could be possible, but it should be a future or a long-term goal for the overall company. So that is the main thing. So they can tell you to explain the standards. Then you must know the purpose. They can ask you for the purpose of standard costing. Remember, as you learn the calculations, you must also learn what? The theory. So the purpose of standard costing. You must know what we use standard costing for. Standard costing, what is it? When we ask you about a standard, right? You must also know what a standard cost is. So a standard cost is actually what? The budgeted cost in what? Per unit firm. So if I have the budgeted cost, the total cost in the budget, and I divide by what? The budgeted level of activity, I should actually arrive at the standard cost per unit, okay? That is what a standard cost is. If the budget is dressed or divided per unit, we get a standard cost. That is why if you are doing OAR, overhead absorption rate, you're actually getting a standard cost. That is why you take your total budgeted what? Overheads, not so, and divide by what? Your total budgeted what? Level of activity. You are actually getting a standard cost. So if you go to the exam and they ask you for the standard, I get to the standard rate for what do we call it? For fixed overheads, it's still the OAR, because the OAR is actually a standard cost. Anytime you are dividing the budget into a per unit form, you are getting a standard cost, right? That is standard cost. So the most common technique you will need when you are doing standard costing is to be able to prepare flex and flexible budgets. I'll teach you the difference. Some people think they are the same, okay? So flexible budgets are different from flexed budgets. Someone will say, but say, why are you saying this? We think it's the same. No, they are not the same. A flexible budget is a budget that is reflected at different levels of activity, while a flex budget is a budget that is reflected at, it's adjusted to reflect actual levels of activity. So in simple terms, if I tell you that, okay, the company is operating at 80% level of activity, right? I want you to get me the same cost for 70% level of activity, 60% level of activity, or the company produced 1,000 units. I want to get a cost as 800 units. I want to get a cost at 20,000 units. You see, this is flexible, different levels of activity. But with a flexed budget, the company is going to what? Let's say we expected to produce 1,000 units, right? But now the company is going to what? Change this. I get to convert the budget into actual unit produced, and let's say actually produce 800 units. So everything will be reflected at these 800 units. So that's the difference between a flex budget and a flexible budget. And all these make use or make reference to what? The standard costing, okay? So the ICA at this level 2, you need to know the purpose of standard costing. What do we use standard costing for? Okay, so purpose of standard costing. Standard costing can be used, one, for cost determination or cost estimation. They can ask you, it comes most of the time too. You can also use this for anything that can be used to determine cost, can be used to determine selling price, right? Determination of selling price, okay? 3, it can be used for inventory valuation. Remember, you can use it to value inventory or stock valuation. You can use it for decision making, take decisions, right? Decision making. You can use it for budgeting or planning. Okay, standard costing can be used for all these things. Standard costing can also be used for evaluation of performance. So you see where and when we can use what? Standard cost evaluation of performance. Are you getting? Or control purposes, right? So standard costing has the following way. So before you even know variances, these are the theories or the areas you should know about standard costing. They can ask you advantages and disadvantages, okay, of instituting or implementing a standard costing system in your organizational environment. Now, apart from knowing that, then you come to variances. Are you getting it? So first, one thing you have to understand is you must know the basic variances, okay? So the basic variances, you are talking about what? Your cost variances. So you must know your cost variances. You must know your what? Your material variances, your labor and overhead variances, together with what? Your revenue variance. That's your sales variance, which is a variance on now, these basic variants are this in statement, okay? Being able to reconcile the various variances. Are we okay? Together with, well, you are reconciling actual and what? You'll be reconciling your actual versus what? Your budgeted profit. Remember this thing. Actual and budgeted profit reconciliation is the focus at your level. But however, sometimes if you are lucky, you just calculate the variances without reconciling. Now, be careful here because always there may be some hidden inventory. And when inventory comes, students get confused. Always inventory is valued at the standard cost. Okay, that's it. Even if you are calculating actual profits, it is valued as standard cost. Do not forget this. Now, apart from being able to calculate the variances, know the reasons for the variances, right? So why are these happening? The reasons for the variance is more important because nowadays it is possible you be preparing performance reports, okay? When we say performance reports, it means that you are going to what? Write a report like the way you do in FR, financial reporting, or even when you're doing ratio analysis. Variances also are like ratios, right? You tell us why this is happening. So performance report, they can tell you that, okay, we want you to evaluate the performance of the procurement manager, right? And procurement manager, what variance would he be concerned about? Material price variance, right? So how come we estimated that we want to buy material at 2 CD, but we ended up buying at 5? What is the reason? So you tell us, oh, material has shown an adverse variance of 3 CDs per unit. This is because of what? What the procurement manager did well. He didn't perform well. One, the reason is maybe there's been inflation in the system, right? Just like the way, so you say the performance of the procurement manager is as follows. He didn't perform well. This might be due to things like inflation in the system, causing prices to rise. Not so, it could be due to poor planning or poor budgeting by what? The procurement manager, not so, as well as that poor negotiation skills. Maybe he couldn't negotiate well with suppliers, right? So negotiate with suppliers. He couldn't negotiate well with the suppliers. Also, maybe the suppliers had a high bargaining power of suppliers, right? If they have high bargaining power, that tells us that these suppliers can determine price because they are, or the supplier may be a monopoly. He can change price at any time. ECG can change price at any time for us. You get it? So apart from you knowing how to calculate variances, be able to tell us why that variance is happening. Okay, these are the things that are very important. Okay, so for me, this is more concerning than even the calculation of the variance. Being able to assess performance. If it comes to the production manager, which variances are linked to flow? Material price is the one linked to procurement. When it comes to production, right? So production manager will be concerned about all the other ones. So material, labor, overheads, machine utilization, right? All these ones, the production manager is concerned about. You can even talk about HR. HR will be concerned about anything labor, right? Especially the labor rate variance. Labor rate is not, I get it. It goes into production, but this one is by HR, right? So you can criticize HR. Then when it comes to sales, you are maybe talking about your sales or marketing manager, right? So you see how I've done it. So everybody and the responsibility he has within the organization. So you must know each manager and what he's concerned about, or each manager and the role that what. Yes, they are all causes of variances, but you see, you must not, if they ask you for what is causing a variance, you must not like talk about general. It must be related to the case. It must be case specific. Okay, so if you are talking about production, maybe wastage, inefficiencies, right? These are some of the causes. But if you are talking about procurement, you cannot talk about wastage. Well, what did procurement waste? Do you get the idea? So it must be case related. Okay, so those were the basic variances and the things that lead to all variances. Now, advanced variances is the focus in your exam, right? So for advanced variances, be ready to deal with advanced variances. So with advanced variances, we can talk about mixed material, okay, material mix and yield. So material mix and yield. We can also talk about labor mix and yield, but people have not seen labor mix and yield before. And they are saying, why are you talking about labor mix and yield? Let me explain. Anytime you have two quantities of material or more, or two grades of labor or more, you can mix them to work, right? So assuming in a question, I have skilled labor and I have semi-skilled labor or unskilled labor, right? These people can work together, right? So the quantity I am going to mix may differ from what I expected to mix. Maybe initially, if I decided to use what? 2 skilled labor in a project and what? 5 semi-skilled labor, right? In a project, this is the expected, what I expected to mix, right? And this will bring a different result. Maybe these people, when they work together, they are going to produce 1,000 units, right? This is what I planned. This is the output, which we call yield, right? So this is how much I must mix to come and yield this. So mix and yield are actually what I must put together to achieve a specific result. I hope that makes sense. So mix and yield, that's what it means. So if I expected to use 2 skilled and 5 unskilled or semi-skilled labor to achieve 1,000 units, now when things actually happen, I realized that, okay, maybe the semi-skilled were busy. So I could only get 3 of them, and the unskilled, I could only get 1 skilled labor. So actually, I could only mix 1 skilled labor and what? 3 unskilled or semi-skilled labor to achieve the same thing that I want to achieve. Maybe these people were only able to produce me, what, 900 units. So you see, the yield that came was different. That's the output. Yield has to do with output, and the mix is what? The quantity that I've mixed. So this is actually what mixed and yield means. So if you are going to explain what the differences arising are, you can look at the various mix, right? Maybe unavailability of the labor at the time we wanted them. Maybe what? Differences in what? Budgeting or wrong budgeting at the time we want to what? Mix the labor that we are looking for. You get it? So these are some of the things. Then the next one that you learn is what? The sales mix and quantity variances, advanced sales variance, right? So sales mix and quantity variance, you must know this. These variances are just like mix and yield. I'll teach you a simple way to use mix and yield formula to also deals with sales mix when the need arises. Then finally, we look at what? Variance recomputation, okay? So recomputation, or simply you can talk about what? Work back variances. Though they are basic variances here, you must be mathematically inclined, okay? Especially you must be very good with equations, okay? So you are going to work back. So your equations must be very good. If you are not good with equations, you are going to have a problem with this. Okay, apart from that, they are going to ask you some theory around variances. And the theory around variances is one. They can ask you for what causes variance, right? Causes of variances. They can ask you factors to consider when you are investigating variances, okay? So investigation of variances, okay? And then the last question that mostly they can throw to you is interrelationship between variances, okay? So you can have interrelationships between what? Variances, okay? So these are the questions around this area. So management decision-making in the exam is about standard costing and variance analysis, okay? And this area, I could say that what the marks here are also 15 marks, okay? So how many marks do we have so far? Kindly put it in the chat column for me. How many marks do we have so far? 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 30. Nice. So our main focus in the exam is 65 marks. It's not that the other areas we are not going to tackle, we will tackle, but these areas that we are looking at are areas that if you bang all your hopes, okay, at least, and you put all your effort there, the chance that you will pass is very high compared to the other areas. So let's go to the third area, which I want you to focus on. The third area is performance appraisal, right? So with performance appraisal is the easiest area, but I don't know why students do not like it so much. So performance appraisal is the area that carries the highest marks together with the, what do we call it? Short-term decision-making, but performance is an area you have to focus. Now, when it comes to budgeting and decision-making, I'm not saying don't learn it. You will learn it. But the thing is, that area, there's no guarantee that the question that will come, you can easily answer. You know, budgets are mostly confusing, especially when it comes to cash budget. It can be very loaded and sometimes can be ambiguous, right? That's why I tell students that, see, don't go to the exam and go and start with the budgeting question or short-term decision-making question. No, start with the theories. Those ones are going to help you make more, right? Then the last but one question should be decision-making or budgeting. It's up to you, right? Because those ones waste time a lot. You have to think what is relevant, what is irrelevant, you get it, and all that. And budget, you have to set up pro forma, copy your easy marks, and go. When you have time, then you come back if you want to do that. But the best thing is first impressions are the best. Deal with the theories, the contemporary approaches, your variances, and your performance, because that place you write a lot, right? You do interpretation and stuff. So that place is better for students. If you want to pass management accounting, in all my years of teaching management accounting, this strategy works like magic. Okay, so that you do all the areas we are talking about. How many marks do we have so far? That's about that's about what? 50 marks, including performance, right? These 50 marks, at least, if you're able to put your hopes and bang it well, Charlie, the other areas you can just play around them and you are assured of what? Some 55 or 60, right? But people want to master budgets and then the decision making. But what about these other areas? You get the idea. So that is the little trick I want to give you. So with performance, the first area you have to talk about is performance itself, right? So what is performance? What are the metrics of performance? So performance issues like data and information, you must know it, okay? The qualities of good information, right? They can ask you good management information. So you can use accurate. It must be accurate, cost beneficial, complete, not so understandable or user-friendly, relevant, attainable, accessible, then timely, and what? Easy to use. Okay, so you must know all these qualities of good management information. Apart from that, another question that they can ask you here under performance is qualities of a good performance measure, right? You can still use what we have there, but a good performance measure are the things that we use to measure performance, right? So the types of performance measures are the next thing we have to look out for. Then how the impact of what? Other factors, internal and external factors, like what? Government policies, okay, government policies on performance, things like what? Inflation on performance, right? These things are things that can help you interpret. So those things we call pestle factors. So things like pestle and five forces, if you've done strategy before, right? But here your syllabus is not specific as to these things, but it can help you determine what? External influences on your performance, right? So when these things change, for instance, if there's inflation, how does it affect your performance? Okay. Then the next thing that you have to know are the concept of what? Critical success factors and key performance indicators. Critical success factors are things we should be excel at, right? Things we must excel at, which are critical to our success. Things you must excel at or you must be good at, meaning they become critical to your success, and KPIs. Key performance indicators are used to measure your critical success factors. So if we talk about a CSF, you are looking at what you must be good at. So if I'm running an airline, I could say one of the things I must be good at to make people patronize my airline is what? Safety, right? So safety here can be what? A CSF, a key success factor or a critical success factor. Now, how do I measure whether safety has been achieved? We use a KPI. And this KPI is what? We could be something like the number of accidents, right? You all agree? So the number of accidents could be what? One KPI. That tells me that, okay, during the year 2015, this company only saw 0 accidents or saw 2 accidents, right? The customer complaints. Complaints can also be a measure, also for safety. If people complain a lot, it means you are not safe, right? So you can use it to measure. Now, KPIs themselves could be financial or non-financial in nature, okay? So when we talk about KPIs, KPIs is the main focus of your exam. So KPIs may be what? Performance indicator. It could be what? A financial performance indicator. And for financial, mostly we use accounting ratios, okay? So KPIs could be things like accounting ratios. Accounting ratios are KPIs. Variances are also KPIs, okay? You could have cash flow analysis, okay, or cash flow information. These are all KPIs. You can have transfer prices. They are all KPIs. Financial targets, okay? So a financial target is simply a KPI. But in your exam, mostly if KPIs are going to be asked, you are going to be given a question on financial ratios or accounting ratios, and you are going to use them to take decision, right? So with non-financial KPIs, if you think you are stuck and you cannot determine a non-financial indicator, right, for a particular question, you can use the balance scorecard, right? You can use the balance scorecard to identify what non-financial KPI. So if you look at the balance scorecard, it has 4 perspectives. You have the financial, right? The financial perspective, and we have what? The non-financial perspective, right? The non-financial perspectives. So though it's for the financial is the first one, then the non-financial perspective are broken into a customer perspective. Also, so the customer perspective, which talks about customer satisfaction. So customer satisfaction is what? A non-financial indicator. You can talk about internal business process, right? So internally, what processes must you excel at to achieve your target? So internal business, we can talk about things like quality, okay, flexibility of your processes, resource utilization, how you effectively utilize your resources. We can talk about cycle time. We can talk about wastage. I get it. All these things, you must excel at them within your organization. You can use them to measure your internal business, right? They are all KPIs, but they do not involve numbers, right? So non-financial indicators could be things like staff welfare, customer relationship, supplier rapport. These things you cannot, they are not numbers, but they are important, right? Then the other one is what? Innovation and growth, or learning and growth perspective, right? Learning and growth, the amount of product you bring into the market, the safety of your product, new products introduced, use of modern technology. So these things are not numbers, but they are important in achieving what? Your objectives, right? So these are the areas around performance, and these areas come every day, whether you like it or not, you are going to meet someday. Now, apart from these areas, still under performance matrices, you are going to learn divisional performance, and this is the main focus of management accounting, right? So when it comes to divisional performance, you must know how to measure performance in divisions, and that starts with understanding the concept of divisionalization. Okay, understanding the concept of divisionalization or decentralization. So with this, what you have to know is you have to know what the advantages and disadvantages of divisionalization against what centralization. Okay, this is very important. Then apart from that, you must understand the concept of responsibility accounting. Remember, just like we looked at the variance, we're talking about variance that the procurement manager has his own role, the HR has his own role, right? They all have responsibilities that they have. And if procurement's responsibility is to gather costs around procurement, I do not think we can go to procurement manager and ask him for labor. It is not his responsibility to gather labor costs, right? So responsibility accounting is saying that, okay, you are only responsible for things that you have control over. Okay, we can only assess you or assign you responsibility on things that you have control over. Do you get it? That goes with what we call the controllability principle. So we can only assess your performance on things you control. The procurement manager only controls cost around procurement. We cannot go and ask him things about marketing. It's not his job, right? So when you're assessing performance, you must first understand these principles in management accounting. Without this, you cannot do divisional performance. So the financial indicators that we use mostly for divisional performance, right, include contribution analysis. So you can use contribution analysis, which rarely comes, okay? But I'm telling you, you can go and then you are going to use contribution to determine performance, right? So which product has the highest contribution? I get it. Sometimes you can even go forward to use CS ratio to measure, right? Then apart from that, you can use return on investment, which can be given as return on capital employed. It can be given as return on net assets. It can be given as return on total assets. It depends. The question will tell you, but this is the common one. They are all return on investment, right? Then you need to know how to use residual income. Okay, residual income to measure performance. Then the alternative to the residual income, which is a modern approach, which is economic value added, EVA. Okay, so economic value added, which is EVA. Okay, so we have RI and we have what? EVA. Okay, now every method here, I told you, everything here is all about advantages and disadvantages. It's not always calculation. So management accounting is like that. Any metric that you learn, you must learn its advantage and disadvantage. So the next area that you have to look at, which is performance in the public sector, okay, which you should be tipping very well. Public sector performance. So you are looking at your performance in the public sector or NGOs, right? How is performance measurement done there? You know, these people, because they are not profit-making organizations, usually it's difficult to measure performance there, right? So we mostly stick to using value for money, right? To measure performance there, the 3 E's. Okay, so efficiency, economy, effectiveness, and efficiency. Okay, this is what we use to measure performance there. Then you look at what? How performance is difficult there. Difficulty measure performance. The reason is because these people have multiple objectives. Okay, their objectives are mostly plenty, so you cannot measure. Sometimes there's too much government interference in their operations, not so. Sometimes they have conflicting objectives, not so. And sometimes it is difficult to quantify their objectives. So there are a lot of reasons why it is difficult measuring performance in the public sector for NGOs, right? Apart from that, you also need to look at performance, why performance measurement in services are difficult, right? Services are difficult to measure performance because of what? SHIP, or you can add O. Now they've added O to it. Services are difficult to measure their performance because One is simultaneous, they are heterogeneous, or they are different all the time. I can teach the same class and it will be different, right? They are intangible, you cannot hold them, they are perishable, and nobody can claim ownership over services. Okay, you can't transfer ownership of a service. So these are the things that make service measuring performance in services difficult. Then finally, you need to know about transfer pricing. Now, for transfer pricing at your level is focused on domestic transfer pricing, right? At the advanced levels, that's level 3, or in strategic case study, we mostly focus on international transfer pricing. But at your level, you do domestic transfer pricing. So know the transfer pricing methods, and the methods, just be able to define them and talk about the advantages or what disadvantages of these transfer pricing methods. Are we okay? Then be able to talk about the objectives of transfer pricing. Okay, so even if some calculations are going to come, you are just going to determine the most sensible transfer price. Okay, and then they'll ask you, ICA transfer pricing is not difficult. They mostly tell you to re-prepare financial statement, okay, taking into consideration the transfer prices. So you just need to determine a sensible transfer price to use. Okay, so these are the things that you must understand under performance. So you see that performance is the area which is broader. Performance is broader than all the areas because almost everything in your paper is used to assess performance. Okay, all the costing methods can be used to still assess performance. So that was performance. And the next area, which is my focus, is long-term decision making. Okay, so long-term decision making. And long-term decision making is what we call capital budgeting. Okay, capital budgeting. So capital budgeting or investment appraisal. So here you need to learn what the investment appraisal process, okay, the capital budgeting process. So you must know this. Okay, this is theory. You must know and explain. You must also be able to explain to us what the time value of money. Why one CD today is better than what a CD tomorrow. So the time value of money. I've written time of value. The time value of money, very important. Okay, the time value of money. Then you must also be able to tell us the factors that influence the time value of money. So there are some factors that influence time value of money, like what? Risk, inflation, okay, and opportunity cost of capital, right? So you must be able to tell us how these things impact what? The time value of money. So you realize that these things are all theory, and you realize that everything I say, I'm more geared towards the theoretical side. Yes, because there are so many questions that I see can ask you, right? Then from there, we learn basic methods of appraisal. And any method, I told you that anything you are learning, make sure you know at least some advantages and disadvantages of the methods. So there are two main methods here. That's accounting rate of return, which can also be return on capital employed, or simple rates of return. Okay, so they can give you a different name. Then we have what we call payback. Okay, so you should know the methods, right? Accounting rate of return, simple rate of return, then payback method. These are the basic appraisal methods that do not have the time value of money. So if you are even talking about advantages, you can always say that ARR is simple to calculate, it's easy to understand, and does not involve the time value of money as a disadvantage, right? And also because it is short term, you see, they are all the same. Payback to is simple to calculate, simple to understand, does not involve what time value of money being a disadvantage, and also what it is used in the short term, making it disadvantageous. Do you get it? So these are just the basic methods. Then the discounted cash flow techniques. We have discounted what? Cash flow techniques. So discounted cash flow techniques. Here, this is where you are going to learn what? The most important one at your level, because ICA at your level, we are more concerned about break-even. You must learn MPV, which is the most superior investment appraisal technique because it uses cash, right? We get value in cash, increasing shareholders' wealth. Then we learn IRR. These are the most important ones that ICA will ask you. But apart from that, you must know how to measure profitability index. Okay, you must know how to measure profitability index. You must know how to measure discounted payback. Okay, discounted payback. And you must know how to deal with certainty equivalent. But that one I could say risk in investment appraisal, right? Risk in investment appraisal. So when we talk about risk in investment appraisal, we just have to know how to deal with what? Expected values, right? How to use expected values in what? Decision making. Okay, expected values in decision making. Okay, so that is it. But also, there's one area you must be very good with cash flows, because your syllabus also asks for what do we call it? Expected annual equivalent, right? So you can use annual equivalent, meaning that they are mostly going to ask you about how to deal with things like annuities and perpetuities, right? Perpetuities, annuities, and how to deal with terminal values. So you could have cash flows beginning in year 10, cash flows that begin in year 50. Okay, so these things, you have to know them, right? And if you see, with these ones that I've put down, investment appraisal is also 15 marks, right? So in summary, I'm just going to focus on the 65 marks. And if we have time, we will look at some particular techniques in short-term decision making and budgeting that you add up, right? Which I'm not going to even mention them. The rest, so if I should put them, summarize what I've put so far, we have contemporary approaches, right? Which was what? Contemporary approaches was what? 50 marks, not so. Then I gave you variances, okay, variance analysis, giving us what? Another 15 marks. Then we came to what? Performance, not so. Performance, giving us what? 20 marks. This was the huge part, not so. Then finally, I gave you long-term decision making or capital budgeting, right? Capital budgeting being what? Additional what? 15 marks. So how many marks do we have overall? 65 marks, which for me, this is my focus for my students, right? I'm not saying the other areas you wouldn't learn. Yes, you will learn, but here's your focus. It means that if you are sitting in the exam room, you want to crack this 65, right? Then the other areas is where you go and you do not waste so much time there. They should be your last, are you getting it? Last but one to last, right? Last to last. That is the area that you are going to what? Use. You get it? So here we have budgets. Budgets also carry marks, but don't be fooled by the marks. They can be very daunting. That's why they are 20 marks, right? They could be 15, sorry. They can make it 20 or 15, depending on how they want to structure. But budgets are what? 15 marks. Okay, budgets are 15 marks. And here the focus is mostly cash budgets and master budgets. But the budgetary systems are also here. Okay, so here it's either you are getting a cash or master budget calculation, not so, or they could ask you for budgetary systems, okay, which will come for theory, zero-based budgeting, program-based budgeting for the public sector. Look in the new syllabus, I think they are going to bring more public sector, and in our old syllabus of program-based budgeting, at least take time and look at program-based budgeting this night before you go and write, because there's possibility that they are going to ask you something around that if a calculation does not come. But I'm really expecting a cash budget or a master budget, right? Apart from that too, you could have dysfunctional behavior, right? So decision, how do we call it? Behavioral approach to budgeting, okay? So behavioral approach or behavioral or behavior of people in budgeting, okay? Participatory or imposed style of budgeting. Then when it comes to decision making, that short-term decision making, that also carries a huge mark. That's 20 marks, right? And you know, the reason why I said these things can waste time is because when it comes to budgets, mostly cash and master budget, they waste time. They are time wasters. So I wouldn't advise any student to make this his first or second or third question. No, you get where I'm coming from. If you make this your first or second or third question, it can waste your time. Please do not do that. I hope that is okay. Don't waste your time doing that. So decision making, mostly you are looking at short-term decision making. They can ask you what relevant costs are. So you must be able to talk about relevant cost and relevant revenues, what they are. You must be able to also tell us what the decision-making steps to take decision, the decision-making process in every organization, right? Which could be your strategic decision-making process as well. Then they can also ask you other things around relevant costs, like non-financial information. A question can just come on non-financial information pertaining to a particular decision. Okay, these areas you must know them. After that, you must learn marginal costing techniques around way, and that's what I'm actually tipping for you. So marginal costing techniques here, you are going to learn what? Cost volume profit analysis. And you see, management accounting, this is the most important technique because it is used everywhere. Even if you cannot do shutdown, make or buy, you must know CVP because it's simply marginal costing I get a variable costing that we use. So most important. So this thing, you must revise it before you sleep, but I'll still take you through at the latter part because this is not our main focus. Then limiting factor decisions, right? Limiting factor goes with throughput. So once I teach you throughput, I'll also teach you limiting factor, right? Then apart from that, you have the specific decisions, and the specific decisions is where you now have your make or buy decision. Okay, this is where you have make or buy or outsourcing decision. You have shutdown decision, okay, shutdown decision or discontinuance decision, okay. Special order decisions where you accept or reject. So we call this accept or reject decision. Then you have pricing decisions, right? So these are all areas that you can have this thing out. Then you can have differential cost decisions. When we say it's a differential cost decision, this is something like do something or don't do something, right? So you weigh the cost, the relevant cost of doing and the relevant cost of not doing, right? So this is your whole syllabus. It's involving, eh? It is very involving. So as a student, I've already given you the area you are to focus on to what? Make your mark. Do you get it? So now we are going to take it step by step by step so that we are on the same track, right? So let's start with the contemporary approaches to management accounting. And let's start with what management accounting actually is. Exactly the time we have to start. So first of all, what is management accounting? Management accounting is a branch of accounting, right? It's a branch of accounting actually, or you could say it's an internal method or internal technique or internal branch of accounting, right? So management accounting is actually internal. It's an internal branch of accounting, but it uses both financial and non-financial information, right? To assist management in planning, control, and decision making, right? To achieve organizational objectives. Okay. So that is management accounting. And you see that everything that I've said here, I've separated it. One, a branch of accounting, which is internal. Two, it uses financial and non-financial information. Three, to help management in planning, control, and decision making. And four, to achieve organizational objectives. Now, each of these things, if you have to break it down, we'll get so many things to talk about, right? So that is management accounting. So my main focus is to understand what? Planning, controlling, and decision making. So when we talk about planning, what is planning? When we talk about planning, what is planning? We must understand what planning means. So you can see here, planning involves what? Establishing objectives of what? And using it to achieve what? Those objectives, right? In order to make plans, it helps to know what has happened in the past so that decisions about what will be achievable in the future can be made. For example, if a manager is planning future sales volumes, he or she needs to know what sales volumes have been in the past, right? Planning can be short-term or long-term, or sometimes you can even have medium-term. Are we okay? Then what is decision making? This is where we consider information that have been provided and make informed decisions from them. So that is decision making, right? So decision making has two steps, right? You establish the decision, then you implement the decision, right? That is decision making. Controlling is what? Where you You use information that you have planned, not so, set it off against what actually happened and establish what? Corrective actions, right? So these are the things that you must understand. At your level, it is difficult for them to ask you the differences between management accounting and financial accounting, but you have to know them. Okay, that one I know, you know, but mostly management accounting is internal, financial accounting is external. Management accounting, the information that is generated is to aid in planning, control, and decision making. And for financial accounting is to record financial performance in a period, right? There are no legal requirements for management accountant. It's purely internal, okay? But for financial accounting, companies must produce financial account. Management accounting has no format. Financial accounting has a format specified by IFRS or the law. And then the nature of information, management accounting uses both financial and non-financial, but financial accounting uses purely or mostly financial information. Management accounting can be both historical information and forward-looking information, while financial accounting can be mostly what? Historical information. Are we okay? So these things, you must just know them. Now, we talked about planning, and I was telling you that planning has what? different ranges. It could be short term, it could be long term, it could be medium term. But Anthony came up with a hierarchy for the levels of planning. You must know the various levels of planning in the organization. The strategic level, they do the corporate plans, right? And they plan 5 years and above, right? Then we have the tactical level, which is the middle level, and they do what? The medium, short and medium term planning between 1 year to 3 year planning, right? And then we have the operational level. The operational level are the ones who do the day-to-day planning. Okay, so these things you must be able to do and explain this, right? So that is what you have to do. And they can ask you a question about the strategic planning process in management accounting. So you scan your environment. Actually, you establish a mission and objective. Are you getting it? You scan your environment, establish your strengths and weaknesses, and also consider various alternatives on how to implement them, evaluate the alternatives and select an alternative and implement it. They are all there, okay? So just like we saw, okay? There are various types of controls. The same way you can have strategic level controls, you could have tactical level, you could have operational controls. Decision making to the same thing. You can have the strategic level, decisions taken by the board and senior management, tactical levels, decisions taken at the functional level, and operational level decisions taken by supervisors and foremen and workers, right? So these things you have to understand them. And what are the types of decisions organizations can take? We can have routine and non-routine decisions, or programmed and non-programmed decisions. Program decisions are things you do day on day, right? And non-program or non-routine decisions are things that can happen later or happen once in a blue moon, like the purchase of an asset. You can buy an asset not every day. It's not something you do day to day, right? It can come as and when, right? So these are all areas that they can ask you questions on. Okay, so you remember I was talking about what data and information at your level, what they are mostly going to ask you about, because management accounting uses financial and non-financial information. They can ask you what kind of financial information is required to take a particular decision. Okay, so you must know financial information like cost of heat, like capital cost, costing, all those things are financial. And non-financial information can be things like attendance records, details on the number of meals served each day, staff turnover. These ones are non-financial. Then management accounting can also require a combination of both financial and non-financial information, which I told you. So they can ask you, what is the uses of management information? Management information can be used for planning and forecasting. It can be used for decision-making, for monitoring and evaluation of performance, and also for controlling of activities. So remember I told you that management accounting information has some qualities that will make us say that, okay, this information is quality, right? So we can have what? Accuracy. Management accounting information must be accurate. Okay, let me zoom this a little. Management accounting information, we are looking at accuracy, should be accurate. I get it? Because using incorrect information will have serious and damaging consequences on the organization. Two, it should be complete. An information user should have all the information he needs, but it should not be excessive. It should be cost effective, right? That means the cost, the benefit of getting the information should be more than the cost. Then it should be understandable, must be clear to the user using it. It must be relevant, right? Meaning it must influence the user using it. It must be accessible via the appropriate channels of communication to the right people, and it must be timely. Your manager needs information on Friday, you submit it on Monday, it is not relevant, right? It is not timely, and it should be easy to use. Are we okay? So they can also ask you for sources of data for decision making. We have looked at the qualities of information. They can also ask you sources of information or sources of what? Data for information. You can get it from internal sources, which includes your accounting records, your production schedules, human resource records, technical reports, and from external records or external sources. You can get it from government policy, the media, industry information from trade bulletins, product features from the internet, government agencies such as the Ghana Revenue Authority. So these are all what? Sources of information for decision or sources of data. They can ask you, right? Then what are the limitations of management information? Okay. Sometimes you may fail to meet the requirement of what? Good information. The problem is that sometimes as to what information is relevant may be difficult, right? Because you may have things like what? Sunk cost, incremental cost, cash flows. All these things may be a problem, right? Then the problem of non-financial information and external information can be difficult to quantify. Okay, so those are the limitations of management information. And this is the first part of your management accounting journey. Now, the next part we have to talk about is ethics in management accounting. So I'm going to put ethics in red, right? So ethics, mostly you can get theory here, when it comes to ethics. The questions can be directly theory, or it could be what? A case, a small or mini case where you have to implement. So when it comes to ethics, first of all, what do you have to know when it comes to ethics in management accounting? First of all, you have to know what ethics is, okay? Codes that guide your moral behavior. In simple terms, that is ethics. So we have some fundamental principles of ethics that every accountant has to know, right? Fundamental principles. So I said when you hear these fundamental principles, you can use what? Pico, okay? Dr. Pico. So I will not go in that fashion. We start with integrity, okay? So integrity means what? You, the accountant, must be honest, right? You must be honest. It's all about being honest. I get it. In all your financial and business dealings, you must be transparent. It goes with honesty and transparency. Also, you must not conceal or hide anything. That's being transparent, and not also be what? Associated with what? Misleading information. So if you're associated with misleading information, it means you're hiding something, right? So we are saying you do not have integrity. So always ensure you have integrity, right? So in a case, you can even check if the person is trying to hide something, meaning it's breaching integrity, okay? Two, we have objectivity, okay? Objectivity means you are allowing what? Bias, okay? So objectivity means allowing bias and undue influence, okay? Allowing bias and undue influence to cloud your professional judgment, okay? So allowing bias and undue influence to cloud your professional judgment. So what does this mean? It means that, let's say you are dealing with two clients. One client gives you more revenue than the other, and they have a case. You may be tempted to deal with the other one that gives you more money because you think you are going to lose him, but you are not being fair. Maybe the other one was right? So what will make you not be objective? Meaning there might be some inducement or some things that will influence you. And the things that influence you to not be objective are all threats to this objectivity, right? So that is it. Then the next area we have to talk about is confidentiality. So confidentiality is two things. One, not disclosing information without appropriate permission. So do not disclose information, okay, without what? Appropriate information or appropriate permission, okay? And two, that's the first one. Two, do not use information, okay? So not using information to your own personal advantage, okay? So do not use information to your own personal what? Advantage. Are we okay? These are the two things that you think about. Now, under what circumstance can somebody say, okay, though I'm not using information to my personal advantage, I need to disclose? So there are two criteria for disclosure. It's either it is what? Mandatory, okay, or compulsory, and then what? Voluntary. So voluntarily, under what circumstance do you have to disclose information? As a management accountant, if you feel the information is of public interest, people ought to know, you have to disclose. To permission from the client. Have you asked permission from the client? If you ask permission, the client says you can disclose. And finally, what? If it is in your legal or professional capacity to do so. So legal or professional right. If you have a legal or professional right to disclose the information, then you can disclose voluntarily. That's why it's not compulsory if you like. But mandatory information disclosure, first of all, if the court has given you an order, that one there is the court that ordered you. So it goes beyond permission. If you see the client is doing things like money laundering, okay, he's laundering money, you have to what? Disclose. Drug trafficking, you see somebody trafficking drugs, it's against the law, disclose. You see somebody is into terrorism, right? You have to disclose. Things like tax evasion, gross tax evasion, siphoning money from government, right? You have to disclose these things, right? So that is confidentiality and what it means. That's the job of the management accountant. Now, the next area is what? Competence and due care. Okay, so competence and due care means that you must exercise what? Reasonable skill and care. So that's due care. Exercise reasonable skill and care in the work you do so that your client will benefit from the service, right? And also make sure you have up-to-date knowledge, right? So attend trainings, do all that. Now, competence and due care means do not rush, take your time when you are doing work, and also make sure that you're up to date in knowledge, right? You can give your client the best of knowledge that you are not in the past, okay? So what will cause somebody not to be competent is 2 things or 3 things. I use rate, okay? So if somebody is not competent, it means that he either had inadequate time, he had inadequate resources, or he had inadequate information, right? These are the things that can cause somebody to not be competent or exercise due care, especially if you do not have time. You want to rush things, okay? Meaning you did not exercise due and reasonable care in doing the work. And you may not be up to date in knowledge because you didn't have enough information about that area, or you didn't have enough resource to maybe attend a seminar, right? This could make you not to be competent. Somebody did not attend class because he didn't have enough money to attend class, and that has brought a limitation in his competence. Are we okay? So that is competence and due care. And the final one is actually professional behavior. Okay, so the final thing, or the final code of ethics or the fundamental principle is professional behavior. Now, for professional behavior, we are saying do not do anything. Okay, so not doing anything that discredits the profession, right? Not doing anything that discredits the profession. So you are not doing anything that discredits the profession. Okay, so these are the things that you do not do. So things like complying with laws and regulations, knowing how to talk to people, not breaching any of the above. So breaching any of the above principles means you have breached professional behavior. Okay, so these are the fundamental principles. Then the next question they can ask you are the threats. So what things will not make people comply with the ethical principles above, right? So the threats, I told you here, you can use as if, okay? So as if, what are the threats? The first one I'll talk about is the first S, which is self-interest. So mostly for management accountants, the main one that you are mostly, because management accountant is within organization, we are looking at things for his own personal interest, maybe some gift and hospitality, okay? Gift and hospitality, some bonuses or performance incentives, right? If we promise to give them, for management accountants, they will tell you they are going to give you a bonus if you achieve an ROI of 30%, right? Because of that, you may think about your own benefits, maybe manipulation to get it, right? Performance incentives. This could be one of the gift and hospitality could be one of the things you are talking about, right? All these things. Then any other personal benefit the person may get is a self-interest threat. Then we look at self-review. So self-review threat mostly is for accountants in practice. That's auditors, because those people do not work within the organization, right? But I come to check. So if you, the auditor, the one preparing the accounts for the person, you are the same person come to audit it, you are checking your own work. So self-review is checking your own work, right? Okay, so for a management accountant, what risk can this have? Let's say you are the person who recommended the software and you are the same person using that software in the organization, okay? Or you are the person who set up the software and you are the same person checking the software again. You cannot see your own mistakes. So self-review is checking your own work. That's the second trait. Then we have advocacy traits. So advocacy trait is simply when people see you to be on the client side, okay? When you are seen to be supporting or promoting the client. Okay, supporting or promoting the client. This is what we call an advocacy trait. You are acting like an advocate of the client. Okay, so where you are seen to be promoting or advocating the client, these are the things that we are talking about, right? That's advocacy. Then, apart from advocacy traits, we have intimidation trait. And for management accountants, this is the most common, intimidation. You will be intimidated, right? Or pressure will be put on you. So things like pressure, threats, okay, where somebody is giving you threats, or maybe somebody will put you under stress, duress. These are all intimidation threats, especially management pressure. Maybe you are preparing cash flow information, they ask you to manipulate it, the management is putting pressure on you. So if you get a case, all you have to do is open your eyes and see what is happening. So the person is a new management accountant, he just finished ICA, and they are putting pressure on him to manipulate the variance information because you want to go and get a loan from the bank, okay, or you are raising finance. That is management pressure. So you just identify the particular information at hand and then talk about it. So that is it. Apart from this, we can have safeguards, right? You can have various safeguards. Safeguards are actions to prevent these things from happening. So these actions, they come from three main perspectives, right? It could be safeguards provided by the profession. It could be safeguards provided in a work environment. That is where you are working. And it could be safeguards provided on individual work that you are going to do, or individual assignments, right? So these are what they are. So provided by the profession, we have things like continuous professional development, you writing your exams, right? You getting your membership, not so. You can have what post-chartered diploma just to enrich your knowledge. And also you have things like your regular reviews. ICA does reviews. You can get practicing license. Okay. All these things are ways to check whether you are complying with the fundamental principles, right? That's why ICA does this. Now, the work environment is you yourself within the organization. You must make sure that you set what? Proper internal control. So you can put in a proper internal control system. You can train and retrain staff, right? Training of staff, HR requirements. So you can have human resource controls, like what staff can do and cannot do. They are all controls, right? Who to employ. You can even do risk assessment once often, not so. Apart from that, you can put in corporate governance mechanisms. These are all things to do within the organization. And on individual assignment, you can rotate staff. Okay, so rotation of staff. You can decline, sometimes you can decline some assignments if you think it will bring conflict of interest. Sometimes you can use separate teams to do work. We call it Chinese walls. Okay, sometimes you can withdraw from a particular investment. I get it. Maybe you own shares in the client. You are going to audit that same client. You can what? Also go out of it, right? These are safeguards. I forgot one threat, which we call familiarity. Familiarity threat is where you are too familiar with the person, maybe close family, I get a close family ties or friendship or business relationships, right? You know the person so much that you are ignoring his errors, or you don't want to offend the person. It's a familiarity trait, right? So these are the safeguards. If you go and they ask you for actions in a particular case, you can suggest any of these things and it will still work. But make sure it is case specific. Are we okay? Then the last thing I'll talk about under ethics is the consequences of unethical behavior. Okay, consequences of unethical behavior. So what are some of the consequences when you act unethically? Okay, what are some of the consequences? One, it could lead to collapse of the company. Not so. Two, it could lead to losses. Okay. Three, it could also lead to what? Maybe withdrawal of your professional license. Okay, for the individual, withdrawal of your professional license or your practicing license if you are practicing. It could damage your reputation. Okay, so reputational damage, people will not trust you again. So reputational damage. Sometimes it could lead to sanctions, penalties, and fines, not so. So you may pay some penalties and fines, not so. Also, another thing you can consider is what? Imprisonment. Sometimes you can be imprisoned. Okay. Can talk about disciplinary action. You may be disciplined. Also disciplinary action taken by the institute. And in worst cases, death, right? Some people have acted unethically and it has led to death. Okay. So this is the first part that we have to know and talk about. If you have any question now, you can kindly put up your hand and you'll be called before we move to the next session, which is what? The modern costing techniques. The modern costing techniques. Do you have any question? Do we have any question? Since we do not, we have to start by looking at the modern costing techniques or the models of evaluation. So the models of evaluation, we are going to first start with environmental management accounting. Now, what is environmental management accounting? You must understand what it means. So where companies are assessing their impact on the environment, okay, and identifying costs that are associated with those impacts is environmental management accounting. Now, the purpose of environmental management accounting stems from the fact that environmental issues are significant in terms of both strategy and cost. For example, if you have poor environmental behavior, it can result in significant cost or losses, such as fines for excessive pollution, environmental taxes, loss of land values, the cost of lawsuits, and so on. So environmental behavior can also affect the perception of your customers and their attitudes to a company and its product. Increasingly, consumers take environmental factors into account when they are buying their product. So let's say you're a company and then you are dumping rubber in the community, you are not minding anybody. People will see it like you are not serious, not so, or you are destroying the community and they may not want to buy from you. Those are green consumers. Now, environmental management accounting can be used to provide information to management to help with the management of environmental issues. So our traditional management accounting system, which is traditional costing or what absorption costing, can underestimate or even ignore costs of poor environmental behavior, because you see, when the management accountant is capturing costs, he does not consider the impact on the environment, which means that you can what? Underestimate your cost, right? But what you have to do is that what? You can also overestimate the cost of improving environmental practices, and sometimes they can even what? Underestimate the benefits of improving what? Environmental practices. Besides, environmental management accountants or environmental management accounting provides managers with financial and non-financial information to support the environmental management decision making. So EMA complements other conventional management accounting system, but does not what? Replace them. You must account for them together, right? To show what you are doing in the environment. So it can be used for the following. Estimating, they can ask you the uses of environmental management accounting. It can be used to estimate annual environmental costs. EMA can provide useful information for the preparation of what annual budget to help estimate the amount of resources required to promote environmental programs. EMA provides relevant cost information for product pricing. EMA can help in estimating cleanup costs. Let's say you've set up shop to maybe produce. When you finish, you have to restore the land to its original form, right? So these cleanup costs, it can help you estimate them. It provides relevant information about a firm's financing and investment opportunity, and it can help us estimate savings from what environmental accounting what programs. Okay, so this is the uses of EMA. Okay, so according to Variance and others, a framework for EMA will provide information to management from various sources. So they can use sources of information from what? For environmental management accounting could come from internal sources, could come from monetary or what? Physical measurements, historical or prospective looking information, short and long-term focused information, and routine or ad hoc information. These are all sources of information for environmental management accounting. Okay, so in case these things can be ready to write something around it. Okay, so with environmental management accounting techniques, these are the things that you have to know, okay? So this is the question that if questions are coming, they're mostly going to ask you about when it comes to environmental management accounting. So these things, let it be with you. Environmental management accounting techniques are mostly four. One is redefining cost. Two, environmental activity-based costing. Three, life cycle costing. Four, throughput accounting, right? These are all what? Or you can say input and output analysis. Those things, these are all what? Environmental management accounting techniques, okay? Input, output analysis or throughput accounting. So with these things that we have, let's look at them one by one. So I think one of the diets, they examine this, which is redefining cost alone. Okay, they ask you what the US Environmental Protection Agency classify cost as. So you must be ready to determine this one. So the US Environmental Protection Agency has classified environmental costs into four. So apart from our normal costing costs, product and period costs, material, labor, they have come up with their cost classification. Okay, and this cost classification can also be used to redefine your cost to measure what environmental performance or your impact on the environment. Okay, so conventional costs, these are environmental costs of material and what energy that have environmental relevance and that can be captured in your costing system. So remember, conventional costs, material and energy costs that are important in the environment. And two, potentially hidden costs. So potentially hidden costs are environmental costs that might get lost within the general heading of your overheads. Okay. So they are costs that are, you cannot see them directly, but they are actually incurred, right, in the environment, right? Things that cannot directly be measured. Then we have contingent costs. These are costs that might be incurred at a future date, such as things that are dependent on your operations. I get in that in the future, maybe you have to dismantle some machines, restore the land, restoration costs, they are all part of a contingent cost. Then image and relationship costs. If you are damaging the environment, there are things that are what associated with your image, such as what the cost of producing environmental report. There are also costs of behaving in an environmentally irresponsible way, such as what the cost of lost sales as a result of what causing a major environmental disaster. Okay, so remember, I'm even concerned about this more because the rest you can say something about it, right? So we have what? CPCI, conventional cost, potentially hidden cost, contingent cost, and image and relationship cost, right? So remember these ones. The next technique in environmental management accounting is what? Environmental activity-based costing. So environmental activity-based costing is the application of what? Environmental cost to activity-based accounting. So here, a distinction is made between environmental costs. So environmentally related costs and environmentally driven costs. Okay, so the environmental related costs are costs that are attributable to cost centers involved in environmental related activities, such as what? Waste recycling plants, incinerator costs. Are you getting it? And then we have what? Environmentally driven costs. And these are overhead costs resulting from environmental related factors, such as high cost of labor or depreciation. Now, one thing here is that in the environment, you have to look at what? Cost drivers, okay? Just like your normal activity-based costing. What are the cost drivers in the environment? Like volume of emission or waste, toxicity, environmental impact added, right? Then the volume of emissions or waste treated. These are all cost drivers. So based on the cost, we are going to drive it by the cost drivers and get a favorable overhead absorption rate to know how your environmental costs are performing. So it's just like your normal activity-based costing, but we are looking at the impact in the environment, right? Then we have environmental life cycle costing. This is where we look at what? All the costs over the entire life cycle of a product. So when it comes to life cycle costing, okay, is where we gather all the costs from the product life cycle. So from the introduction of the product into the market, it goes to the growth stage, also go to the maturity stage, and finally to the decline stage, right? So you are gathering costs all over the life cycle of the product. And then most of the time with this one, all you have to do is that you have to gather all the costs. So you are going to get your life cycle cost per unit. And life cycle cost per unit is just total costs over the life cycle, okay? All over what? The total life cycle units, okay? Your total life cycle what? Units. This is what we are trying to get. So if you get any question, just add up all the costs. You know, some costs will repeat, some costs will not repeat. So a typical example is, let's say we are producing a product, right? And we're producing the product. It tells us that what? The product will produce 50,000 seed. We are going to produce 50,000 units for 5 years, right? 5 years. Then they tell us that these are the costs. We will incur material of 10 cedis per unit, not so. Material 10 cedis per unit. I get it. Per annum, right? 10 cedis per unit per annum. Labor and overheads. Labor and overheads. We are going to incur what? 30 cedis per unit per annum, right? Then we have, they told us that we'll have what? Initial setup cost. Okay, so initial setup cost being, let's say, 1.2 million, also 1.2 million. We have maybe dismantling costs, okay, dismantling cost. That's after we finish our project and we'll dismantle this for 580,000, okay? So assuming these are the costs and they're asking us to find our life cycle cost per unit, we know that we have to bring all these costs together. And you know, we have 5 years. So some of the costs, they are one-off. Something like this one, it's a one-off cost, right? Initial setup. Then dismantling cost. It's also a one-off cost, right? Because it happens one-off. But material, labor, and overheads happen every year. Okay, so we have to gather our life cycle cost and get our life cycle cost per unit. So let's get our life cycle cost. Okay, so life cycle cost, we have what? If we are gathering, we have what? Introduction, during the introduction stage, are you getting it? We have our setup cost, but if you like, you not group them. Our setup cost, initial setup cost was how much? So we bring our initial setup costs. So setting up the machines will cost us 1.2 million also. Apart from that, over the life cycle, we have what? Because this one is over 5 years, we have material. So material, we said materials was what? 10 cedis per unit, but we are producing 50,000 units for how long? For 5 years, right? So some people are going to do year 1, year 2, year 3, year 4, year 5. Don't do that. You can waste time. You just gather all the costs, multiply. Are we okay? So with that being the case, what then do we get? Okay, so you have 2.5 million being material costs. So I'm going to gather all my material costs here, 2.5 million, and also Then we have labor and overheads, right? So with labor and overheads it was 30 cedis per unit, but we are producing what? 50,000 units over what? 5 years, right? And that's 7.5 million. Okay, so we have 7.5 what million, not so. Then we had the dismantling cost. We have to dismantle the machines at the end of what? The period, which was 580,000. So this is cost over 5 years, right? We group all the costs under the life cycle. So let's add up. So we have 1.2 million plus 2.5 million plus 7.5 million plus 580,000, right? So this gives us what? 11,780,000 being the total life cycle cost, right? So these are total life cycle cost, right? And what's our total life cycle units? So total life cycle units will be what? How many units did we produce over the life cycle? We know we are producing 50,000 per annum, but we are going for 5 years, meaning that we are producing what? 250,000 what units. So if we take this and divide by the 250,000 units, we should get what? We should get the life cycle cost per unit, right? Do you all agree? So what's our life cycle cost per unit? Okay, which is our 11,780,000 divided by 250,000. And what do we get? 11,780,000 divided by 250,000 units over the life cycle. Meaning once we are done, we are going to sell, or we are going to get a cost for 47 cedis, 12 pesos, right? For the product. So this is the life cycle cost over, or the cost over the life cycle, and that is the life cycle cost per unit. So this is how we do life cycle costing. Are we okay? So the next technique which I want us to talk about is benchmarking. What is benchmarking? Benchmarking is part of your syllabus. Benchmarking is a continuous process of measuring product, service, and practices against the toughest competitors or the companies recognized as industry levels, as industry leaders. We call it the best in class. So benchmarking is simply comparing your performance against people who are doing good at, I get it, who are better in the industry, or who are better than you, or who are the best in class. So Vodafone or maybe Airtel Tigo comparing against MTN's performance is benchmarking. So we are looking at you comparing to those doing very well, right? So it is a process of setting standards or target for products, services, or work processes with reference to organizations that are recognized as the models of the best practice. A benchmark is an organization that provides the best practice for comparison, okay? So an entity uses benchmarking to evaluate its own products, services, or work processes by comparing them with the best practice of the benchmark organization. The purpose of benchmarking is to identify measures that need to be taken or to improve or change so that the organization becomes as good as or better than the benchmark. So you are doing this or comparing performance to ensure that what you become better than the one who is already there. Are you getting it? Or you become closer to him, something like that, right? So the question that ICA can mostly ask you is the importance of benchmarking or the processes used in benchmarking. So benchmarking has some steps. One, you must identify aspects of your performance that you want to compare with your benchmark partner. You must select a suitable benchmark partner, also. Then you compare the product or service with the benchmark. So it's like identify what you want to benchmark, select who that company you want to benchmark against this, compare yours to that benchmark. Then you identify gaps in your performance against that person's own, not so. Then you identify the change that you can improve in your business to what? Improve your performance. Then you implement the improvement, and you also monitor and measure the success of your change. Are you getting it? And measure the benefits that come out of it. So I hope you won't forget. So it's simple. Identify areas you want to benchmark, select a suitable benchmark, identify or compare yours with that person, identify gaps, identify the change that you need to improve, implement the improvement, and monitor the success and measure the benefits. Are you okay? So what are the benefits benchmarking can offer? This one, you can use your own mind to generate points, right? Because measuring to improve performance, one, it can help you identify aspects that we can improve, set targets for improvement. It can be used to look at practices in companies in different industries and learn from them. It can encourage continuous improvement, right? And encourage managers and employees to make improvements that they believe are necessary. Okay. But what is the limitation? It comes with several problems, right? It might be difficult to identify a critical process where benchmarking would provide valuable information to help improve your performance, right? So some areas you can select may not be critical to your performance, and it might be difficult to also obtain relevant information for comparison. Okay, that's a problem. So that is it. So there are some methods of benchmarking that you need to look out for. We have internal benchmarking, which uses a benchmark against the organization itself, right? So we can look at one performance in one branch against the performance in another branch, right? The same organization, right? So we have similar operations in regional offices. We can compare them and see which one is doing well. Internal benchmark, right? We have competitive benchmarking, which uses a successful competitor as the benchmark, right? So, okay, I'm using MTN and Vodafone. That could be competitive benchmarking, okay? So these are some of the things that you have, but the competitive benchmarking may have some disadvantages, or it may have some problem, because most competitive benchmark information are non-financial and are not readily available. And if you want information, sometimes you cannot get, you know that, because how can the competitor give information if it's not published? It may be secret, it may be hidden in the competitors' firms, right? Okay. Then we have what we call process benchmarking. Process benchmarking is the most common method of benchmarking, right? It involves comparison of a performance of an entity in one particular activity or process with the performance of another entity in a different industry. So if we are looking at sales, how does this entity do their sales? I compare my sales process with their sales process, right? So we identify best practice and make sure that we do ours to what? To suit that type, right? So the next is what? Customer benchmarking, which is a completely different approach. This uses the customer as a benchmark, trying to establish what the customer wants and expects. So with customer benchmarking, you are just looking at what the customer wants from you or what the customer expects, right? So a company can compare what the customer wants with what the company actually provides, and the gaps can be identified and satisfied. Then we have strategic benchmarks. Okay, so benchmarking is many. Okay, based on the one they give you, you can even use your hit your head around to know what they're asking for. Strategic benchmarking involves comparison of business strategies of various companies. You identify the gaps in yours and that company and try to settle it or try to improve your performance. Then we have functional benchmarking. So this is like competitor benchmarking, but this one involves comparison of your performance of a core business function in the company with the performance of the same function in a successful competitor. So if I'm looking at R&D, how is my R&D function compared to maybe Kaplan in the UK, right? So that is functional benchmarking. I'm comparing my functional department or my functional area against another functional area in a competitor. Then we have project benchmarking, which is called reverse engineering, okay? It's a form of competitor benchmarking, but here we compare an entity's product with products manufactured by its main competitors. Identify the cause, the different concepts, identify the differences in their product, the features, the physical characteristics. Okay, we compare all these things to see how we can use to improve ours. We do it all the time, and that is what we call product benchmarking. Okay, so now you can unmute and tell me how many types of benchmarking have we identified, and give me a brief explanation. You can actually unmute. Anybody, you just put up your hand, I call you, then you unmute and tell me the different kinds of benchmarking. Yes, put up your hand, and let's go to value chain. So we are hitting everything. Quick, so that we can move to the next topic. It's like people are too quiet. Yes, who can say something? What are the types of benchmarking you remember? Yes, put up your hand and talk.
We have process benchmarking, the functional benchmarking, strategic benchmarking.
Okay. Is that all you remember?
We have internal benchmarking.
Internal benchmarking. Customer benchmarking. Competitor benchmarking, right? Okay, that is fine. Okay, so I hope we are all okay.
Benchmarking, strategic benchmarking.
Okay, nice. And you can explain all of them if you are being asked. That is what I want to know.
Yes, sir.
That is all I want. Thank you. Okay. So if you have a question, just put up your hand for me and I'll gladly answer you. Now we go to the value chain analysis. Now, why do we need a value chain analysis as management accountants? The thing is that, you see, as management accountant, we have to know how things move and the various organization departments, also how they coordinate to make sure that we create value, because creating value will help us measure what value has been created, as a performance measure, right? Creating value for the organization means increasing shareholders' wealth. That's the main objective of every organization, right? So we want to know how value is created and how we can measure this against our expected performance, right? So Porter's value chain actually what is the most common what do we call it there? Model that is associated with value creation in a company, okay, that handles physical resources such as your manufacturing or retailing organization. Okay, so based on Porter's value chain, I get to know the value creation models are grouped into two broad activities. That's your primary activities and what supporting activities. Okay, so we are saying that every organization has processes it does which brings products to the final consumer. And in exam, sometimes ICA can ask you to draw this value chain, okay? So we must know how to draw this. Okay, so inbound logistics, operations, outbound logistics, sales and marketing, and after sales service. So let me just put it here like this. So in exam, just be prepared to draw this because most of the time they can ask you to draw it. Okay, so write like this. Lots of space. Oh, which document have I there? What happened? Unfortunately, I've gone to close it all. Okay. So, oh, why is this thing moving? So let's say it looks like this, right? Then we have margin here. Margin is the value that you are giving the customer, right? Margin. Okay. So this is it. So in exam, draw it well because I'm using a pen on the computer. That's why. So we have what the supporting or secondary activities, right? That support the primary activities. So we have what firm infrastructure. You need a good infrastructure to operate, right? Then once you get a good infrastructure, what you need is human resource management, right? You need people to work after infrastructure, right? Human resource management. Okay. Once you are able to get people to work within the organization, you need good technology, right? To start working, right? Then once you institute your technology, you now need to buy raw materials to work. So you need procurement, right? So this is how the secondary activities fit into the value chain. Now, the primary activities, which are found below, these are supporting activities. The primary activities are the things the company actually does to what? Establish or create value, okay? Now, these primary activities, every organization needs to buy raw material and store them, right? So we have inbound logistics, which is the buying of raw materials and storing them for production. Now, from there, it moves into operation, which is the actual production, right? And here it depends on the effectiveness of your production system. Are you capital intensive? Are you labor intensive? We are trying to build efficiency, right? The more efficient you are, the more margin of value you can create. So this value is the margin that comes out at the end, right? Then from there, the goods are produced, right? They'll be packaged and delivered to the customer. That's your outbound logistics, packaging and delivery to the customer. Then finally, that sales and marketing happens, right? Sales and marketing, that's where you sell and take your money. Then some products after sales, also, you can still give after sales service, right? What does that happen? You buy a decoder, you see they send somebody to go and fix it for you. This is after sales service. So all these things must work hand in hand. You see there's coordination, there's synergy among the various departments. Now, if you have a good procurement manager, he can negotiate better prices with the supplier, right? Bringing you what? Favorable variances. True or false? Won't this bring you favorable variances? Yes, because this will bring you a favorable variance, that means it's bringing you a good margin. So you are looking at effectiveness of your systems using what? Being able to beat down labor rate, and also using effective materials or reducing material wastage. All these things can help in what? Bringing favorable variances to you. I'm talking like a management accountant, right? Favorable variances to you because your operating systems are favorable. Outbound logistics, reducing cost of packaging, quality inspection. All these things can help you, right? Make more profit at the end because you are controlling costs within your value chain process, right? So we are saying that these activities must work hand in hand to ensure that the greatest value is given to the customer at the end of the day. So in exam, what are they going to ask you? They'll ask you to explain the value chain and its advantages, right? So you know it is to create value. It can help you even identify areas which are non-core areas of the business that need to be outsourced, right? It can help us to identify gaps in performance to know how we can improve and know how various functional heads are also performing, and also ensure coordination and synergy amongst various departments. So that is the value chain for you. You must know the various activities. So we have secondary or supporting activities, firm infrastructure, human resource management, technology, procurement. I get in it. Then we have primary activities, inbound logistics, operations, outbound logistics, sales and marketing, and after sales service. Okay, so just know about that. That is the value chain. Okay, because we have a lot to do. That's why I'm in a rush. I'm just giving you the idea so that you can write something about it, right? So that is it. The next area I want to talk about possibly is business process re-engineering. When we talk about business process re-engineering, what does it mean? Business process reengineering is an approach to improve business operations and processes by redesigning them extensively. Okay, so the change introduced by business process reengineering are major changes, okay, completely altering the way the processes were carried out before. So a complete redesign or overhaul of your activity to change it, I get in it, is business business process reengineering. Now, by Hammer and Champy, it is defined as the fundamental rethinking and rational redesign of your business processes to achieve dramatic improvement in critical contemporary measures of performance, such as your cost, quality, speed, and service delivery. So we are saying that when it comes to business process reengineering, you are taking an operation and radically redesigning the way it is carried out. You are changing the way it used to be done. For example, handling customers' orders from taking an order to delivery to the customer can be changed completely. Before it was manual, now we can send it online, right? Where customers can do everything online. This is business process reengineering. Requisitioning of materials and purchasing systems may be done manually. Now we go online to do it, right? Quality control process may be changed. Are we okay? That's business process reengineering. So what are the principles in business process reengineering? There must be total rethinking of your business process. Work should be organized around the natural flow of information. Work should be organized around what the processes produce, not around the tasks that go into it. It is the processes and what they produce and not the tax itself, right? So at the end of the day, how can we streamline this to ensure that we get good customer value? So the objective of BPR program is to achieve sustainable or substantial improvement in performance by redesigning the process. That's why there are models of evaluation. We want to change these things. You see, things have moved from the past where we were just looking at, okay, how to just improve performance. But here, we see how to just measure performance. But here, we are not just measuring performance. We are looking at how we can improve our performance by changing our systems, right? By changing things we do in our system. Are we okay? So a BPR exercise seeks to transform the way in which the process is performed with the aim of performing it better, more effectively, efficient, and economically, right? In a BPR exercise, the investigator or the management consultant will look at all the activities that are involved in performing the process under what? Review. They might consider why each activity is performed and what value it provides, right? Having investigating the existing process, the investigators will now consider whether it can be radically redesigned so as to achieve the same result, but far more cheaply and efficiently, or more usually, not so, and whether it can be radically redesigned to achieve better results, perhaps more cheaply and efficiently. So these are the things that you would be looking at, right? So when they come, they will ask you what are the importance of business process reengineering? What is it, right? How is it important? You must be able to talk about it. The next area I want to talk about is just-in-time systems. In simple terms, just-in-time system is used by the Japanese where they try to minimize stock as possible, right? We do not want to keep so much stock. So no stock is just-in-time system because stock can get damaged, stock can get spoiled. Sometimes there are costs that come with holding stock, right? So just-in-time means, okay, it is either you produce just-in-time to give to the customer, or you buy just in time for production. So we have just in time production and just in time purchasing. What it means is that if right now I want to produce, I must buy the exact raw materials that I want to put into production, right? And the exact goods that the customer needs, because I do not keep stock. And remember that not keeping stock also has its own disadvantages, right? Because if I don't keep stock, unexpected demands that come, I cannot settle them, right? So just-in-time system was developed by the Japanese, and it is radically different approach to inventory management compare with the management using the normal EOQ models and reorder levels. The principle is that producing for inventory is wasteful because inventory has no value and holding inventory is therefore expensive. For which there's no profit because you have to keep this stock, which comes at extra holding cost, right? These are the things we are talking about. If there's no immediate demand for output for any given system, a production system should not produce finished goods output for holding as inventory. No, we should produce just in time to settle the demand that we know, right? And that means demand must be what? Certain. Are we okay? Now, one thing is that when it comes to just in time, I told you we can have to just in time purchasing and just in time production. So it is important that items should be made when required. That is just in time production. Finished goods must be available when the customer orders them, and raw materials and components must be supplied when they are needed for production. And therefore, this means that production times must be very fast. If there's no inventory of finished goods, production has to be fast in order to meet new customer demands quickly. And production must be reliable, and there must be no holdups. I get stoppages or bottlenecks. Poor quality production leading to rejected items and scrap is unacceptable. And deliveries from what? Suppliers must be reliable. So suppliers must deliver quickly, and purchased materials and components must be of high quality. But remember that not keeping stock also has its detriment, right? For instance, you cannot meet unexpected demand. Assuming they are bulk discounts, you cannot enjoy them, right? And also holding when there are changes in prices in the future, you are still not going to benefit, right? It has its own, and some stock must be stored to mature. If you are dealing with such stock, you may have a problem. So just-in-time purchasing is when I purchase raw materials that I need for production, right? I buy raw materials that I need actually for production. So just-in-time depends for its success not only on the high efficient and high quality production, but also on the efficient and reliable supply arrangement with your key suppliers. So if your suppliers are not dependable, they are not reliable, then you cannot use just-in-time purchasing, because assuming I need to produce 5,000 units and I want raw materials, can this guy give me the raw materials just in time for production? If he cannot, I cannot operate the system because I will lose. Because what if I need them? The customer needs it tomorrow. I need the royalties, the raw materials to produce today. If I do not get it today, the customer cannot get it tomorrow. So there are two types of just-in-time. So they can ask you the limitations of what? Just-in-time system, right? So zero inventory cannot be achieved in some industries. I told you, you cannot get bulk purchase discounts. Some inventory must be stored to mature. Not so. Sometimes the supplier lead times, he cannot follow, which is a problem for us, right? Okay. So the EOQ model, which we normally use, succeeds in minimizing total cost by striking a balance between holding and ordering costs. But if you are using a just-in-time system, ordering costs may be very high because you are actually ordering all the time when you need goods. How do we eliminate waste? This is a typical management accounting system, right? Cost control. How do we eliminate waste using just-in-time? I get it. So waste is any activity that does not add value. Okay. So in Toyota car manufacturing system in Japan, where just-in-time originated, there are several causes of waste were identified, like overproduction, waiting time, transport or movement of materials, factory and plant layouts, waste in the process, inventory, motion, and defective goods, right? All these things were some of the reasons why they brought just-in-time. So they can ask you, just-in-time techniques. We can have workflow and the layout of your factory machines, reducing your setup time, production or total productive maintenance, right? To prevent breakdowns in equipment and those things. Are you getting it? You always make sure your machines are in check, because since you are producing just in time for your customers, if the machine breaks down, you have a problem. Then we have Kanban systems and visibility in the workplace. So to improve your production flow and to avoid production of items that are not yet wanted, there should be clear signs in the workplace that indicate when more production is required, right? So that you can meet the expected demand. Are we okay? So these are this. So the last thing I am going to talk about is quality and quality management together with continuous improvement. Now, when we talk about quality management, but let me talk about total quality management. We are talking about what? Total, zero defect philosophy when it comes to quality, ensuring that quality is achieved at every level of the organization. That's total quality management in simple terms. And that everything meets quality. Everybody is completely involved, right? So success in business depends on the extent to which the needs of the customer is satisfied. An essential part of meeting customers' requirements is to provide the quality that customers want. Quality is therefore an important part of product design and marketing. The pursuit of quality by an organization can cover many aspects of performance. So quality is often associated with the design of feature of a product or service. Product quality is also assessed in relation to price. Also, quality It's also concerned with the quality of processes and what? Operations, right? Remember, high quality processes will deliver products to customers more efficiently and at a lower cost. And quality and operations could also mean producing and delivering goods to customers that are free from errors and faults to meet their design specifications exactly. So quality is different for different people, right? Another area you look at is quality control, which is a method of managing the quality of products, service, and systems and processes. The purpose of quality control is to ensure that actual quality conforms to large or standard level of quality that we have set, right? We want to achieve some particular target of quality. How do we achieve it? We can measure actual quality and compare this with the target. We can report quality performance to the managers responsible. We can require managers to take corrective measures when quality fails to meet the target or standard, right? So quality can be measured in a variety of ways, including the number of items rejected in the manufacturing process or inspection or testing, or the number of customers who give complaints, right? So quality control is concerned with maintaining quality at a target or standard level rather than improving quality standards. And this involves procedures for checking and inspecting body materials and components and output for production, some form of statistical quality control, okay? So you remember that earlier on, I told you that we have some non-financial factors, right, that we can put in the balance scorecard. This is quality is internal business process, right? So this quality we are doing, it forms part of internal business process, right? So if you are measuring quality, you can measure quality like the performance measures or the KPIs, maybe the percentage rates of defective items, the average number of faults, the number of customer complaints, customer satisfaction ratings, the number of costs of warranty claims, average times between failures or breakdowns in the process. You could measure things like speed, the lead time for processing orders, throughput cycle time, that's your production cycle time, actual throughput time compared with your budgeted throughput time, okay? Then dependability, the percentage of customer orders that are met from inventory, the percentage of items that are delivered late, flexibility, your range of products, your new product development time. You can talk about cost. How do you measure your actual cost versus your expected cost per operating hour or per machine hour, labor productivity, and added value? So there are a lot of things around quality, but what I'm concerned about is quality-related cost, right? So in the exam, this is where most of your questions will be focused on. So remember that we have two main types of costs when it comes to quality. The cost of what? Conforming to quality and not conforming to quality. So conforming to quality is like prevention is better than cure, right? So you know that, okay, this thing can happen. So why don't you prevent it from happening? So those are conformance costs. Okay, non-conformance cost means that, so one is proactive, which is the conformance cost, and one is reactive. The thing must happen before you solve it. That is not conforming to quality. So conformance cost is incurred to maintain the required quality standard and to prevent poor quality. So this one, we prevent it from happening, right? Or make sure it is maintained, okay? Or detect poor quality items when they occur. That's cost of control. Whereas non-conformance cost is incurred to correct the problem when poor quality does occur, like the cost of failure. So one is proactive and one is reactive. I hope that is okay. Now, when we want to break this conformance cost into the various quality costs, right? So there are what? There are two main types. We have the conformance costs, which are things like appraisal cost and then preventive cost. Then for the non-conformance cost, we have internal failure cost and external failure cost. Are we okay? So we are saying that the total cost of quality includes these four main types of costs. So appraisal cost, these are costs incurred to detect defective items before they are delivered to the customer and to deal with faults or defects that are discovered, okay? So these costs are normally associated with things like inspection of sample of items, but also includes the cost of quality testing, quality audits. Appraisal costs are incurred after items have been supplied or produced or during the process of production, right? Defective items that occur during production are either scrapped or reworked to eliminate that defect, okay? So 3 is what? Preventive costs. Preventive costs are the cost of action to prevent defects, okay, or reduce the number of defects. These are costs incurred to prevent a quality problem from arising. So prevention costs are costs incurred in order to what? Reduce appraisal costs and the cost of quality failures, okay? So you are preventing the thing from happening by preventing or reducing defects and failures produced by the process and to reduce the need to spend money on inspections and testing for quality failures. So internal failure costs, these are costs incurred when products are defective because they do not conform. So things that went wrong within the organization are internal failure costs because the problem started from there, but are discovered before the product is delivered. So any mistake you make before the product is delivered is an internal failure cost. And there are failures that would have otherwise led to the external customer being dissatisfied, okay, if they have been delivered. So there was a mineral company that a cockroach fell inside before they saw it before it went out, meaning that's an internal failure cost. They have to rectify this or change it or prevent it from happening the next time, right? So the external failure cost is when the thing has got to the customer already. Okay, so as the thing has got to the customer, like rework cost, the customer has to bring it back for you to work on it. And also like warranty cost, or maybe reimbursements to the customer when something has happened to him, maybe by consuming your products. These are our external failure costs, right? So this includes the cost of correcting the failure and costs associated with the loss of reputation. So the total cost of quality include what? The conformance and non-conformance cost. So appraisal and preventive cost being cost of conformance, plus the internal and external failure cost being what? Non-conformance cost. The two should give you a total quality cost. So how can this be implemented in a full question, right? That is what you have to be able to deal with. So we have a question here. You can see, right? Let's see if we can play around with this and see if we can actually get the total cost of quality. So with this said, who can give us an idea? Who can give us an idea as to how to deal with this kind of question? Can you see? Can you see how we can deal with this kind of question? Are we okay? So how do you go about it? And let's see. It says BOA is a car manufacturer. It has a relatively new company and the directors are keen to establish a reputation for high quality. The management of BOA recognizes the need to establish a culture of total quality management at the company. The management accounting team has collected the following information for the most recent quarter in the current year. So we have cost data, right? Customer support center cost per hour being 58. We have equipment testing cost per hour being 30, manufacturing rework cost per the car. Now, so we have warranty repair cost per car. Then we have some volume and activity data, right? Okay. So before you even look at the volume and activity data, first of all, you must ask yourself, what kind of cost is it? Customer support center. What kind of cost is this? Equipment testing. What kind of cost is this? Manufacturing rework. What kind of cost is this? Warranty repair. What kind of cost is this? Yes, I'm waiting. You can put up your hand. Yes, let's see which ones we can identify. Quick. Yes, please. Yes, I'm waiting on. We know the kind of cost, the sum of all the costs. We have preventive cost, we have appraisal cost, we have internal failure cost, we have external failure cost, right? Remember, we know the sum of all this gives us our total quality cost. Yes?
Yes, sir.
Yes, boss.
Yeah, manufacturing rework, that should be external cost.
External. Yes, Paul. Paul, your hand is up.
Warranty
Customer appraisal cost. The first one, the customer support center is appraisal.
Appraisal. Okay. Then warranty repair cost.
It's external.
External. Internal failure warranty is external. Yeah.
Okay, external. Then equipment testing.
Internal.
Equipment testing. It's appraisal.
Internal failure.
Oh, you are testing equipment. It's appraisal, right? It's appraisal. Check. Oh, your hand is up again. You are testing equipment. Is it not appraisal?
Hello, sir.
Yes.
I'm thinking it's preventive.
Preventive costs. Okay.
Yes.
Why?
because you test the equipment to prevent it from producing probably materials that you can't supply to your customers.
Okay, I think that is a good initiative. Yes, Paul, your hand is still up. I don't know whether it's a wrong hand raising. Are we okay? Okay. So when we go in there, it tells us that BOA undertook research and training during the quarter at a cost of 60,000. What is this? It is preventive, right? Do you all agree? This is preventive cost. True or false?
True.
Okay. We want to do research, we want to train ourselves to prevent this from happening. And due to quality issues in the quarter, the car production line experienced periods of unproductive downtime with cost of 375. So what is this? This is internal failure, right? Also, do you all agree? Do you all agree?
Yes, sir.
Yes, sir.
Because it happened within the organization. So in that case, let's put the cost together. Yes, we want to group the conformance cost and the non-conformance cost. So he says we should find the conformance cost of quality. So conformance cost, what and what do we need? So first of all, preventive cost. Preventive cost, what and what did we need? Preventive cost. Preventive cost, we had what there? Training and research, right? Training and research cost how much? Please, you can dictate the cost for me. Training and research.
60,000.
60,000.
Okay. Was there any other preventive costs?
No, sir.
No, sir. Okay. The equipment testing, anyway, it could be put here, but equipment testing is like quality check, right? We are checking whether the equipment is quality because the equipment will be used to make the car, right? Or the equipment may be in the car. So it's more of appraisal. As you are producing, you are checking, right? So when we go to
Okay.
appraisal cost, what was there? Let's check and see. Appraisal cost. Equipment
testing 30.
So 30 per hour. It said 30 per hour. How many hours would they use? This was 30 per hour. How many hours were used in testing equipment? Production line equipment testing time, 400 hours, right?
100.
So when we multiply, what do we get? 30 by 400. That's 12,000 also.
12,000 out.
So was there any other cost?
And appraisal, no.
And appraisal, there was no appraisal cost. Okay, so let's go to non-conformance cost. So non-conformance cost, let's start with internal failure. Internal failure cost. No, there was another cost under appraisal, customer support center.
Isn't that one like external?
Yes,
Okay.
Prof. I think it should be external.
External, yes. It depends on how you look at it though, but they put it under external. And the exam, don't think plenty, right? So far as it will add up, just put it there. Because at the end of the day, it will be correct. So let's see. So we have what? Internal failure cost. There was production downtime. Do you remember? Unproductive
Yes, sir.
downtime. How much was it?
375,000.
Productive downtime. 5,000. Okay. So that is what we had. Then what else did we have? They said we had manufacturing rework cost. That's external, right? Warranty repair, external. Not so.
Yes, sir.
So external failure. So external failure cost. What did we have? We have customer support center. But this customer support center still, anyway, let's continue. So 58, it says 58 per hour, right? How many hours did we use for customer support center? 500 hours, not so.
Yes, sir.
So 58 by 500, that's how much? That's 29,000, not so. Okay, then we had what? Warranty repair, right?
Yes, sir.
Don't you think if I have customer support center, is it not going to support customers?
Hello, Prof.
Yes, boss.
Yes.
So my take on that is that I believe if you should do your internal works very well, you wouldn't incur customer support. Customer
It's
support
so
will come in.
it should be appraisal.
No, I think
Customer
it should be
support.
external because if you do your internal works very well, there wouldn't be a need to even incur that cost.
But what if we
That
put
cost will only be incurred.
I understand you, but what if we also do this support center just to know what customers want so that we can satisfy them? What about that one?
That could be gotten in the research. When we were incurring research costs, I believe that could take care of them.
No, what if
And
the customer support is also like the secondary activity too?
Yeah, something like an after sales service, eh?
Yes, after sales service,
Complaints
yes.
and stuff.
Then it becomes an appraisal.
You have manufactured and you have sold to the customer and now give you assistance. So
Okay.
it means that
Yeah.
Don't think plenty. You still add
DSTV will still make somebody come and do the thing for you and still call you while the thing is off.
okay. It's so good. So in that case, warranty repair, how much was it? It was per car, right? 2.6 per car. How many cost? How many cars came back for warranty? So 2,600. How many cars came back for warranty? 650 cars, right?
650.
So 650 cars
Yes,
came back.
sir.
So 2,600 by 650 cars. That's wow. The cost is huge.
1,690,000.
Yes, 1,690,000. Then we had what? I think we had manufacturing rework costs, right? Manufacturing rework cost. How many costs had to be reworked? Manufacturing rework is actually internal. Anyway, let's continue. That one, how many cars came? 800 cars, right? But how many cars came back for rework? The cost was what? 380, right? Do you all agree? So 800 cars by 380, that's 304,000, right? Okay, so what's our total quality cost? Yes, total quality cost, let's add up from the top. We have 60,000 plus 12,000 plus 375,000 plus 29,000, right? 29,000 plus 1,690,000 plus 304,000, right? And that gives us what?
470,000.
Right? Okay, so that is it. So when it comes to quality cost, I hope we are all okay. Okay. I hope we are all okay. So with that being said, I think the models of evaluation, I think we've exhausted a major part of it, right? The next area that I would want to talk about is activity-based costing. Now we are going to the modern costing techniques, activity-based costing. Now for ABC moves with traditional costing, right? Remember, ABC and traditional costing go together. It's a costing system based on what? Activity. And the whole thing about ABC is that when it comes to ABC, what you are doing is that you get OAR for each separate activity, which in traditional costing systems, it doesn't work like that. Okay, so we are going to take this question and use traditional costing to absorb overheads and also use what? The ABC approach to what? Absorb overheads. So using ABC, we first use traditional costing. Traditional costing means you are using OAR, right? Which is absorption cost. And in the exam, they can ask you the difference between what? Traditional costing, which is absorption costing, versus what? ABC, right? So definitely you are looking at the weaknesses of what? Absorption costing compared to ABC. ABC is used for modern costing decisions, right? Because of modern environment, and absorption costing was in the past, which uses an arbitrary basis to absorb overheads, which is not always the case because now in modern costing environment, overheads constitute a larger part of your what? Your production cost, right? So it is better to use what? ABC, because ABC looks at what influences each cost. So that's the distinguishing factor. Are we okay? So remember this. So using this question, using the production, what do we call it? The traditional costing approach, right? we want to get the overheads, right? So what we are going to do is, first of all, let's determine what we are going to use to absorb. He said, well, calculate the production overheads to be absorbed by 1 unit of each product using the following costing methods. The first says we should use what? A direct labor hour to absorb overheads. So using direct labor hours, it means that we are going to use what? Traditional means we use overhead absorption rate. And what is our OAR? Note, management accounting formulas carry marks. Sometimes you can get marks very high as 3 marks for just putting down a formula. Okay, sometimes even 5 marks. So please, the formula is very important, okay? So always write formulas. Don't go straight to calculation. Don't ever do that if you want to score management accounting. So in that case, we are saying that this is what? Our total what? Budgeted what? Overheads, not so. Over what? Our total what? Total budgeted labor hours, right? Yeah, the question is activity basis or level of activity, but they said we should use labor hours. Most of the time it will be labor machine hours based on the question. So since they've given us labor hours, now let's go and determine the total budgeted overhead. So what's our total budgeted overhead per the question? Total budgeted overhead per the question was what? Total budgeted overheads.
We have 285,000.
So it gave us 285,000, right? So we've got this. Now the next thing is to get our total what? Budgeted what? Labor hours, not so. Total budgeted labor hours. So getting our total budgeted labor hours, first of all, let's look for labor hours. Now, when you look in the question, the direct labor hours given was per unit. Okay, meaning this is for just 1 unit. This is also for 1 unit, but we want for all the number of units, right? And the number of units produced were 5,000 and 7,000. So always check this. This is one of the reasons why people fail, not able to attribute units to what? Quantity per unit. So in that case, we want what? Labor hours, right? We know that for product L, how many units were produced? 5,000 units, not so. But how many hours were used? We use 1 hour, right? Per unit, not so. So 1 hour per unit for all the units to be what? 5,000 hours. Do we all agree? Then for product M, we were using what? 2 hours per unit. But how many units did we produce? 7,000, right? Do you all agree? Do we all agree?
Yes, please.
Yes, sir.
So that's 14,000 hours. So if we put it together, what do we get then? We get 19,000 what? Labor hours overall, right? So these are total labor hours. So you see here, all these costs are different costs, but we put them together and absorb all using labor hours, which is not the best way, right? Because there are some costs that are influenced by other things. That's where ABC comes in. So here was our overhead absorption rate. It's going to be what? 285,000, not so, divided by what? 19,000 what? Labor hours. Do you all agree? And that gives us what? As our overhead absorption rate. So 285,000 divided by 19,000. Who is that?
50.
Somebody's background. What do we get?
15.
15 cedis per labor hour, not so. Okay, so we have this. Now that we have this, we are now going to establish our cost per unit, right? Our overhead cost. So in that case, since we didn't have material and labor, it's still the same thing, right? We have product L and product M, right? We need to get our costs. And me, I prefer you always work in total before you come and get the per unit. If you work in total, it makes everything easier. I see people working in per unit, which can take a lot of time. Just work in total. So our overhead, I'm just going to say what? My production overhead, right? And then I bring my product. So I have product L with overhead cost of 15 cedis per hour, right? But how many labor hours were used? Total labor hours. I don't want per unit. Total labor hours. So I must go to the question where I calculated my labor hour and go and check. So I use 5,000 labor hours and here I use 14,000, right? So this becomes 15 per hour times what? The 5,000 hours. Do you all agree? And then for M, I use what? It's 15 cedis per hour, but I use what? 14,000 hours, right? So this can give us our overhead cost for each of these products. Okay, so let's multiply and let's see. So we have 15 by 5,000. And that's 75,000 cedis, right? For this guy. And then we have 15 by 14,000 for this guy, making 210,000. And truly, when you add 210 plus 75 is 285. So we have actually allocated the overhead cost for this product, right? But what if I want the cost per unit? I get in it for each of them. Then I must take this guy L and divide this 75,000 by the 5,000 units that we produce, right? You see the style? Then for M2, I do the same thing, right? I take my what? 210,000 and just divide by what? The number of units that were produced. And that was what? 7,000 units. Okay, so what's the cost per unit? This one is 75,000 divided by what? 5,000 units. That means it's 15 also. 15 per unit. And this guy, 210,000 divided by what?
30.
7,000. That means this one is what? 30 per unit. So assuming they gave you labor, material, and the rest, you are going to fill them in just like that, right? When you finish and you get the total cost, just divide them by the what? The number of units, and then you get the cost per unit. I hope that is okay. So that is traditional absorption costing. Now let's go to activity-based costing. Now with ABC, you need OAR for each activity. What did I say? You need OAR for what?
Each activity.
Each activity. That's how you do for what? Activity-based costing. Okay, so for activity-based costing, our OAR, which is actually a cost driver rate, but it's still an overhead absorption rate. What we do is that we take the total cost in the cost pool. Okay, so total cost in cost pool. Okay, and divide by the total number of cost drivers, right? So over the total number of cost what? Drivers, the total number of cost drivers. So with this being said, you do it for each activity. That's how it works, because each activity and what drives that cost, right? So what you are going to say is that, okay, for each cost of activity, let's see the cost that we had. We have cost relating to machine activity. We have cost relating to production setups. We have cost relating to handling of orders, right? So each of these ones are influenced by something. So you now have to go and check the question for the suitable cost drivers. So if we go up the question, you realize that related to machine activity, what should be the appropriate cost drivers based on all the quantities we have here? What should be the appropriate driver to machine activity?
Machine hour per unit.
Machine hour
Machine
per
hour
unit.
per unit. It ends in per unit, meaning we must multiply by the number of units, right? But the rest, do you see any per unit there? No, meaning those ones are already in total terms, right? That's how you go about it. So let's try machine activity cost, OAR, right? So machine activity cost, OAR, what becomes the formula for the OAR? It becomes total machine what? Total machine activity what? Cost, not so. All over what? Total machine what? Total number of machine hours. You get it? So it has its own formula. Can you see? And this one, they mark it for you. Don't just jump into the calculation. Give us the formula. So total machine activity cost over total machine hours. So machine activity cost, now saying, how much was it?
220,000.
So the total is 220,000, right? Which we have. Now we need the total machine hours, right? So let's get the total machine hours. Total machine hours. So let's get our total machine hours, yes? Total machine hours for product L. We know how many machine hours were we using. We're using 3 hours, not so. But how many units were we producing? 5,000 hours. Do you all agree? We're using 5,000 units, sorry. So 3,5, it means we are using 15,000 what? Machine hours, not so. Then
Yes,
for
sir.
M, we were using how many hours? 1 hour. But how many units were being produced? 7,000 what? Units. That means you have what? 7,000 machine hours, right? So at the end of the day, when we add it together, what is our total machine hours? 22,000 machine hours, right? So OAR for machine hours now become what? Machine activity, OAR. That is what? 220,000, not so, divided by what? 22,000 what? Machine hours, not so. Not so. So that gives us what?
10.
So that means it's 10
10
cedis
per
per
unit.
machine
10
cedis per
machine
machine hour. Are we okay? So now we are done with that one. What's the next OAR in question? The next was relating to setup cost, right? So let's get our OAR for setup cost. So what does the formula become? It becomes what? Our total what? Setup costs, also all over what? The total what? Number of setups. Now you see some students go and make a mistake here. Why? Because they are going to now go and multiply the setup by the number of units. Is it wrong or is correct?
It's wrong.
It's wrong.
Why?
Because in
Because
total.
setup, yes, setup never said setup per unit. Unless it ends
Yeah.
in per unit, don't assume it's per unit. Do you get it? So I hope that is okay.
Yes,
So
sir.
what is total
Yes,
setup? Total setup cost, how much was it? It was 20,000 also.
20,000.
So 20,000. Then we need the total number of setups, right? Always do working for
50.
this market. So let's add up. So setup cost, we had what?
10
10
plus
10.
10
40.
plus 4.
making 50 setups, right? Okay. So in that case, what's our OAR for setup? So that's 20,000
0.4.
divided by 50 setups, right? And that's how much? 400, right? That's
Yes, sir.
400
400.
per setup.
Yeah, 400.
So you just put this down. And this is where all the marks are. Okay. What is left? Handling of orders, right? Order handling costs. So let's go to OAR for order handling. So order cost, right? Because of time, that's why I'm saying I'm shortening them. So order cost, what does the formula become? Somebody should give me the formula for the OAR. Total
Handling,
handling cost.
order handling cost over total
orders handled.
or total number of orders handled. Yeah. Are we okay? So first of all, what's the total order cost or total ordering cost?
45,000.
45,000.
5,000. Okay. So total number of orders.
That's 75.
75.
So we have to add, right? Show working. So 15 plus what? 16 also. And that's 75 orders. Okay. So we have this. So in that case, OAR for orders become what?
600.
That's 45,000 divided by what? 75 orders, right?
200.
And how much did you get? 600.
Yes, sir.
So 600 cedis per what? Per order handled,
Per
right?
order handled.
Okay. So now that we are done, you see that's the distinguishing factor between what? The activity-based costing and then what? The traditional costing. Here, the overhead cost that we are going to get, you see that it is what? It is different, right? So we break it down into its various components. So overheads, right? So we have L and M. If you have material, you would have calculated the material the same way. You would have brought the total materials. If I had labor, right, I would also bring the labor cost. So then that gives me what? My prime cost. You get it? So most questions are going to give you all this. You're just going to put them there by calculating, right? Just get the totals. When you finish, then you come to production what? Overheads. And that's where this question only gave us, only the overhead part. So now the overhead will be broken down, right? So the first will be machine activity. So machine activity, what was the overhead? We calculated it, right? For product M, machine activity was how much? Let's go and pick machine activity. It was 10 cedis per what? Per hour, right? But how many hours were actually used in total? We calculated it. Total machine hours 15 and 7, right? I hope that is okay. Understood? So always go for the totals because we are working everything in total. So this was 10 cedis per machine hour, right? Let me make it MH. So 10 cedis per machine hour. By how many machine hours was used? This guy used 15,000 machine hours, right? And M was also 10 cedis per what? Machine hour. But how many machine hours were used here?
7,000.
7,000, right? So that means this one will end up with 150,000. And this guy will end up with what? 70,000 also. Which when you add it to, you still get back the 2,000 for what? 220 for machine hour, right? To machine activity. The next was setup cost also. So setup costs, what was the OAR? So L and M. The OAR for setup cost was 400 per setup, my boy. Was 400 per setup, no be so?
Be so.
Okay,
Yes.
400 per setup. So now we have to multiply by the number of setups. This guy had what? 10 setups, not so?
10, 4,000.
This guy had what? 40 setups, right? Okay. So when we multiply, what do we get? This guy gets 4,000 CDs, and the other guy gets what?
And
Is this
16,000.
16,000 CDs. Okay. Now we are left with what? So no matter the number of activities, do OAR for all of them. So here we have order handling, right? Order handling. You have L taking what? Order handling, we had 600 per order. Do you remember? Do you remember?
Yes, sir. 600.
600
Yes.
per order. How many orders were handled? This guy
L
had
had 15.
15.
orders, and this guy had 60 orders.
15, 50.
So we multiply. That's 600 by 15. That's 9,000 CDs here. And the other guy 600 by 60. That's 36,000, right? Okay.
1,000.
So now let's get the total cost. So what's the total cost? So that's how you go about it. You see, people are always running away from ABC, but I hope it's very simple. I hope I've simplified it for you.
Yes, sir.
ABC is not difficult. This is how you go about it. So you have 163,000 for this guy also, and then you have 70,000 plus 16,000 plus 36,000, right? So that gives us 122,000. Okay, so now that you have this, what we have to do, we need a cost per unit. What do we get? So for product L, it becomes what? 163,000 divided by what? How many units were produced? 5,000 units.
500. 5,000.
So what do we get for the cost per unit? And then M, we have what? 122,000 divided by the cost per unit. And the number of units, 7,000 units. Also. Okay, so
And 32.6.
32 CDs, 60 pesos per unit.
Yes.
And
Yes,
the
sir.
other one, 122 divided by 7,000. 17.42
Yes, sir.
or 43 per unit. Okay, so that is it. Okay, so ABC is gone. Now we move to throughput accounting. Any question? Any question? Please, you can ask your questions before we move. You can ask your questions before we move. I'm just waiting for your questions. So. Yes, I'm just waiting for your questions. So yes. Oh, ask questions. Oh. Uh-huh. Have we looked at just in time?
Yes,
Have we
sir.
looked
Let's
at
move
just in
forward.
time?
Let's move forward.
Yes, sir.
Hello.
Yes, yes, boss.
And so I wanted to ask that if, assuming that it was given a percentage, that one, how will we go about it? For
Or if
example,
you were given a percentage, like for the cost. Oh, you just split the costs.
okay.
Are you talking about a percentage for the cost drivers or a percentage for the cost itself?
The cost drivers.
So that means that they are telling you that this cost, this percentage is, so this is what it means. So let's say that they gave you something like production runs, right? Production run cost. And they are telling you production run cost, right? You have maybe product L, 30%, product M, 70%, right? So that means if you add the two, you get what, 100%. Is that also? So all you are doing is that the cost that you have been given, this 30,000, you are just splitting it, right? So the overhead cost now, if you want to do the OAR, I get it. If you are doing the OAR now, the one for what? L will now become what? 30 out of 100 times what? The 30,000, right? To now give me
Okay.
the cost, and then 70 out of 100 times what? The 30,000, right? Giving me this one's
Yes.
cost. That's what will go under overheads. Is that simple?
Okay.
Understood.
Thank you.
You're
Yes,
welcome.
sir. Thank you. Yeah.
So when it comes to throughput accounting, now, before we even go to throughput, let's understand the concept of limiting factor or bottleneck resource, right? They are the same thing, but from different perspectives. When we say a bottleneck resource, where does it come from? Let me explain, right? So we are an organization where we make clothes, okay? So let me ask something. So we have cutting, okay, we have cutting department, right? They cut the materials and they can only cut 100 materials, okay? Then from there, it goes to those who are going to do finishing. Let's say finishing can only finish 50 materials, right? Then we have what? Packaging. Let's say packaging can only package, let's say 10 materials at a time. Now, which of these processes is slowing down the whole production process? Which of these departments is slowing down the whole process?
Packaging.
Packaging, right? Because even if I cut 100 materials, packaging can only package 10, meaning packaging has limited all of them to 10. Because if I cut 100 and this guy can only do 50, what about the rest of the 100? It's waste, right? Because they cannot finish it. If I finish 50, these people can only what? Only package 10. What about the 40 left? So this guy becomes the bottleneck resource. I hope that makes sense. I hope that makes sense to everyone.
Could you take that again, sir?
No, we are saying which one is the production, which one is slowing down production?
Okay.
Which one? Look at it carefully. This one can do 100. If I do 100, at the end of the day, this guy is the final process. Can all 100 go to packaging?
No.
How many can go? 10. What about the
Only
rest?
10.
So packaging
Okay.
goes to finishing. And finishing can only do 50, meaning we can only give this guy 50, right? What about the rest of the 50? So the one that is the bottleneck becomes what? Packaging, because packaging is the one slowing down the whole process.
Okay, sir.
Does that
Okay.
make sense?
Yes, sir.
So which one becomes the bottleneck? It becomes the
That's the
packaging.
packaging.
So you see when you are pouring a bottle, right? Let's say this is a bottle, right? You are pouring a bottle. What happens? You see the water rushes when it's coming, but when it gets here, it slows down, right? So that's the reason why they use the word bottleneck resource. Because the bottleneck is the limiting factor. This bottleneck here, right? It slows down the pouring of the water. But if you cut this bottle, you see the water pours, wow. But because of this, it comes slow, right? That is why we call this bottleneck resource. Makes sense? So the theory
Yes,
of
sir.
is saying that, okay, despite this slowing department, how are you still going to maximize your profit? Okay, let's try a different example. Let's go to the hospital. So this is the outpatient department, the OPD. The OPD can receive, let's say, 200 patients, right? Then from OPD, they go and see the doctor. Okay, so the doctor can only see, let's say, 160 patients during the day. Then from there, they go to, let's say, everybody who comes to the hospital goes to the dispensary or the pharmacy, right? And the pharmacy can only give 60 people medication during the period. So my question is, which one is the bottleneck resource?
The pharmacy.
The pharmacy. Because even if the doctor takes care of 160 people during the day, they can only receive what? 60
people.
Yes, which means then why did I go and see the doctor in the first place? You get the idea. Let's try another one. So we have 3 machines. The product goes through machine 1, goes through machine 2, and then goes through what? Machine 3, right? So let's see. With machine 1, it takes us 9 hours to produce per unit, right? 9 hours per unit to produce. Machine 2 takes 15 hours to produce. Are you getting it? And machine 3 takes only 3 hours to produce. Which one is slowing down the whole process? Which machine becomes a bottleneck?
Machine 3. No. No.
One is efficient.
Machine 2.
You see, I've intentionally tricked you. Here I
Yes,
used
machine 2.
quantity, here I use machine. We are looking at the machine that consumes a lot of hours, right? It takes time for it to produce. It means machine 2 becomes what? The bottleneck. Please, are we all following? If you get this, you are safe when it comes to throughput. A lot of people just go straight into questions, but understand the concept. So we want the bottleneck, which is the limiting factor. the production constraint that is stopping us from achieving our maximum profit, right? So that is what it is. So when you are doing throughput, the difference between throughput and limiting factor is just the material cost. Because you are in a just-in-time system, we do not keep stock, right? So materials become the only variable cost in a just-in-time system. Do you get it? Because all other costs are just incurred to what do we call it? To convert material into finished goods. Do you get it? So they are called factory cost operating expenses. So under marginal costing, which I know everybody here knows marginal costing, right? Marginal costing is limiting factor decision. That's how we call it. Limiting what? Factor decision. And under what? Throughput accounting. Throughput accounting. That means you are doing decision making under throughput, right? Decision under throughput. Okay, so I'll teach you throughput for decision making, and I'll teach you throughput for performance measurement, right? There are 2 questions under throughput that you can be asked. And when you are measuring performance under throughput, you use the throughput accounting ratio. I'll teach you how to do all that. Are we okay? But for now, let's understand this. So under marginal costing, what you do is that the difference between marginal costing and throughput is that marginal costing, your contribution is determined as what? Your sales, not so, minus what? Your variable
material.
cost, right? No, variable cost, marginal cost.
Okay.
Sales minus all variable costs, right? To get our contribution. But when it comes
Yes,
to, I told you that throughput contribution or your throughput return, which is your throughput contribution, what's the difference? Here, material becomes the only variable cost because I told you throughput uses a just-in-time system. Do you remember? So here, the only
Yes,
difference when you are getting contribution is sales minus what?
material.
Material cost. Please get the difference. So sales minus material cost. So if we are getting our profit, okay, let's use profit. So sales minus material cost, then we get what? Our throughput return or throughput contribution. No matter the one you write, they will still give you. So that's our throughput contribution. But here we are going to less what? Fixed cost, right? Remember, sales minus variable cost give you contribution minus fixed cost gives us what? Profit, right? Our operating profit or net profit, okay? So with this being said, now we take out what? Here we cannot take fixed costs. We take out factory costs. And factory costs or operating expenses is what? Our labor plus overhead, right? All these are considered what? Transformed inputs. Okay. Transforming input. They transform material into finished goods. So all the labor and overheads are going to be taken out before we get what? Our net profit. Are you getting it? So that's the only difference. Here, the only variable cost is material. Do not forget. So most questions can tell you that A, use a throughput approach, and B, use marginal costing, right? It means that compare the two, do all, and come up with a decision. Please, are we okay with the differences? Can we go with a question?
Yes, sir. Yes, sir.
Yes, sir.
So what are the steps that I want you to use? The steps that I want you to use is simple. 1, always determine the limiting factor. So the first step is determine the limiting factor, okay? The limiting factor or the bottleneck, right? And the limiting factor may be anything. It may be machine hours or machine utilization, okay? It may be machine hours that is short. It may be what? Material quantity or material kgs, which are limited. It may be labor hours, right? It may be labor hours. It may be anything, but these are the common ones that you see in exam questions, right? As being the limiting factors. So what are you going to do? So the first thing is identify the limiting factor. Always do that to check what is limiting. Then the second step is what? Determine your contribution per unit, right? So as you get your contribution per unit, the next thing is to say, okay, that is the contribution for all the hours that you have. What is the contribution per limiting factor? So contribution for 1 unit of the limiting factor, because we want contribution for each unit, right? So the next thing you do is now what? Rank, and then carry out what? An optimum production plan, okay? So the next is carry out an optimum production what? Plan. And then finally what? You determine your maximum possible profit, okay? Your maximum possible profit. So these are the steps that you follow. And trust me, if you follow this, you are always safe when it comes to what? Throughput or limiting factor. Are we okay? So with that being said, let's take a nice question around that and beat ourselves into it. Want a simple question where we can deal. We can use both methods. Come in. Okay, so we have a simple question here, which says what? We should what? Use these two methods, right? So we can see Pi manufactures two products, A and B, with selling price, materials, labor, other variable costs, and fixed costs and everything, right? But you can see that the only cost we were giving was material hours. Some questions you have material hours and labor, you have to test all of them, okay, and see which one is the limiting factor. But let's check if material hours per unit is the limiting factor, right? So one, what's the first step? Identify what?
The bottleneck resource.
Bottleneck resource or the limiting factor, right? So I'll say testing what? We are testing what? Machine hours, right? So let's test machine hours. So testing machine hours. What is the available machine hours? The question says how many machine hours are available? How many machine hours are available?
48,000.
48,000. We only have 48,000 hours available, right? How much is required for production or needed for production? How many machine hours are needed for production?
For
So
A is
for product A, we need 2 hours, right? But this 2 hours is per
Yes.
unit. How many units are we producing?
20,000.
20,000, right? Which means we need 40,000 hours for production, right? And for product B, how many hours are we using? 1 hour. But how many units are being produced? 10,000 units, right?
10,000.
Meaning we need 50,000 hours. So overall, how many units do we need for production? We need what? 90,000 hours.
10,000. Yeah.
So we need 90,000, but how much is available for production? Only
Hello,
48.
sir.
Yes, please. Hey, 10, sorry.
It's 1,000.
Yes, sorry. It's 10,000. Meaning we need 50,000, right? No, so.
Yeah, 50,000, yes.
Okay. So we need 50,000 hours. So we are saying that we need 50, but we only have 48. Is there a shortage or there's a slack? Slack means unused hours. Is there a shortage?
Shortage.
So if there's a shortage, right, that tells you that what? Machine hours is actually the limiting factor, right? Meaning we are short by 2,000 hours, right? So always, if there are multiple ones, check if there was material. Some questions will tell you available material kg is 36,000 kg. Available labor is what? 26,000 hours. So you test material, test labor, test machine hour. Then you see the one which will give you a shortage is the one which is the limiting factor, right? So now we say therefore, machine what? Machine hours is what? Is the limiting what? Factor. Do you get it? Are we okay? So now that we have identified that this is the bottleneck resource, the next thing is to determine what? Contribution per unit. And here we are using limiting factor before we come and do throughput. So using limiting factor, contribution, let's get our contribution. What's our contribution? That's sales minus variable cost. So for product A and product B, what's our sales or our selling price? Because it was per unit. Selling price was how much? This guy was 25.
For A.
That was 28.
28.
Then our variable cost. Let's get our variable cost. So we had material. How much was material? 8. And then
8
then labor.
5
5.
2. Then other variable cost.
7.
7. And then 2, right? Okay, so let's take all out. Or we can just sum up the variable cost, right? So total variable cost. So that next time when we are doing for throughput, we don't have to come and add this again. 15 plus 8, 12 plus 8, this is 20, right?
20.
24, right? So what's our contribution per unit?
5 and 4.
Yes, 5 and 4.
5 cedis. Okay, now you see, let's be rational and let's understand. They are telling us that for each hour that we produce, right? Look, for each unit that we produce, we use 2 hours. And each unit that we produce here, we use 1 hour. So you cannot say which product is making the more contribution, which product is making more contribution per what we have done. Which product makes the more contribution?
A.
Product A.
No, it's not A. You know why it's not A? Because this 5 cedis came from 2 hours.
Yeah, 2 hours.
And this one
then
used
4
only 1
cedis, yes.
hour. It means that this 5 is just for 1 unit, but 1 unit is not what we are looking. We are looking at which one consumes more. This one uses 2 hours and this one uses 1 hour. Is it making sense? So we are
Yes, sir.
saying compare, we have to put all on an equal pedestal. Does that make sense? So it will be better if we convert all to 1 hour. Then now we can properly compare. That is why you now find something we call what? Contribution per limiting factor. Do you see? You do not just do the processes, you must understand. Say 5 way is for 2 hours, and this 4 is only for 1 hour. So this 4, even for 1 hour, is 4, and for 2 hours is 5. That means this one is doing well. I hope it makes sense. So let's find the contribution for just 1 machine hour. Contribution per machine hour, which is the limiting factor, right? We know that. So contribution per machine hour, we know that this guy is 5 CDs, but it uses what? 2 hours, right? This guy is 4 CDs, but also uses just 1 hour. So this guy means that it is actually using 2 CDs, 50 pesos per machine hour. And this guy is using 4 CDs per machine hour, right? So that means all of them are now on the same level. So which one is now more profitable?
It's B.
B.
I hope that makes sense. So now we rank.
Yes, sir.
That means this guy is first and this guy is second, right? I hope that makes sense.
Yeah.
I hope
Yes,
that makes
sir.
sense. So now that you know you have ranked, then you are saying that, okay, to produce both of these products, we are not going to get all our profit because there's a shortage of 2,000 hours. But how can we still utilize the 48,000 hours available to us to still make the maximum profit we require? So that is where you prepare an optimum production plan, right? And there are many approaches we use, but I think this is the suitable and most simplest one. I get it. So we are saying that what? Our optimum production schedule. Now, ICA, instead of telling you to produce optimum production schedule, sometimes ICA can tell you to produce something we call what? A profit maximizing output. It's the same thing. You get it? So look, I just give you all the scenarios. So profit maximizing output. So when we ask for profit maximizing output, it's the same as your optimum production schedule. Are we okay? So optimum production schedule, what is the available machine hours? How many machine hours were available? Was it not 48,000?
48,000. Yeah.
We are looking at the products, the rank, okay, and how much we can use. Let's see. Which product was first in ranking? It was product what? Product B, right? And how many hours do we intend to use? For product B, we intended to use what? 1 hour. But how many units are we producing? 10,000 units, right?
10,000.
Meaning how many hours we end up using? 10,000 hours. Can we use all the 10,000 hours? Can we use all the 10,000 hours from the 48? Yes, we can. Meaning how much do we have remaining? How many hours do we have remaining?
38,000.
38,000 hours. Okay. Now, which one was next in ranking? Product A, right? Which was second in ranking. How many hours did we intend to use? We intended to use 2 hours by 20, which is 40,000. But we cannot use all 40,000. It means we can only use 38,000 to produce this, right? So since we can only use 38,000 to produce this, the question is, this 38,000 that we are going to use, how many units is that going to give us? We know that each 1 unit gives us 2 hours. So for the 38,000 hours is going to give us how many units?
19,000.
So in simple terms, just take this 38,000 and just divide by the 2 hours. That means we can only produce what? 19,000 what? Units instead of the 20,000 units, right? So it means that you still have what? It means that you still have what? 1,000 units left. You still have 1,000 units left, which you cannot produce, right? And this 1,000 units, this is where sometimes ICA can add a twist and tell you that a supplier wishes to what? Take up these products and supply them at a price of maybe 2 cedis per unit for you. Okay, so you have to assess and see whether this supplier giving you that 2 cedi per unit is profitable or not, so that you can outsource this. So this is make or buy under limiting factor. Do you get it? So once this 1,000 is left, if you think the supplier's price compared to what you manufacture at, that's the variable cost, right? You compare these 2 cedi to the total variable cost. So if this supplier is going to give it to us, let's say at 12 cedis per unit, right? Let's see. What's the variable cost for this product? Product A. It was 20, right? Was it not 20?
Yeah, 20, yeah.
20, but this supplier wants to give it to us at 12. Is it profitable? Should we accept?
Yes, sir.
Yes. So in that case, you are going to say we'll produce 19,000 units, right? So we are going to make all in-house, but 1,000 units of product what? Product A is going to be outsourced to the supplier at 12 cedis per unit. This is how we do. Wait, so you do your normal limiting factor. Whichever leftover units that are left, you can decide to outsource if only the price the supplier is giving is what? Is better than the cost of making it in-house. Makes sense. That's easy.
Yes, sir.
Okay, I hope you won't forget. If I see it takes the twist. Okay, so now that we have decided this, what's our profit maximizing output? Let's write it down there. What's our profit?
Okay. You can change it or just put it off. As an urban producer,
This is the if you know your background is noisy because a lot of people are watching. Kindly. So profit maximizing output. Let's see how much output is going to make us profit. So we need to produce how many units? 19,000 units of product A, right? To be profitable, and product B, all the 10,000 units, right? So these are profit maximizing output. Makes sense. So this is what will generate us our profit. So the last thing is our maximum possible profit. So let's get our maximum possible profit. Maximum possible profit. First of all, we need what? We need our contribution. And this contribution, you can decide to go with contribution per hour, okay, times the number of hours used, or you can decide to go with contribution per unit times the number of units. It's up to you. It will all give you the same answer. So my contribution, I want to go with contribution per hour based on the production schedule, right? So for product A, the contribution per hour, we know it was 2.5 per hour. Do you remember? But how many hours were produced in my optimum production schedule? Product A, we use 38,000 hours, not so. Can you see? From our schedule. Do you all follow? Do you all follow? For product B, this one was 4 cedis per hour. Do you remember? So 4 cedis per hour, how many hours were used? 10,000 hours actually, right? So in that case, what becomes our total contribution? You can also go with our contribution per unit times the number of units that were produced in the optimum product. That's by 19,000 and 10,000. You still get the same. So 2.5 by 38,000. I hope you are all following. Is it clear to everyone? Is it clear to everyone?
Yes, sir.
So our total contribution gives us what? So that's 95,000 plus 40,000. That gives us 135,000, right? So we've got 135,000. Then we less fixed costs. Okay. So fixed costs do not change because they are according to the budget. So fixed costs, I think for product A, it had fixed costs of 3 cedis per unit, but we are actually producing 20,000 per the budget. Remember, fixed costs are fixed. They wouldn't change, right? And product B2, we had what? 2 cedis per unit, right? But we're producing 10,000 units. Oh, why is this thing messing up again? 2 cedis per unit, but by 10,000 units, right? Meaning that our fixed cost for this guys, we have 60,000 and we have 20,000, right? Meaning fixed costs are what? 80,000. We take it out, then we get our maximum possible profit. Okay, and that gives us what? 135 minus 80,000. That's 55,000, right? Giving us our maximum possible what? Profit, right? So that is it. Are we okay? So if they say do throughput accounting, it's the same approach you are going to use, but with throughput, the only variable cost will be what? Material cost, right? Is it understood, or you want us to also work the throughput so that we can go to other topics? Should we still work the throughput out?
Yes, it's likely.
I'll say yes, but it's the same approach. Okay, no problem. So using accounting, so throughput, using throughput accounting, we already know that the limiting factor. So identify what? The bottleneck resource, right? We already know that what was the bottleneck resource? Machine hours, right? We know already. So this why we did it from A. Then 2, get your throughput contribution per unit, right? So throughput contribution per unit, okay? Throughput contribution per unit. So in that case, we have A and we have B, right? So what's our selling price?
25.28.
So this guy was 25. This guy was what, 28, right? So in that case, we less what, material cost, right? So here, material is the only cost. So this is 8 and this is what?
20.
Okay, so in that case, what's our throughput contribution?
8 and then 20. 17 and 8.
17 and 8, okay. But we know that this 17 is for how many hours? This is for 2 hours, right?
Yes.
2 hours. And this is also for what? 1 hour, right? So which is more profitable? That is where we need our throughput return per what?
Contribution.
Per machine hour, right? So per machine hour, this guy gives us what? 17 divided by what? 2 and 8 divided by 1 hour. So that means this one gives us what?
8.5.
8 and
8.5
8.5.
points hour per hour
8.5
and 8 CDs per hour, not so.
and 8.
So now that we've
Yes.
seen this, now what we need to do is we need to rank, right? Next
Yes.
step is to rank. Okay, rank. So let's rank. Which is first in ranking? This.
A.
And right.
Product
So you see,
A.
throughput, the ranking has changed. When we did throughput, you see the ranking has changed.
Yes.
So in that case, what we are going to do now is what? To get what? Our optimum what?
Production.
Optimum production schedule. What's the available machine hours?
48,000.
Available machine hours. What's 8,000? Okay.
Yeah.
So we take our what? Our product rank and then what? The usage, right? Or the
Yeah.
utilization. Okay. So what's the first in ranking? Product A. What's the rank
Yeah.
first?
Right.
How many
Yeah.
hours did we want to use? Wanted to use 2 hours, right? But we were producing what?
Yeah.
How many?
20,000.
20,000.
20,000. Can we produce all from the 48? Yes. So
Yes.
that's 1,000. Okay, we can take it out. Then we'll leave how much remaining? How much is remaining?
8,000.
8,000.
8,000. That means we only have 8,000 remaining, right? So for product B, which was second in ranking, we needed 10,000. But if we use 1 hour, meaning how many units can we produce? So if you take
8,000.
8,000 divided by 1 hour, that means we can only produce what? 8,000 units, right? Okay, so 8,000 units. Okay, so the 2,000 left over, if an external supplier wants to take it up, we have to compare his cost. What do? We have to compare what? His cost to our internal cost, right, of making.
Yep.
If it is lower than ours, then we take it up, right? So if that is so, that is all that is left. Are we okay? So with that being said, now we know what is our profit maximizing output. That's 8,000 units of what? Product B and what? 20,000 units of product what? Product A. So let's get our maximum output. So getting our profit maximizing output, first of all, we need our total operating expenses, right? You know, here for throughput, operating cost or factory cost, operating expenses are the sum of labor and overheads and fixed costs, right? They are all factory costs, right? I told you material is the only variable cost here. So it means that every other cost is a factory cost. So what are we going to do? Let's get all our factory costs. So for product A, and for product B, our factory cost. Let's start with labor cost. So labor cost, so for product A, labor was what? 5 CDs per unit. So by what? 20,000 units. And also product B, labor was 2 CDs per unit by what? 10,000 units. And also 5 2. That gives us 100. And this guy is 20,000. Do you all follow?
Mm-hmm.
So you see here, I'm just getting all the costs to get my total fixed cost for both products. Then we had what? Other variable costs, right? For product A, it was what? 7 CDs, but we are producing 20,000 units. Then for product B, 2 CDs, but we are producing what? 10,000 units, and also 7 2. This is 140,000, and also Do you all follow?
Yes, sir.
Then we have 20,000 again for this guy. Okay. Then we have what? Fixed costs. So you see, for throughput, that's the only thing. All costs are going to be gathered except material, right? Which is the variable cost. So for product A, the fixed cost was what?
3.
But here lies the case, eh? We have made a mistake here. Here, we shouldn't have used weight because it's labor and other variable costs. We base it on the production schedule. So 8,000 and then what? 8,000, right? Do you remember? Because labor changes. So since we are producing 8,000, labor will be based on 8,000, right? And this will be based on 20,000, 20,000. Makes sense. It's only fixed cost that is actually based on the budget as we see, right? So fixed cost, this was 3 by 20,000. And then this one is what? 2 by 10,000. Not so. I hope that's okay.
Yeah.
So 3 by 20,000, that gives us what? 60,000 and 210, 20,000 again. Not so. So what's our total factory cost?
So in that case, we have to change the cost for B, the labor cost, and then the other variable cost for B.
Yeah. You say it has to what?
Because the units used is 8,000 times 2. That should be 16,000. Yes.
Thank you. So it will be 16,000 at both ends, right?
Yes, sir.
Thank you. 16,000, 16,000. Okay. So let's sum it up and then we consolidate everything. So 100,000 plus 140,000 plus 60,000, which is 300,000. Okay. Then this one,
52,000.
plus 20,000.
52,000. Yeah.
So what's our total factory costs? That's 352,000 also.
Yes, sir.
So now that we have this, you see this one is a whole working on its own. It involves a lot. But however, you can open bracket and do it. So in that case, let's get our maximum possible profit now. What's our maximum possible profit? So if we take A, we take B. No, it's for the whole company. So let's just get our total contribution. So what's our total throughput? Our total throughput or total throughput contribution is what? Product A, we made what? 8.5 per hour, right? But how many hours were used overall? This guy, we used 20,000 hours. Do you remember? 40,000 hours, not so. Sorry, from our production setup. Was it not 40,000 hours?
Yeah.
Then for B, it is 8 cedis per hour. But how many hours were we able to use? Only 8,000 hours, not so. So in that case, what do we get? 8.5 by 40,000. That's 340,000 Ghana cedis. Then you have 8 by 8,000.
64,000.
So you add it together, 340,000 plus 64,000. That's 404,000. So now we less what? The factory cost of operating expenses, right? So operating expenses, that's 352,000, which we calculated up there, right? Working. So that gives us what? A maximum possible profit of how much?
52,000.
62.
Yeah. 52,000.
52,000. Okay, so that is it. Okay. Are we okay with throughput accounting now? So now we have to look at one thing, that's performance measurement in throughput accounting. So when it comes to throughput accounting, we need to know how to measure performance. And measuring performance in throughput accounting, we use the throughput accounting ratio. And the throughput accounting ratio is measured by 2 metrics, right? The first is what? Your throughput return, okay, or your throughput contribution per bottleneck or per limiting factor. Oh, what is this? So we use this to measure. So we have our throughput contribution per limiting factor or per bottleneck, right? All over the total factory cost. You know what factory costs are, right? The total factory cost per limiting factor or per bottleneck. Why so? We want to see what the throughput accounting ratio measures. If throughput accounting ratio is greater than 1, we accept the product, right? Meaning we should produce, meaning the product is profitable. Are you following? Are you following?
Yes,
If
yes,
accounting
yes.
ratio is less than 1, we reject what? The project. Meaning the product is what? Loss making. Make sense?
Yes, sir.
Are we okay? So we are going to use the same question, this same question that we solved, but this time we are going to use the throughput accounting ratio style, right? So we need 2 metrics. The first is the throughput contribution per limiting factor, right? Which we have already done. So the first thing to do is to get what? Your throughput return or your throughput contribution per bottleneck, right? Which we have already done. Do you remember? We can just pick. What was the contribution? A and B. Selling price was what? So we are working against so that it gets stuck. 25 against what? 28, not so. The material cost becomes what? 8 and 20, not so. No be so.
Yes,
so.
yes.
So what's the
17
throughput
and 8.
contribution?
17 and 8.
17 and 8, right? So we have this,
Yeah.
but we know that the number of machine hours that we're giving were what? This one was 2 hours. This one was 1 hour also. So we divide. So we've got the first metrics, right? Which is the A we are looking for. That's the throughput per what? Per bottleneck. Per what? Okay. This one gives us 8.5 per hour.
8.5 and 8.
This one we get what? 8 per what? Hour, right? Okay, now that you have, you do not rank. Yeah, we don't need ranking. We are trying to get our throughput accounting ratio. So this is the first part, right? So now that we've got our first, the next part of it is to get what? Our factory cost or operating, right? Factory cost per bottleneck, right?
Yeah.
Okay, per bottleneck. Now, what is our total factory cost?
352,000.
Total factory cost operating expenses is 352,000 Ghana cedis, right?
Yeah.
Okay. Then what's the total available bottleneck hours? Available machine hours was what? Total available machine hours. 48,000, right? So what's the factory cost? What's the factory cost per machine hour? What's the factory cost per machine hour? Get it for me. Factory cost per machine hour. What does that give us? So that's 352,000 over what?
48.
Over the 48,000 machine hours, right?
7.3.
So we have what? 7.3
yeah.
per machine hour, not so. Okay, 7.3 per what? Per machine what? Hour, right?
Yeah.
Okay, so now that we have all the metrics that we need, let's get our throughput accounting ratio. So throughput accounting ratio, not so. We have product A and product B. So first of all, we need our throughput per bottleneck. Throughput per bottleneck was what? This guy was what? 8.5 per hour,
Yeah.
not so. And this guy was what? 8 per hour.
8.
Okay. Now we need factory cost per bottleneck. Factory cost per bottleneck. That was what? It's fixed. So it's 7.3 per hour against what? 7.3 per hour, not so. You get it? So we divide both, and that gives us our throughput accounting ratio, T power. So both of them will be profitable, meaning we can proceed with production. So 8.5 divided by 7.3. This one gives us 1.16, right? Profitable.
Yeah.
This one 8 over 7.3. That gives us what? 1.09 or 1.10, right?
1.1. Yeah.
Okay. Meaning both of them are profitable, right? So if you're able to do the throughput accounting ratio, you can now continue to rank. The question tells you, you can now continue. The reason why when we did the first one, we still had the same ranking was because 7.3 is constant. So it will still give us the same ranking. But if the question specifically asks for throughput accounting ratio, this is how you do it. So you rank This one will be first, and this one will be second, right? Then you proceed with the optimal production plan, and then your maximum possible profit. I hope I've taken you into throughput, right? Now, sometimes a limiting factor, the question can ask you for what we call shadow price. This is where students get confused. What is shadow price? Shadow price is the extra contribution, okay? The extra contribution generated as a result of employing one additional unit of limiting factor. That is what we call shadow price. So in simple terms, what is the shadow price? The shadow price is the contribution per limiting factor for the limiting product, right? The one that you cannot produce. So which one is the actual limiting factor? That is, if I employ one additional machine hour, which products would I end up producing? We realized that we couldn't, when we're doing limiting factor, which product could we not produce? We couldn't produce product A, right? We could only produce only 19,000. So it means that if we employ just one unit of what? One machine hour, it will go into the production of product A. Do you know that? That means that for one unit, the contribution that we generate from product A, which is a contribution of what? 2.5 per hour, becomes the shadow price. So there's a long calculation for shadow price, which we can do and still get the same 2.5. But anytime you are getting shadow price, the one which you couldn't finish producing, the contribution on it becomes the shadow price. Makes sense? So if you go and they ask you to calculate shadow price, that is all. Okay. Are we on point? So cost profit analysis, right?
Yes, sir.
Yes, boss.
Yeah, I actually wanted to make to get some clarification in terms of determining the factory cost per limiting factor or whatever, or per bottleneck resource.
Yeah.
Why could we not, once we have the individual products having the labor variable and fixed cost, why could we not have computed that divided by the bottleneck to get the factory cost per bottleneck, and we are using the total.
So for factory cost, we assume that factory costs are total for the whole organization. They are fixed. Do you get it?
Okay.
That is the assumption.
Yes,
so for factory cost, we get the whole factory cost for all the organization and then divide. Do you get the idea?
Okay, sir.
If you want us to do that, let me do something. I hope that will not, if that will not worry, we can still do it, right?
Yeah.
So we have a lot of them that we can do, but anyway, that's okay. Somebody keeps annotating on the screen. Let me stop sharing my screen and share again. And disable annotation. You get the idea? So look, assuming that a company manufactures a single product, each unit takes 2 hours to make, right? 2 hours to make on machine X, right? And output and capacity is restricted by the available time on machine X, meaning machine X hours is the limiting factor, okay? Which is limited for 500 hours per week. The product had material of 220 cedis per unit and sales of 160 per unit, meaning we can get a throughput return as what? 160 minus 20 per unit, right? And total operating costs are also given what? Per week, meaning we are doing per week, not so. So when we look at it, let's look at something. So what is the throughput return per unit or throughput contribution per unit? What's the throughput contribution per unit? We make selling price of what? Selling price
160.
Okay. This was what? 160 minus
20.
Minus 20, which means we have what? 140 cedis
per unit.
Per unit. Okay, so now that we've got 140 cedis per unit, how many hours were available for the making of one unit?
2 hours.
2 hours, right? So that means that divided by the 2 hours is going to give us what? Our throughput return per what?
Per unit, per bottleneck.
Yeah, per bottleneck, which is 140 per 2 hours. That's what 70
70.
per hour. No, so okay.
Yes, sir.
Now we need our factory cost per what? Per hour, right? But you see that the factory cost that we're giving were what? 30,000 per what? It was given per what?
A week.
Per week. And how many hours are also available per week? You see, everything is total. They didn't do per unit. Everything is total. So what's the available hours per week? Checking the question. How many hours were available per week? We have 500 hours per week,
Yeah,
right?
a week. Yeah.
So if 500 hours per week, what becomes our factory cost per hour?
60.
Per bottleneck hour. So that means we take our what? Our 30,000 and divide by what? 500 hours. And do you see why we're dividing the 352 by the what? The 48,000? Do you get it now?
Yes, yes, yes.
So 30,000 divided by 500 hours, what do we get?
It gets 60.
60, right? So now we've got
Yeah.
all the variables we need. So what's the throughput accounting ratio? Let's check if this product is profitable. Okay. So we have what? Contribution per hour over what? Fixed factory cost per hour, right? And what do we get?
1.17.
1.17. So is it profitable? Since what? Since T pi is greater than what? 1, right?
1.
What should they do? They should produce the product, right? Should they produce the product?
Yes, sir.
Because it's profitable, right? Because throughput accounting ratio is greater than 1. Okay. I hope this is a good example. Okay,
Yes, sir. Thank you.
So you're welcome.
Hello, sir.
Yes, boss.
Please, with the shadow price, is it always the contribution or the return?
The return
Yeah,
is the same as the contribution.
Yeah, I'm asking the question because I've seen a situation where they use the contribution per limiting factor as the shadow price.
That is what I said. That's what I said. Is that not what I said to everyone? Didn't I say the contribution per limiting factor for the one you cannot produce, or that becomes the shadow price? Because each time I add 1 extra hour, that is the one that it will go into its production.
Yeah.
You get it? So it's the contribution. The return, you know, contribution is the same as return in throughput. Just that throughput, we do not call it contribution, we call it throughput return. It's the same thing. It's still contribution. Per hour. It's per hour because we are comparing per the machine hours or what was given. Please, are we okay?
Okay, thank you. Yeah, thank you.
You're welcome, boss. So now we move to one technique which is very important. It is utilized for decision making, but I prefer that we actually understand it very well, which is CVP. Okay, CVP is very important, and CVP is what you will be using. Now, in your exam, if CVP comes as what do we call it? If it should come as a single product CVP analysis, okay, they are going to ask you some theory, okay, that what are the assumptions used in CVP analysis? And they are going to ask you the limitations of the assumption for theory. You see, I'm always talking about theory and I'm also talking about calculation. So what are the assumptions that are used in CVP? Now, let me tell you what we call CVP. It says cost volume profit analysis. This is a what if analysis. When we say what if means that if something like this changes, what will happen, right? That's how CVP works. So cost volume profit analysis tell us how a change in cost and volume will affect profit. That's what it means. Or how a change in profit and the rest will affect other things on the financials, right? So what are the assumptions that we use in CVP? One is that costs are either fixed or variable. Here, cost behavior is very important, right? And to do CVP, we must understand cost behavior very well. CVP means that you must understand how to split variable and fixed costs using high-low. And it is possible you are going to get a question on high-low. So before we even start CVP, we are just going to go over some few cost behavior, right? Including high-low, and do some questions on high-low to learn how to split costs when it comes to high-low. Are we okay? High-low is not difficult. Just know that. So the assumptions are that costs are either fixed or variable. Fixed costs are normally assumed to remain unchanged at all levels of output. The contribution per unit is always constant for each unit sold. It doesn't change. Price per unit is constant, not so. If sales price per unit, variable cost per unit, and fixed costs are not affected by volume of activity, sales and profit are maximized by maximizing total contribution, and production is equal to sale, meaning there's no opening and closing stock when you are doing CVP. Makes sense? So in case you even get a question, they say now use CVP, ignore the opening and closing stock and work as if they don't exist. Makes sense? So these are the assumptions that we use in cost behavior and also CVP analysis. Make sense? Are we okay?
Yes, sir.
Yes, sir. Yes, sir.
Okay, with that being said, right now, I know you guys know variable costs, you know fixed costs, you know semi-fixed costs. Now I want to talk about semi-variable costs and how to split them. Okay, when it comes to semi-variable costs, we split them using a lot of methods like regression analysis, accounts analysis, least squares method, and the rest, right? Even interpolation is what we are going to use, right? That is the high-low method. So we are establishing 2 points on a line. So with the high-low method, what we do is that to split semi-variable costs, okay? There are some steps we need to follow when we want to split semi-variable cost in a question. One, we are first going to what? Determine the cost. Remember, variable cost per unit is always constant, right? This is what we use to answer management accounting. Variable cost per unit is always what? Constant. Since it is always constant, it never changes, right? And this is what we use to take decisions in management accounting. Are you following? So with high-low method, the first thing is to determine what? To determine your variable cost per unit, right? And variable cost per unit, we get it as what? Our cost at the higher level, okay, minus your cost at the what? The lowest level, all over what? Your level of activity at the highest level, minus your cost at the what? The lowest level, right? This is how we get it. And you know, you've done this in mathematics. You are actually trying to what? Do this. Y equals A plus BX, right? Where we know that this B is the gradient. You've seen it before, right? And this A is the y-intercept. It cuts the y-axis. So if you have this, this becomes your A, this becomes the steepness of the line, the B, and X is here, right? So what you are trying to do is you are finding the gradient. And in mathematics, you know, gradient is got as what? The B in mathematics is got as what? Y2 minus Y1 over X2 minus XY. You've seen this before, right? That's exactly what you are doing here. So management accounting and mathematics are the same thing. Just that we are using different terminology. Makes sense? That's all. So this thing you are doing is y2 minus y1 over x2 minus x1, just to come and get the b. Makes sense? Very easy, right? So after you are able to get your variable cost per unit, the next step is to determine your fixed cost, meaning now you are trying to find the A, right? So determine the fixed cost. And determining the fixed cost means that you can take any original, so take the original parameters and put in the question, right? And you can take it at the higher level or the lowest level. Remember that total cost equals what? Fixed cost plus what? Variable cost per unit times the number of units, right? So this is it. So you can slot in any number of units and you come and get the fixed cost at the what? At the level that you are looking for. And the third is you use it to solve the question. Establish your total cost equation. That what? Total cost equals your fixed cost, which you have determined from above, plus the variable cost you determine above times the number of units, right? And then you use it to work the question. It's always like this, right? So we are going to take some basic questions under high-low, and then we'll use it to what? Work out. I hope that is fair.
Yes, sir.
Okay, we'll solve a basic question, then we'll solve a difficult one too. Let's see how well we can all. Okay, high-low. So there's a simple question here. This is actually a past question that came in May 2011. So let's see. So we have a company. Okay, in the actual question, they didn't bring total cost, but remember, high-low, we are using costs, okay? We are using costs, but in the question, they gave sales and profits, okay? In the question, they gave sales and profits. They didn't give what? They gave sales and profits. They didn't give
Total cost.
Total cost. I mean, a lot of students were confused. But you know, sales minus cost equals profit. So if they give you sales and profit, what do you do to get the cost? You subtract, right? That's as simple as it goes. But a lot of students made mistake. So the first question is that state 5 assumptions under cost behavior. Yes, we just looked at it. What are the assumptions?
Total variable cost. Total fixed cost does not remain constant.
It remains constant. Variable
Yeah.
cost per unit stays the same. There are no
Same.
opening and closing stock, right? Sales remains the same.
Production is equal to sales.
Contribution remains constant per unit, right?
Yes,
If sales is maximized and contribution increases, it should maximize what? The contribution as well. So these are the things we looked out for. And production is equal to what? Sale, right? Okay. So you say it, you get your marks, you are gone. Okay, so what do we do first? I told you the first step is to determine what?
the variable cost per unit.
Determine the variable cost per unit, right? So variable cost per unit. And how do we get it? Variable cost per unit is giving us what?
Change
The cost
change
at the
high cost of higher level minus cost of lower level.
the lower level, all
All
over what?
over.
The level of activity at the highest level.
Activity, higher level and low.
Activity at the what? The lowest level, right? So first of all,
Yeah.
let's get the quantity first and relate it to the cost. So when you look at the quantity, we have what? The lowest quantity being 1,005 related to what? 280, right? You get the cost. So you subtract this and this, get the cost, which I've done for you already. So in that case, what do we have? So the highest cost was what?
The highest cost is 2.
Check well. The highest cost.
The highest cost is 490.
190,000, right? Minus
Yeah.
what? The lowest cost?
280,000.
280,000.
What is the corresponding level of activity?
3,000
1,000 units against what?
minus 1,500.
Units. Okay, so in that case, what becomes our variable cost per unit? 190,000 minus 280,000. 210,000 divided by what? 1,500, right?
Yes, sir.
Okay, so what do we get for our variable cost per unit?
1,400.
140. Oh.
Yeah. 140. Yeah.
Okay, so we get 140 per unit, right? So now that we've got 140 per unit, what's the next step? Determine the fixed cost, right?
Yes,
So
sir.
determine the fixed cost per unit. So using the parameters in the question, which level of activity should we take? So we can use what? The highest level, right? So taking the highest level, you know, at the highest level, total cost was what?
490.
190,000. And the level of activity or quantity was what?
3,000.
3,000.
So let's put it in. We know total cost equals what? Fixed cost plus what? Variable cost per unit times what? The number of units, not so. So in that case, total cost at this level was 490,000. We equate it to what? Fixed cost, which we are trying to find. Plus, we know variable cost per unit is now 140. So multiplying this by the 3,000 that we had at that level, we can get the missing figure as the fixed cost, right? So 490,000 equals what?
Minus
140.
420,000.
It gave us 420,000. Where is this?
So fixed cost is 70,000.
Thing is freezing. So that means this minus what? You said it's how much? 420,000, right?
Yes, sir.
So that means fixed cost is what?
70,000.
70,000. Okay. So now that we've got our fixed cost, meaning we can establish our cost equation also. So let's get our cost equation. That means total cost is now what?
It's equal to 400.
70,000
140
plus 140x, right?
Yeah.
Yes.
Because x is
Plus
the number.
70.
If right now I tell you that what's the cost of 100,000 chairs, we can easily find it, right? We just put
Yes,
it in
sir.
this. Meaning total cost for 100,000 chairs will now be 70,000 plus what? 140 by 100,000 chairs. That gives us what? The cost for 100,000 shares.
Can hear you.
What do we get?
I'm getting 14,070,000.
Yes, that's the cost of 100,000 shares. Yes, I hope that is okay. Okay. I hope everybody is on point. Now, this is a question that will blast people's minds. Let's see. Let's play a game. Now, look. Nyong Limited has computed this factory overhead cost at high and low levels of activity as follows, right? So what's the requirement? It says what? Determine how much of the 176,250 factory overhead at high level consists of maintenance costs. And you know maintenance has fixed and variable costs. Do you know that? Because when you are maintaining in an organization, sometimes ICA will not tell you whether that cost has both fixed and variable costs, right? But you have to know. So something like maintenance has both fixed and variable costs at the same time. So you have to try and split them. But they are asking us that out of this 176,250, right? How much of it relates to what? Maintenance. So first of all, let's see. They are telling us that assume that the factory overhead costs above consists of direct materials, rent, and what? Maintenance expenses, okay? And the company has analyzed the 50,000 direct labor hours, are you getting? And has determined that the cost exists in the following proportion. So this is what they are saying. If I should group them, what's our level of activity? We have what? 50,000 what? At 50,000 units, right? And at what? 75,000 units. Do you all get it? Let's gather the cost here and let's see. Okay, so what are the costs? We had what? Indirect materials, right? Indirect materials. We know this is variable cost, right? And variable cost, we know that variable cost per unit is always constant. No be so?
Yeah.
So at 50,000, this was actually 50,000. So if it was 50,000, what's the cost per unit? We can easily get it, right? That indirect material cost per unit becomes what? We know the cost for 50,000. So 50,000 divided by what? 50,000. That means what's the cost? The cost is 1 CD per unit. Remember? True or false? Is it not 1 CD per unit?
50,000.
Yeah. So we have 50,000 and corresponding one, but this one we do not have the cost, so we want to get it. And we assumed in cost behavior that what? Variable cost per unit is constant. It doesn't change, right? So once we divide, we can get it. Since it's 1 per unit, that means that the 75 level of activity is going to be what? 1 CD per unit. True or false? True or false?
True.
Yes, it doesn't change. So at 50,000, so 1 by 50 will give us 50. So 1 by 75 will also be what? 75,000. Do you all agree? Makes sense. Okay. So now, if we are equating this, we know that this one, the total cost was what? We are giving total cost. Total cost, now saying this one was 142,000, right? And this one was what?
176,250.
Now we've got the missing figure. Now the next was what? Rent. They said rent was what? Fixed. And since it's fixed for all levels. So if rent is 60,000, that means here to rent is what?
60,000.
60,000. Oh, wow. That means maintenance. We can easily get maintenance. Not so. And how much was maintenance? Here, maintenance was 100 and what? Maintenance was 32,000, right? And here, maintenance will be, you have the total, so you can just subtract. Not so. You get what? 41 what? 250. Not so. You all agree?
Yes. Yes, sir.
Compared to this. Okay. So this alone would have beaten some students. They cannot do it. See how tricky it is. Okay, now we know maintenance is semi-variable. So what do we have to do? We have to split it, right?
Yes.
Okay, so how do we split it? So we need what? Variable per unit, right? And we know this is what? The maintenance cost at the what? Highest level minus what? Maintenance cost at the lowest level, right? All over what?
Activity, highest activity level.
Highest level minus what? Level of activity at what? The lowest level, not so. So in that case, yes, we know maintenance at the highest level was what? 41,250, not so. We just got it. The one at the lowest level was what? 32,000. You can see, right? But what's the level of activity? This one, we had 50,000 hours. Not so. And then, no. 75,000, right?
Yeah.
So 75,000 labor hours against what?
50,000.
50,000 labor hours, right? So we are looking for variable cost per labor hour. That's what we're giving. So what's our variable cost per labor hour? So 41,250.
0.37. 0.37.
0.37. Okay.
Yeah.
So that means you have 0.37 per labor what? Hour. Not so?
Yeah.
So can you explain how you get the 41,250?
What we've done here. See, indirect materials is
Maintenance.
variable cost, right? So if it's variable
Okay.
cost, it doesn't change. So since it doesn't change, you can get a variable cost per unit, right? Which we have. So once you've got this variable cost per unit, what are you going to do? You can now multiply by the 75 for the next, and you get it. What we are actually doing here is that we are preparing a flexible budget. This is what we call a flexible budget, right? A budget at different levels of activity. So it was at 50. So we divided by the fixed budget to get 1 cedi per unit, and now we multiply by this to get for this one. If there's another one, we can multiply it to get. You get it. And since rent is fixed, it is fixed for all levels. So you see, we repeated the same rent here because it's also fixed.
Yes,
Now they've already given us the total to be 176. So we can compare it to all this, and the difference is the 41,250. Is that okay now?
yes, sir.
Okay. So now that we have this 0.37 per labor hour, what do we need? We need fixed cost, right? How do we get fixed cost? Which level should we take?
Cost minus variable cost.
Yes.
Let's
Fixed
take
cost
the
is
high
total
level.
cost minus what? The variable cost per unit times the number of units. The reason why I don't say total variable cost is this is always constant, right? It is this one that changes this. So taking what? Today, let's use the lower level. So taking the lower level, right? I know what? At the lower level, total cost was what? Total maintenance cost was what? 32,000, right?
32. Yes, sir.
And then the level of activity was what?
50.
50,000 hours. Okay, so we slot it in. So we know total costs equals what? Fixed cost plus what? Variable cost per unit times what? The number of units, not so. So in that case, total cost at this level was 32,000. We are finding fixed cost plus variable cost. We know is 0.37. How many units were here? 50,000 what? Hours, right? In that case, let's work it out. We get 0.37 by
18500.
so we get 32,000 minus what? 18.5, oh?
Yes.
Yes, sir.
So what do we get for the fixed cost?
13.5.
1350.
13.
500.
500.
30. Okay, so now we've got it. What's our total cost equation for maintenance? Yeah. Comes 13,500 plus what? 0.37x, right?
7x. Yes.
So this is total cost for only maintenance. Remember? Okay. Now I want total cost for all the variable costs. So let's get everything. So total cost, we know that variable cost, we had what? Variable cost for what? Indirect material. Indirect
Per
material.
unit is
Indirect material. It was 1 cedi per hour. Do you remember? Do you remember?
yes, sir.
And this one maintenance to variable cost was what? 0.37 per hour. If we put it together, it means we have 1.37 per what? Per hour. No, so we've got the variable part. Let's go to the fixed part. So for fixed cost, what did we have? The total fixed cost. We had rent being what? 60,000. No, so then we have maintenance being what? We got it right now. The maintenance. How much was the fixed cost? 13.5, right?
13,500. Yes.
Okay, so if you put it together, that means you have what? 73,000 what? 500. No, so that means our total cost equation now equals what? 73,500 plus what? 1.37 per hour.
Yes.
Okay, 1.37. Let's just put the X, right? So in that case, if we try any of them, we should get, let's try the 75,000. So at 75,000 units, let's try and see if we get it. So total cost becomes what? 73,500 plus 1.37 times 75,000 hours. If we put it in, what do we get?
$176,250.
Are we on point?
Yes, sir.
Yeah.
Question maybe one more.
Yeah, there's confusion.
But if you understand, it's easier. If we understand, is it easy?
Well,
Yeah,
yeah,
if you
okay,
understand,
it's very easy, simple.
Let's try another one. We are going and we are going and we are going, So we'll keep going and going until we go. Okay. So let's see. So these
Prof,
things
please,
are what?
can we get one with the step fixed cost?
Step fixed cost at your level, they are not going to bother you with that.
Wow.
Yeah.
Okay.
But with step fixed cost, it's very easy. So let me show you a trick. If we say step fixed cost, it means that when your fixed costs get to some specific level, when your production gets to some specific level, you incur additional fixed costs. And if that happens, what you are going to do is that if your high level includes that level, right, take it out and do it without the fixed cost. Take out the fixed cost inside. When you finish and you get everything, then add back the fixed cost to the total cost equation. That's all. Makes sense? Oh, it's not clear. You get what I'm trying to say?
It's not very clear.
I'm coming. Let's use the maintenance cost here. And let me tell you that if labor hours exceed 80,000 hours, okay, additional maintenance costs of 1,500 cedis is incurred, okay? So let's say this is what we have, okay? Are we okay?
Yes, sir.
So this is what you have. Based on this same question we're doing, the one we just did. So I'm just going to give you maintenance cost, right? At the highest level and at the lowest level, right? So maintenance costs at the, well, let me arrange it well. So level of activity. We know that the lowest level was 50,000 hours, maybe. Now highest level, let's say we are saying 90,000 hours. Okay, this is what we have. So that was what? So you are having what? You are having your cost, right? Your cost, maintenance costs. Here, your maintenance cost was what? 32,000, do you remember? At 90,000, the cost is 48,300. So let's say this is what you have. And it says, let's use high-low, right? High-low. Then this is the thing that we were given. That means if level of activity exceeds 80,000, right? What happens? Additional 1.5 is incurred. So the question is, the high level, has it exceeded the 1.5? Has it exceeded the 80,000 units? Has it?
Yes, sir.
Yes.
It has, meaning that this cost includes 1,005. That should be taken out before you do your high-low. Do you get it? Make sense?
Yes, sir.
So I am going to strip off the 1,005 from it because it has exceeded that level. So when you take it out, what are you left with?
7,500.
No, you are left with 46,800.
46,800.
Yeah.
Yes. So this 46,800 you are left with. Use it now to do the high-low. Let's see. So what's our variable cost per unit now? It's going to be what? 46,800 minus what? Minus 32,000, right?
2,000.
All over what? 90,000
50,000.
minus what? 50,000.
50,000.
And what do we get for our variable cost per unit? Do you get the 0.37 still? Check and see.
Yeah, 0.37.
Yes. So you see, it doesn't change it. 0.37, right? Per unit, right?
Yeah.
Per labor hour. We have it. Now let's put it inside our fixed cost and let's see. So getting our fixed cost, let's use the lower level. So using the lower level, we know that total cost at the lower level was what? 32,000, right? And then the level of activity was what? 50,000 hours. Okay. So we put it in this one. That means what? Our total cost, which was what? 32,000 must be equated to what? 32,000 equals what?
Fixed cost.
Fixed cost, which we are trying to find, plus what? 0.3
0.37
times 50,000, right? And that gives us what? 18,500, right? So we
18,500.
get
Yeah.
1,000 minus what? 18,500. equals our fixed cost, which is still 13,500 also, equals
500.
our fixed cost. You see, it's the same question that I've revamped, right? So 13,500. So now that you know it is 13,500, now your total cost equation is still 13,500 plus what? 0.37x plus 1,005 if level of activity exceeds 80,000 what? Hours. You get it? Makes sense. So now assuming I produce 800,000, use 100,000 hours. The question is, if we put this inside, we are going to add 1,005. True or false? True, because this is more than 80,000 hours. Make sense?
Yeah.
Yes, sir.
What if I say do for 20,000 hours? Will we add 1,005 to it?
No.
Because it does not exceed. That's all about
Exceed.
the fixed cost. Makes sense. Very simple. Okay.
Great.
Okay, so let's look at Jimco. Jimco makes and sells a single product P, from its base in Labadi. It is currently producing 112,000 units per month and is currently operating at 80% of full capacity. Now, one thing you should listen carefully is that in management accounting, anytime you see somebody having a different level of activity, are you listening? Somebody having a different level of activity, make sure that you always try to find 100% level of activity. What did I say? Anytime you what?
You have a different level of activity. You have to make sure you have 100% level of activity first.
Always make sure you find 100% level of activity, right? So let's try and see. Jimco produces what? It is producing, what is its 80% capacity? It's producing at 80% capacity. How many units? It says 112,000 units per month. Okay, so if 80% is 112, then 100% will be what? That's what we are trying to find. Its original capacity. You get it? And that will be what? We need to find it, right? So that means 100 out of 80 by 112,000, right? Will give us. Anytime you have something you want 100% in management accounting, you can just take that thing and just divide by the 80%, which is 0.8. It will give you the 100. The reason is because, see, 100 over 80 times 112 is the same as what? Remember, multiplication and division, you turn it upside down, right? This is the same as saying 112,000 divided by 80 over 100, right? Which is the same as 112,000 over 0.8. Not so. So if you do not want to use this, I prefer that in management accounting you use this because sometimes ICA will just give you percentages. So if you want the 100%, just take this and divide by 0.8, and that will give you the 100%. What if it was 75%? Then we divide what? The 112,000 divided by what? 0.75 to get 100%. Makes sense. Simple, right? Makes sense.
Yes, sir.
So if I have 20, what if I told you that, okay, 108,000 was 20%? So how do we get 100%? How do we get 100%? Oh, I just taught you. How do we get 100% level? Why is there silence? Oh, I said if you are giving 80% and you want 100%, just divide this by the 0.8. So now I said if 108 is 20%, what becomes 100%?
Probably divide by 0.2.
Yeah, so you just take 108,000, just divide by 0.2. That's all. Please, you need this for management accounting, especially when you are doing flexible budgets. That one, they only give you percentages, like 0.2, 80%, 75. You just divide by 0.75, 0.8, and you are trying to get overall 100%. That's what it means. Do you get it? So if you are doing mix and yield, and they tell you that, oh, output of 30,000 kg came out, right? 30,000 kg. There was a normal loss. There was a normal loss of 5%. Normal loss of 5% indicates that what? Whatever came out is equivalent to 95%.
95.
So how
Yes,
do we
sir.
get 100%? We just take the 30,000 kg. 30,000 kg and just divide by what? 0.95. It's the same as saying 100 out of what? 95 times the 30,000. It's the same thing. But this one is quicker, right? So just take it. And then you are gone. That means the original input that was put into the process was what? That means we end up with what? 31,579, right? Kgs of material, which is what becomes our standard input that is going to be split at the standard mix, right? So that is it. I hope you are getting it.
Yes, sir. Yeah.
Please don't forget this. Oh, you will need it tomorrow. Okay, let's see. Let's see. So they are telling us that 80% gave us what? 112,000 units. No, so if 80% gave us 112,000, then what is 100%? How do we get 100% capacity? We can take our 112,000 units and divide by what?
140.
So that's how much?
140.
140,000 units.
Yes.
Okay, so we've got this. Now let's continue. It says what? Total monthly cost at the current level of capacity is what? 611,000. So they are telling us that the 112,000 gave us how many units?
It give us 6,000.
611,000.
Yeah.
Okay. At 100% capacity, total monthly costs are what? 695,000, right? And 100%, we have already calculated it just to be. That's 140,000 units. Also.
Yeah.
So in that case, what do we get? They said this one was 695,000, right? And
69, yes.
They said fixed cost will be the same at all levels between 85% and what? 100%, right? Okay. And they said a normal selling price for product P contributing to sales ratio is this. And a new customer has done this. But with this being said, this is total monthly cost, meaning it includes both variable and fixed costs. So since it includes both variable and fixed costs, what do? We must split, right? Can we use high-low here? Yes, we can. So the first thing to do is what? To split it. So what's our variable cost per unit? That's the first thing we do. That's our cost at what? The total cost at the highest level minus what?
Minus lower.
Total cost at the lowest level. You see how now they inculcate what? This into what? Your decision making, right? So we have what? Level of activity at the highest level minus level of activity at the what? At the lowest level, right? So what then do we get? We know that the highest level is 695,000 minus what? 611,000 also.
Yes.
Now divided by what?
140 on 112.
What is this?
What's another 112?
So this one was what? 611,000 also. So 140,000 minus what? 112,000. Okay. So what do we get for the variable cost per unit?
3
cedis per unit, right?
Unit.
Okay, so if 3 cedis per unit, let's get the fixed costs. So fixed cost.
Are you using the high or low?
Any of them. Just take any of them. So taking the highest, okay, taking high level of activity. What was the total cost there? Total cost was 695. A level of activity of what?
140.
Okay, 140,000. Okay, so in that case, let's get our fixed cost. We know total cost equals what? Fixed cost plus what? Variable cost per unit times the number of units, not so. So in that case, at this level, we have 695,000 compared to the fixed cost we want to get, which we are trying to find. But this is what? Variable cost of 3 cedis by what?
140.
140,000. Okay, so in that case,
fixed cost is 275,000.
Fixed cost is 275. But in this question, we didn't really need the fixed cost, right? It's the variable cost we actually needed to determine the selling price. So in that case, it says the normal selling price for the product P, the contribution to sales ratio is 60%. So we are saying that, okay, they are saying that CS ratio, okay, contribution over sales is 60%. So that means if I should bring selling price, which is the original 100%, I should bring variable cost and I should bring my contribution. They are telling me that contribution to sales is what? 60%, right? 60%. That means variable cost to sales will be what?
40%.
40%. This is a simple approach, right? If you are a management accounting student instead of mathematical. So straightforward. You are saying that this variable cost, which is 40% of sales, is equivalent to 3 cedis. We had it. Do you remember? That means our selling price, which is the 100%, will be what? We don't know. Not so. So how do we get 100% when we have a figure? We can say that our selling price, therefore, is what? 3 CDs divided by 0.4.
0.4.
Or you can definitely do 100 out of what? 40 times what? 3 CDs. Not so. It's still the same. So what do you get? You get 7.5.
7.5. Yes.
So that means it is what? 7 CDs, 50 pesos to be the selling price. Straightforward, right? If you think you cannot do this, then go mathematical. Contribution to sales ratio is the same as what? Contribution per unit over our selling price. Meboa. Is that not it? And then contribution is giving us what? Selling price minus variable cost, right? Which is contribution all over your what? Selling price. And they are saying this is 60%, right? So if this is 60%, and selling price is what we are trying to find, but we know variable cost is 3 CDs. Divide by selling price, then we can work out, right? So it becomes what? Selling price by 0.6, right? Equals selling price minus what? 3. Not so?
Yeah.
So you get 0.6 SP equals SP minus what? SP minus 3, right? So this will move to the other side, making SP minus 0.6 SP equals 3. Not so?
Yeah.
Have 0.4 SP equals 3, meaning you have to divide by 0.4, 0.4, which will still give you the same what? 7.5 as the selling price, which is too long, right? But as a management accounting student, you always know the other side of something. If they tell you you retain profit of 80%, it means you pay out dividend of what? 20%. You get it? Always know the two sides of things so that you are on the safer side. Otherwise, you do long methods. I hope you are learning something. So these are the nitty-gritties.
Yes,
Equation should be very good. Now, we've got a selling price, and they are saying that a new customer has offered to buy 25,000 units of product P each month at 20% below the normal selling price. Oh, so this guy is going to buy what? 25,000, but now at what? 20% below the normal selling price. So how much is he going to buy? That means he's going to buy it at 80% of the price. So he's going to buy it at 80% of 7.5, meaning he's going to buy it at 6 CDs. Do you get the idea?
Yes, sir.
They are saying that for every 5 units that it sells to this customer, it is going to lose 1 unit of its current monthly sales to other customers. So what is its current monthly sale? What is its current monthly sale?
The monthly sale is 7.5.
No, the quantity. We are looking at the quantity. Question if you will move. Don't worry. Let's go small. Now, what is the new selling price that the customer wants to buy? The new selling price. He wants to buy at what? They say he's going to buy at 80% of what?
Of
80%
the old
original price, right? Because they said that he's going to buy at 20% below the normal selling price. So below means what? You are giving him a discount. So the 100% 0.2, right? Meaning he's going to buy it at 80% of the original price. So this times the 7.5 will give us what? 6 CDs. That means he's getting it at 6 CDs now, right? So what's the new contribution? If we decide to sell it to him, how much contribution are we expecting to make? You know, contribution is selling price minus variable cost, right?
Yes.
So that means we get 6 minus what? Variable cost of 3 CDs. Is that not what we have? Meaning, if we sell to this customer, we are sure to make what? A new contribution of 3 CDs per unit. Not so? So,
yes, sir.
If we are going to sell to this customer, they are saying that what? For every 5 units that we sell to this customer, we are going to lose 1 unit of our what? Our current monthly sales to other customers. So for this customer itself, how much are we going to make? Contribution from this sale, we are going to get how much?
3 CDs.
3 CDs times 25,000, right?
Yes, sir.
Which is how much? 75,000 also.
75.
We are saying that we are going to also lose contribution from other sales. That says that what? For every 1 unit that we sell, okay, we are going to lose 5 units from our current sales, right? Which means how many units are we going to lose contribution for? 5,000 units, right? And each
Yes,
of them
sir.
has a contribution
5,000.
of 3 things. And that's how much?
That is 15,500.
Okay. It's 15,000.
Yeah, 15,000.
So
Yeah.
that means let's check if this order is good. We should accept or we should reject. Should we accept the order? Does it come with a net benefit or a net loss? Net benefit, right?
Yeah, net benefit of 60. No.
Of 50,000 also. So should we accept or reject?
You accept. You accept.
Okay. The company should what?
Accept.
Company should accept the order, right?
Yes.
Because it what?
But it increased profit by 60,000.
Generates a net contribution of how much? Of 50,000 cedis. So you see the application of high-low. High-low can be applied anywhere. It can be applied in budgeting, can be applied in CVP, it can be applied anywhere. At your level, it's more application-based. But this question could have gotten a lot of students, right?
Serious.
Yes, that's management accounting for you. But I hope gradually the understanding is coming small. Okay.
Yes, sir. Yes, sir.
So mostly high-low for special order decisions, that's where you mostly see high-low, okay? You are going to use it. So let's look at Zombie Limited. Zombie Limited manufactures and markets slimming products and body shaping drinks, which they sell for 20, let's say, pesos per can, right? Currently, output is 400,000 cans, which represent 80% of installed capacity. I told you anytime you see another level of your other level or other capacity level, what do you do?
We calculate for the 100%.
Yes, so in that case, what's the current level? Current level was what? 80%, right? And this 80% equivalent to what? 400,000 cans. Okay, so 400,000 cans. So that means if I want 100% capacity, what does it become?
Divided 400 by 0.8.
Divided by 0.8, right? That means how many cans becomes 100% capacity? 500,000 what? Cans.
500 cans.
Okay, so 500,000 cans. And what is it telling us? It is telling us that we have the opportunity currently. What is our spare capacity? We are currently producing 400, meaning we have a spare capacity. How much?
20. Our spare capacity of 1,000.
Look at it very carefully. We can produce 500, but currently we are only producing 400. Meaning how many extra units can we produce if somebody asks for an order?
100,000.
100,000, right?
100.
Yes, we have 100,000 spare cans we can produce, right? And they are telling us that we have an opportunity to utilize our spare capacity by selling our product at 13 pesos per can to a supermarket chain who will sell it as their own branded labeled product. So we are going to check whether we should accept or reject this order. Do you get it? And you see, everything is cost behavior. You have to check. So let's go and check whether it is good to accept this or it is good to reject it. Do you get it? That's what you have to do. So they are telling us that, okay, they will buy, instead of the 20 pesos per can, they will buy at 13 pesos per can, right? And the total cost for the last period was 56 total, of which 16,000 were what? Fixed cost. That means how much was variable cost?
40,000.
Total cost was what? 56, right? Not so?
Yes.
And then they said what? Fixed cost was how much?
16.
16, right? That means variable cost was how much?
40,000.
They're applying it here. That means this was 40,000 at the current level of activity. And the current level of activity was how many cans? The meaning this variable cost related to how many cans?
400,000.
400,000 cans, right? And we already know that variable cost per unit remains what?
Constant.
Remains constant, irrespective of level of activity. So it means that if we can get a variable cost per unit, it will be the same for any number of units we want to produce. Makes sense? So in that case, what's our variable cost per unit? That's what we need to find. That will be our 40,000, not so? Is that not so?
Yeah.
I hope by now you are getting the notion, you are getting the idea behind what I'm doing. Don't just look at the question, but the idea behind it. That's what will make you pass. It's like people rely too much on questions than the concept behind the question. If you want to pass management accountant, you must be very good with cost behavior and overhead absorption. Those are the things that will help you pass, right? So what's our variable cost per unit? So this becomes what? 40,000 divided by what? 400,000 pounds, right?
Yes.
And that gives us what?
0.1.
So 10 pesos per can, right? That means right now, if we decide to manufacture this can, we are going to incur cost of what? 10 pesos per can. Okay, so now what we are going to do is we need to take a decision. And for a special order decision, this is what you do. You compare what? The avoidable cost. Okay, just compare the avoidable cost. Just compare the avoidable cost of accepting the decision, okay? Compare it to what? Your foregone revenue of rejecting the decision. If you decide to what? Reject this decision, what becomes your foregone revenue? Okay, how much are you going to forego? You get the idea? So we are saying that, okay, if I decide to reject, okay, what is the revenue I would, how much revenue would I lose? So revenue from accepting, right? How much revenue would I get if I accept this order? Each of them were sold for what? 13 pesos. Wow. How many units am I selling to them? 100,000 cans. True or false?
Yes, sir.
Meaning that I end up with 13,000 cedis. Okay. So let's see if it generates an extra contribution. Then what are the costs of manufacturing? The variable costs. We said variable cost. 10 pesos, right? So 10 pesos. That means you have 10,000. Okay. So should we accept or reject this? Does it give us? We should accept, right? Because it generates an extra contribution of how much?
3,000.
3,000, right? So we should accept the decision, right? So we say what? The company should accept the what?
The offer.
Contract, right? Because it generates
contour of 3K.
An extra contribution of 3,000 cedis, right? Okay. But then there are some other non-financial factors we need to consider. What are they? Okay. So they said the person is going to use it or sell it as his own branded product, or they are going to sell it as their own. They are going to sell it as their own what? Labeled product. Are they not going to compete with us? Have you thought about that?
They will compete with us.
Competition should be considered, right? You get the idea. What about our what? Customers, customer concerns. We went to see some of your products somewhere, but with a different container, right? Are you getting it? We should consider this. What about staff morale? How are staff going to take this? Because they are producing for a new brand. Not so.
Yes.
What else can we talk about? Reliability, right? Reliability of the supermarket to not disclose this, or people may do clone models of our products. Not so. So anything at all that you think is necessary, even if they've not asked, always produce non-financial factors for decisions you take, right? And it tells the examiner that what you are about, right? So that is it. So around cost behavior, there are lots of things, but what I am concerned about is cost volume profit analysis. Okay, and that is basically the last thing we will do. We'll solve CVP for single products, which will be a target profit. Then we'll do CVP for multiple products. Then before morning, at least I will send you, there are variance YouTube videos on all the areas of variance. Very simple. It's not more than, they are not more than 26, 27 minutes. Watch them, okay? Cover the variances, and then for performance too, okay? Then you should be fine. At least I know these are the major areas that students have problems with. I hope that's okay. So that it's a win-win for everybody, so that you can also have time to sleep. Don't be so. So let's look at how CVP came in the exam. Recently, they are going to give you the way it comes. So I'm going to first look for the past questions on CVP and how they came, right? The target profit decision type. There are two types that have come, but I'm going to look at which one. Let me get the past question. Target profit this April. It came in April 2022, question 5A, and November 2020, question 1. Okay, April 2022, question 5A. Write it down. April 2022, question 5A, and November 2020, question 1, right? Okay. Have you written it down? Do you have it down? So give me the dates I gave you.
April 2022. Question 5A.
April 2022, question 5A. Where are my questions? ICA past questions. Management accounting. Let's see. April 2022, right? Question 5, what?
A.
Okay, so let's go there. April 2022, question 5. Okay. Yeah, that's question 5. We are there. Then the other one was what?
Oh, the other one I didn't hear.
The other one, who wrote it? The other one was what? November. Oh,
2020, question 1.
November 2020.
Yeah.
November 2021, question 1. On November 2020, question 1.
November 2020, question 1.
Okay. November 2020, question 1. Where is November 2020? November 2020. Okay. So we have them here. Okay. So now November 2020, question 1. Yeah. Yeah, I have it here. Nicely done. Thank you. This is the type of question that we are really expecting for you guys. This type of questions are very good. So let's see. We start with this first one, then the second one too can be done. Okay. So let's continue. A motor car manufacturer has been specializing in the production and sale of Bedford model of cars. The model is somewhat outmoded, and the current sales forecast indicates that the current 2018 sales level of 150,000 will be the same as the 2019, but will decline to 130,000 cars in 2020 and 110,000 cars in 2021. The company supplies according to orders received and no stocks are held. Carbon monoxide emissions regulations will prevent the model from being manufactured and sold after December 2021. The company's current estimates of the selling price and cost in 2019 are as follows, right? So this is the current estimate of the selling price and the cost and other things, right? Okay. Now we are in 2019 and sales level was what? 150,000, right? In 2019. Okay. So we have what? Selling price 11,200 per car, material and labor 36, assembly and delivery, right? Which are given. So they are saying that 75% and 40% of the assembly and delivery costs respectively are fixed and the remainder vary with production costs. What does it tell us? Yes. What does this tell us? Oh, my people, they are telling you that 75% of this 4,000 are fixed. So what does it tell us? That means how much is variable?
25% is variable.
And this one to 40% of delivery is fixed. That means how much is variable?
60%.
That means everything in this question is cost behavior. That is what I've been trying to tell you. Get cost behavior, get management accounting. Makes sense. So let's continue. So as you go, the best way to do management accounting is to what? Be flexible, right? Know what is happening, deal with them. So straightforward, I'll lay out my variables. So I'll just start and say, I can write it on my exam sheet. So I say variable cost of what? Assembly. How much would that be? Variable cost of assembly. That'll be what percentage?
25.
25% of 4,000, right? And that gives us what? So variable cost of delivery. So just get all your data down. That's how you become a good student. That becomes 60% of what? A 25, right? I hope you are flowing with me. So what do we get?
Yes, sir.
So this
1,000 for assembly.
1,000 for assembly. And then what do we get for this one? So 0.6 by 25.
1,005.
1,005. Okay, so we've got this down, right? So we know our total variable cost now. So based on what we have here, we can definitely get contribution, right? So let's get our contribution per unit. And every decision in CVP is all about contribution per unit. Management accounting is contribution per unit. We know contribution is selling price minus what? Variable cost per unit, right? So let's get our contribution now. We know selling price is 11,200. Let's variable cost. We have 36, material and labor, assembly 1,000, delivery 1,500, right? Makes sense. Makes
Yes,
sense.
sir.
So 11,200 minus 36 minus 1,000 minus 1,500, right? So we have 5,100 per unit, right? 5,100 per car. Oh, that's the contribution per unit. Okay. So we've got a contribution per car. We lay it down. Then now we dive into the question. They say in addition, the company estimated that it will incur the following non-production cost. Okay. Marketing cost of 60 million, right, will be amortized on straight line basis over 3 years. Okay. So what's the marketing cost per annum, per year?
20 million.
2019, you know, it's 3 years. 2019, 2020, and 2021, right? So marketing cost per annum is what?
20 million.
Divided by what? 60 million.
Yeah, very-
That means it's 20 million. Okay. 20 million per annum. Okay, that is done. Okay. So now we have this. Now let's continue. So you see how I'm answering the question. I haven't started, but I'm just laying out my foundation. Can you see? This is what I want you to do in management accounting. Lay out everything you see and be opening it. Don't start solving it. Just get, because sometimes the problem with management accounting is that students find it difficult to know when you're answering. Who has encountered this before? You don't know where to start answering. True or false? You don't know where to start.
True.
Very true.
The best way to go around it is to lay out. Remember, I've also been a student before. The
Sir,
best way
please, this particular question is under what topic?
is under cost behavior, CVP.
Really?
It's-
I was just asking a colleague what this question is about.
But you see, if you start looking at questions in topics, you get confused. You see the way I taught you high, low, and then we took it into many dimensions. Just know it like that. So it doesn't matter what they bring, you can do it. Do you see how I do management accounting? If you know cost behavior, it doesn't matter what they bring. You can just, so far as you see a cost having 2 levels, you can know that, okay, definitely it's total cost. I have to split into what? Variable and fixed components. You get it? Then what do I do next? So you see, we even went into decision making, sales orders, and all that, right? And it was all under high low and cost behavior. So they go together, right? So now we know that our fixed cost, marketing cost is what? 20 million, and will be amortized over the 3 years. Administrating costs are 10 million fixed per annum, right? We've got admin costs. How much?
10 million.
10 million, right? For a year. So 10 million per annum. Okay, we've got this. We put it down. Then it says selling price, variable cost per car, and total fixed costs are expected to remain constant from what? 2019 to 2021, right? So
Yes, sir.
So what's our total fixed cost? Let's see. So that means our total fixed cost will be what?
75% of.
No, total fixed cost. That's our 20 million marketing cost, right? Plus the 10 million admin cost, right?
Yeah.
Do you get what I'm trying to say? So total fixed cost now is 30 million. No, so I'm just putting it down, just for putting it down. And they said the managing director is unhappy with the current annual profit forecast for 2019 to 2021, based on the information above, and believes that the company has the potential to increase profit to a desired level of 245 million in each of the years 2019 to 2021, right? So they are saying that there's what? A target profit that they want to make, right? And how do you determine target profit? We said anytime you want to do target profit, you must establish what? The number of units to get a target profit, right? And how do you get number of units to get a target profit? The background. We are streaming on YouTube. Oh. The background noise. If you know your background is noisy, just be on mute. So the number of units to achieve a target profit is mostly what? Taking what?
Hello, sir.
Yes, please.
Please, the first cost for assembly and delivery, aren't we going to factor it?
We'll factor it. I'm just looking at the total non-production fixed cost. The production fixed
Okay,
cost.
sir.
Now I'm just going gradually. So the target profit, we know it's our fixed cost plus our target profit all over our contribution per what? Per unit, right? This is the number of units that you want to get. Now, if you want the sales to give you the target profit, right? To give the target profit, you are just going to do the same thing, which is your fixed cost plus the target what? All over your CS ratio, okay? So this is how you go about it. So with this being said, it's like you are laying out your foundation. You haven't started solving yet. Are we okay? So now that you know that, let's get our total fixed cost. So our total fixed cost now for both production and admin. So for production, what becomes our fixed cost? You just lay out everything down so that when you start, it's a smooth flow for you. So assembly fixed cost is what? Assembly fixed cost was what?
3,000.
Okay, 3,000. Okay. Well, let's do the calculation. It was 4,000 by 75%, right? 0.75.
Yes.
This one per car. Remember, this fixed cost, that's why I didn't break them earlier. They are per car. And the one for delivery was what?
All for due is 1,000. 40% times 2,500.
5 times what? 0.4.
40%.
So this one, you said this one was what?
3,000.
3,000. And this one was what?
1,000.
1,000. Okay, so 4,000. Okay. 4,000 per car, right? So this one you have to multiply by the budget because fixed cost is based on the budget, right? Then other fixed costs, right? Other fixed costs, we had what?
30,000.
30,000, right? That's 30 million. 30 million.
Million.
We have this down. Now, they said what? We decided to make a profit of 245 in each year, 2019 to 2021, right? The MD has undertaken a strategic review and developed the following strategies to eliminate the gap. So this kind of questions, you put down each strategy and you implement. And what's the requirement? The requirement is to prepare a financial analysis statement showing the current annual forecast of course, revenue and profits for each year, 2019 to 2021, and briefly comment on the figures, right? Ignore the time value of money. They do not want you to discount, right? So this is what we have to do. So based on these factors, we can establish what? The profits for each year. And we know each year what they have, right? So straightforward, we can put in what? 2019, 2020, and 2021, right? Okay, so the profit forecast. We want a profit forecast, so straightforward. 2019, what was the unit produced or the unit expected to be produced based on the budget?
150.
150,000. 2021, it will turn to 130,000 cars, right? And then 110,000 cars also. Okay. So we have these units down, which we close it off. So now I am going to start by what? I will not start from sales. Starting from sales is a waste of time because we already have contribution per unit. Do you get it? Do you get it? So I will start from contribution. You get the idea. So let's start from contribution. So from contribution, 2019, contribution was what? Contribution wouldn't change. They say it will remain the same. How much did we get for the contribution? So let's work in thousands. Whatever figure we get, we cut 3 zeros off so that it becomes simple. So 2019 contribution will be how much? How much did you get for the contribution? You go up to your calculations. 5,100 per car, right? 5,100 per car. But how many cars were produced in 2019? 5,100 per car. So 5,100. By how many units were produced in 2019? 150,000, right? From the top. So 5,100 by 150,000. That gives us what? 750. Okay. So 100 by 150,000.
That's 765 million.
That's 765,000, right? Add 3 zeros off. So 2020, 2020, the car is still 51, right? Multiply by what? 130,000 cars. Okay. Meaning 5.1 by 130,000. That's 663,000 contribution. Okay. Then we have 2021, right? 2021, the same 51 by 110,000 cars in that year, right? So that's 5.1 by 110,000 cars. That's 561,000 also. Okay. So now that we have this, we are now going to less fixed costs already. You see, there's a shortcut. So less fixed costs. So we have production fixed costs, right? So fixed production fixed costs. We already had it, right? So straightforward. How much did you get for production fixed costs? I think you guys had what, 4,000, right? Was it 4,000?
Yes, 4,000.
Delivery. Yes, we have already done it. So you see, it's now making the question smooth. So 4,000. So 2019, this would have been giving us what? 4,000 by what? 150,000. 2020, 4,000 per unit by what?
130.
Then 2021, we have what? 4,000 by what? 110, right? So multiply and give me for the fixed cost. So that becomes 4 by 150,000 because we are cutting 3 zeros off.
So that's 600.
600,000. And then this one?
The last one is 440.
440. And the middle one?
520.
520,000. Okay. So nicely said. Okay. So now we have what? Other fixed costs, right? Fixed admin and distribution, right? Fixed admin and distribution, we know is going to be what? 30,000 per annum. You remember?
Yeah.
It was 30,000 per annum. Okay. So we have this. So with this being said, we are going to less our total fixed cost now. So what's our total fixed cost for each year? Okay, then we take it out, right? From our contribution that we have up here. So what do we have? This gives us what? 630,000 also. And this one, 550,000, 470,000 also. Okay. So with that being said, what's our net profit under each of them? So let's call it A and B. So A for this and B for this. That means our net profit is A minus B. So what do we get?
135,000.
130.
5,000. A.
Okay. Then B, what's the net profit? 63 minus 550.
33.
I'm coming. 135,000. And you said this is what? 33,000.
Yes, sir.
Okay. And the next
91,000.
91,000. Okay. So now we've got a net profit. Okay. They said the manager is not happy with this. So he came up with some strategies, right? So the first question says what? We should determine what? The cost, revenue, and profit forecast, which we've done. So this calculation alone is 9 marks. Free Bonto, right? It wasn't difficult. But some students still didn't make it. Oh, why are you saying it's difficult?
How to even identify that this is what they want you to do is a problem.
That is why I said, you see, how did I identify? I didn't even know this was what they were looking for, right? But you see, as I laid down my data and was going through, then it started unraveling. That's how you go in management accounting. Don't rush as others are rushing. You, behind your answer booklet, let's just write, let this be this, let that be that. Just be coming up with it. By that time, it will start making sense. If you rush into solving, you'll be midway somewhere in the question and you get stuck. You don't know where to go and you have to cancel. Then you go and write, dear examiner, all my cancellations are canceled. Please don't do that. You have you have to take your time and put down your variables, even variance. Let SR be equal to this standard rate. Let the examiner know you know. Go systematic and trust me, there's no way you are failing. I told you formulas are very important in management accounting. Don't go and solve something without writing down the formula. It is never understood, right? So they are saying that we should estimate the profit only in 2019. You see, first of all, they made us do all the 3 years, but now they said what? We should calculate the profit gap in 2019, 2020, and 2021. Already you know the profit gap, right? So profit gap is between this and this, right? That's the difference, and here. That's all. I hope it's easy. So the gap between our profit between this and this is what? Profit gap. Between this year and this year, what's the profit gap?
102,000 for the
102,000. Okay.
Yeah.
Between this and this, what's the profit gap? That means it was a reduction, right? It reduced. Here and here, what's the profit gap?
58,000.
58,000. Okay. But overall, what is overall profit gap? That's from 135 to 91. So with our profit gap,
that's 44.
So 2019 to 2020, our profit gap was what? Minus 102,000, right? In 2020 to 2021, the profit gap was a positive what? 58,000, right? And between 2019 down to what?
2021.
2021, what's the profit gap? That's 135 to 91. It's a huge drop, right? That's why the MD was not happy. How much?
44,000.
44,000. Okay. So you get the idea. So you've laid down your gaps. Now they want you to implement the strategy. So they are saying that estimate the profit in 2019 if strategy 1 was implemented, if strategy 2 was implemented, and if strategy 3 was implemented. Then you select the strategy to implement. So all you have to do is that now, when we take the strategies, lay down your data as usual. That's how we go about it. Don't start solving until you have the data, right? That is it. They said strategy 1, a marketing proposal will enable the company to enter new overseas market with the result that total, including the overseas market, sales level will be established as 160,000 cars per annum from 2019 to 2021. So what's our estimated number of cars if we go with this strategy? Estimated units to produce how many cars?
160.
We produce 160,000 new cars, right? Okay. Now, if we produce 160,000 new cars, it says what? The market entry cost will be 30 million for each of the 3 years, right? So additional marketing costs or incremental marketing costs, right? So additional marketing costs will be how much?
30 million
for 3 years.
30 million for 3 years, right? Okay. So 30 million each of the 3 years, right? But now we only need 2019. So in 2019, what becomes the profit from this strategy, right? Let's see, from this strategy. Meaning that you can still make reference to your existing cost that you had already, right? So in that case, what's the contribution per unit? What's the existing contribution? So contribution becomes what? We know contribution was 5.1, right? We are working in thousands. It's 5.1. Since we are working in thousands, 5.1. That was our contribution. But now we are producing 160,000 cars. True or false?
True.
So 5.1 times, because contribution didn't change, 5.1 by our 160,000 cars will give us what? That's 816 million. Okay. Then we less what? Fixed cost. So what's our fixed cost? For our original fixed cost under 2019, we have production fixed cost being how much? Production fixed cost. Already we have the total. No, we have to go and check. It was 600,000, right? Production fixed cost. We have it at 2019. Go and pick 600,000. We've already done the calculation, right? Then fixed admin and distribution 30. So we had production, right? 600,000 also. Then we had fixed what? Admin and distribution being what? 30,000 as well, right? Then we have what? Additional marketing costs, right? Which we just incurred to go to the overseas market, also 30,000. So how much do we get? Just 660,000 being a total fixed cost. True or false?
True.
True. So in that case, what is the net profit we are expected to meet under this strategy?
156,000.
Want to make 156,000, okay? Does it achieve our target profit we want to make? Okay, when we finish, we have to check. They are saying that we want to make a target profit of 245. So if we are going to make this, on the average, we can exceed the 245 actually. Do you know that? Because 156 on the average, compared to what we have there, it would exceed 245. You get it? Okay. Now 20, that was strategy 1. Strategy 2, what does it say? The second strategy. Strategy 2, it says what? Redesign of the car will enhance its sales appeal and will permit the company to increase its selling price to 12,000. So anytime there's a change in anything, ask for the impact on contribution. Does it change my contribution? So my question is, if selling price has changed, does it end up changing contribution?
Yes, sir.
Yes. So all you have to do is just be concerned about contribution. Anything that changes, does it change contribution? If it does, recalculate the new contribution, right? So let's see. So what's our new selling price now under strategy 2? We'll sell the car now for how much?
12,000.
12,000, right? 12,000, which becomes 1.2, right? Because we are working in thousands. Do you get it? Okay.
Yes, sir.
Now it will be 1.2 per car. Okay. Because we are working in thousands. So now what's the new contribution? We have to calculate the new contribution. Or we can just put down the normal 12,000 there so that we do not. It's supposed to be 12, right? So 12,000. Okay, when we finish, we'll take the 3 zeros off. So do we still have the costs? Let's get our new contribution. So new selling price also
12,000 and the variable.
we less the cost, 10,005, right?
Yeah.
Okay, so it becomes what? New contribution, selling price 12,000. Less variable cost 3,600, right? Assembly cost 1,000, right? Then we have the other one was what?
Delivery.
Delivery.
Of
Was what?
1,005.
So what's the contribution per unit? Or contribution per car now? 5.9. Okay. So if you are working in thousands, that means our contribution per car is how much?
59,000.
That's 5.9 per car, right? So we've got this. Okay. Now that we know our contribution per car, was there any other thing that happened in the strategy? Yes, they said that what? We are going to incur redesign fixed cost, right? Redesign cost. So what was our redesign cost for just 2019? Redesign cost, how much?
30 million.
So it's 30 million for 3 years, right? Okay, so divide by 3 years. That means each year it becomes what? An additional cost of what? Incremental redesign cost or incremental fixed cost is what? 10,000 per annum, right? So this 10,000 per annum is an additional fixed cost under this strategy. So under this strategy, let's see what the profit will be. Then we select which one. So profit under strategy 2, right? Under the second strategy, let's see. So what's the contribution? You see, always starting with contribution is faster. If you start with sales, you waste a lot of time because you have to get delivery cost times this. You have to get all that, right? But just start with contribution. So the contribution now we know is 5.9, right? But we are how many units? That means that they will permit the company only to increase selling price, meaning that we are still going to produce the same 150,000. Do you get it? Because this one is a different strategy. The 160 is only if you are using strategy 1. But for 2019, the actual unit are 150. Do you know that?
Yes.
Yes.
We want to put the selling prices. Yeah.
Yeah. So in that case, we have what? 5.9 by what? The 150,000. Which now becomes what? 885,000. Also. Then we now less what? Fixed cost, right? So fixed cost, production fixed cost will be what? Production. We already have it. So we just go and pick production fixed cost. 600,000. 600,000 for production fixed cost. Then the Selling and distribution.
Distribution, that is
Admin and distribution.
400.
That was 30,000 also. Then we have the additional redesign cost. Redesign.
10,000.
Oh. I don't like this update. So this one was what? 30,000. And then the redesign cost, which is the new fixed cost, right? 10,000.
10,000.
That means we end up with 640,000 also. Fixed cost. Take it out. What's the net profit that comes from this strategy?
245.
245,000. Wow. Yes. I think this strategy has achieved the minimum we wanted to achieve, right? The desired profit level in each of the 3 years. You get it?
Yeah. Oh.
The question is interesting, eh? I never knew. So we have achieved this, but don't stop here. Try strategy 3 and see if it will be more than that. Always when they get money, they are greedy for more. So strategy 3, what did they say? You see, when you lay out your data, the thing becomes simple. Otherwise, you beat around the bush. You can never finish solving this question to waste your time. So strategy 3, a radical cost reduction program, which will improve what? Efficiency and lower all variable costs by 20%. Oh, nice. So first of all, my variable cost itself was what? We had what? 3,600 plus what? 1,000 plus 1,005. Do you remember?
Yes.
Variable cost. Let's add all and let's see what we get. So 36 plus what? 1,000 plus 1,005 gives us 6,100, right?
Yeah.
Which is the existing variable cost. But now they said it's going to what? Reduce by 20%. Meaning that our new variable costs are just going to be what? 80% of the original. True or false? Because it's reducing by 20%. So in that case, 80%.
True.
So in that case, 80% of the 6,100, that will give us how much?
4,880.
4,880, right?
Yeah.
That's the new variable cost. Okay, so now that we have the new variable cost, what are we going to do now? We are going to use it to work the new. Does this affect contribution? Does this affect contribution?
Yes, please.
Does this affect contribution? Yes.
Yes, sir.
The end result is that you are just looking for a change in contribution. So what's the new contribution? Straightforward, right? So that means our new contribution will be what?
Selling price minus
the variable cost.
Okay, and that gives us what? Our selling price, original selling price was what? We can check from the top here. 11,200. It didn't change, right? Don't use the 12, for the 12 was a different strategy. So we will maintain the existing selling price. So 11,200 minus what? Our 4,880, right? What's the new contribution?
6,320.
6,320. Okay, so 6,320 is our new contribution. So now that we have our new contribution, we have to implement. Was there any other cost that came because of the strategy? Yes. Additional fixed cost, right? There was additional fixed cost, right? Additional fixed cost of how much? 70,000, right? Which is 70 million. So we have
from.
So let's get our profits and then we can say good night. So what's our profit?
Do for it.
Okay, so first get your contribution. So what's our contribution? Our new contribution is 6.32. 6.32. So we multiply by the number of units, meaning we are still going to produce our existing 150,000 units. And that gives us what? Then we less our fixed cost. So 6.32 by 150,000 units. That's 948,000 also. I think this is the highest profit so far. But let's get our fixed cost. The production fixed cost existing, we had what? It was 600,000 also.
Yeah.
And the admin and selling,
30.
it was 30,000. Then now we are adding additional what?
70,000.
Right? Of what? 70,000 because of this process. If we add it up, what do we get? 700,000 also. Not so.
Yes, sir.
So what's the net profit?
248.
248. So I think this is more greedier, right?
Yeah.
So the strategy to select decision. Select strategy what?
3.
3, because it achieves the target of 245 and even beyond, right? Plus additional what? 3,000. Not so. Question if you were more, but it's worth it, eh?
So please, I want you to go to the where you started from, so I'll take a screenshot and then try to solve it and see.
Okay.
This question failed me the first time I tried MA.
It's because you went to the long, approach.
I don't forget this
most
question.
people, if most people are calculating net profit, they always start at sales. Do you know that? And you know that can be a time waster because you have to get all the costs. But trust me, if you are doing CVP, just start from contribution to make the thing simple. I hope you've learned something today.
Yes, sir.
Happy to do multiple product CVP. It's already late. That one I'll just take you through the process and then we are good to go. We'll just solve one simple question on multi-product CVP. Then
Sir, I mean the top.
The top. I'm coming, please. Let me see if I can get multi-product CVP. Oh, there's a nice question that came in let me see. There's one here that is nice. Jinx is not bad. We can solve Jinx. Okay, that's fine. So the top. Yeah, I'm at the top. This is where we started from, the profit fork. Okay. You mean why I laid out my data?
Yes, sir.
Okay. So you always say let, then you lay out your variable. So this is it. Then we are coming to solve Jinx, and then we are saying good night.
Okay, so let's go to the next page after this. I mean.
Yeah.
Yes. Thank you, sir.
Okay. Can we go again?
Yes, sir.
Okay.
We go, sir. Okay.
But sir, why don't you share it in the group? Maybe that will be easier.
Okay, it's because some people are streaming on YouTube. But anyway, I would still post.
Okay.
Okay.
Please, you can go.
Can we move?
Yes, sir.
So I told you what is the trick. Always identify something that will change your contribution, right? That's a rule.
Yes.
So anytime you get this sort of decision, does it affect my contribution? Does it affect my fixed cost? You see, it's always about contribution and fixed cost. Contribution and fixed cost. If there's a change in sales, it affects contribution. A change in cost affects contribution. Does it affect fixed cost? Yes or no? That's all you have to think about. Can we go?
Yes, sir. So please, you can move. Yes, sir. Yes, sir.
So that is it. So we are done, eh?
Thank you very much, sir.
You're welcome. Okay, so with multi-product CVP, let's do by illustration. It says what? Jinx Limited produces and sells 2 products, M and N, right? Product M sells for what? 7 per unit and has total variable cost of 2.94 per unit. While product N sells for 15 per unit, has a total variable cost of 4.4. The marketing department has estimated that for every 5 units of M sold, 1 unit of N will be sold. The organization fixed cost per period totaled 123,600, right? So let's get our information. Selling price of M be what? Selling price of M was what? Get the figures for me. I want to see whether you're following.
7 cities per 7 cities per.
And variable cost of M was what?
2.9.
2.94.
Okay. So that means this one will generate a contribution of how much?
4.06.
So that's 7 point. But we can do the contribution later. Don't worry. Let's just get our data.
For N,
yeah,
selling price. Variable cost 4.4.
So this one was 15. Variable
Yes.
cost was what? 4.4, right?
4.4.
Okay, that is what we have. And then we have what? Fixed cost. They said the fixed cost was what? 1, 2, 3, what? 600, not so. So we have this one down. Okay, so what are the steps that we mostly take here? The first thing you have to do is determine your sales mix, right? Because you are selling different kinds of products, you have to know how to mix them up, right? So determine the sales mix. That's the first thing you always have to do, to know how you sell these goods, right? So the first step, I sell my sales mix. And it says for every 5 that I sell of M, I sell 1 of N. True or false? True or false? So we are saying that, okay, M and N. If I sell 5 M, I sell 1 N, meaning it's over 6, right? So this is 5 out of 6, and this is 1 out of 6. So I've got my sales mix down. This is the first thing you do. Now the next thing is to get your contribution per what? Contribution per unit, right? So if it's multi-product, meaning that you cannot split, right? You cannot determine how much goes into the fixed cost. You have to use the weighted average to split, right? So what do we get? Give me the contribution for M and N. And what's the selling price?
4.06. No, sorry.
10 cedis. And this was 15, right?
Okay, yeah.
Okay. 7 cedis. And then we have what? 15. So we less variable cost. Variable cost was what?
2.94 for M.
And then this one?
4.4.
4.4, right? So we take it out. What do we get as our contribution?
For M.
4.06.
4.06. And the other one?
10.6.
10.6. Okay. So this is what we have, right? So now that we've got this, the next thing to do is to get our weighted average contribution. Okay. Okay. Because there are 2 or more goods, we need to do weighted average. And weighted average contribution, what we can do is that we can take the product, take our contribution. Okay. Is the contribution multiplied by the sales mix, right? To get a weighted average. I hope that's okay. So now when I take M, the contribution I made was 4.06, right? What was the sales mix? It was 1 out of what? No, it was 5 out of 6, right?
Out of 6.
When I take N, this was 10.6 by what? 1 out of 6 also. So what do we get? So 4.06 by 5 out of 6. We have weighted average of what? 3.83, right? And we have 10.6 by 1 out of 6.
1.77.
1.77. Okay, so if we add, what is the weighted average contribution? 3.83 plus 1.77. That's 5.6, right?
5.6, yeah.
So now that we have this, what we can do is that we are going to now work the question, right? It said calculate break-even point for jigs. How do we get break-even? Break-even point in units is giving us what? Our fixed cost.
Fixed cost over contribution.
Per unit.
Plus 0. Why do I put 0 here? Because we assume 0 profit, right? At the break-even. So if they say target profit, then it becomes fixed cost plus that target profit, right? Over the contribution per unit. But here, the contribution, because we have multiple products, we use the weighted what? Average contribution. So that all the formulas you know are the same. Just like here, everything we use weighted average. That's the rule. Makes sense? Very easy, right? But there's a long approach which they teach people. I don't want you to use that long approach. Use the simple one. You still get the full mark. Makes sense? I like to make things easy for my students. So now, what do we get for our break-even point? We know our fixed cost to be how much?
123,600.
1, 2, 3, 600. So we divide this by what?
5.6.
5.6, right? CDs per unit. Okay. So what do we get? 1, 2, 3, 600 divided by 5.6.
22 and 71.
So we must produce 22,071 units, right? So 20, 22 and 71 units must be produced to make no profit, no loss, right? Break even. Okay. So now that we've got that, how did we get 5.6?
The weighted contribution.
Okay.
3.13 plus 1.77.
Okay. Okay. So what do we get? 22,071 units must be produced, right, to break even.
I'm sorry, it should be 7.9.
What should be 7.9?
The weighted contribution.
Weighted
It
contribution.
should be 4.9.
Really?
That's 3.1. Unless I didn't write well, 3. Let's go up and let's see.
3.83.
83. Oh, okay.
That's 1.77.
Okay, that's okay. Thank you.
Yes, it's 5.6. Okay, so in that case, let's see. So 22,071 units must be what?
Produced
to break
even.
So how many of products M and N should actually be produced, right? So that is, we are trying to get break even per what? Per product. So what's the break even per product? We can try and get it. Okay, let's get the break even per product. So how do we get it? We can take the product and multiply by the sales mix, right? To get a break-even point. Do you get it? So in that case, this is how you do it. So for product M, we know that what? The sales mix is 5 out of 6, but we are what? We are producing 22,071. Out of this, what do we get for the break-even units? So 22,071 by 5 on what? 6. That means we must produce what? 18,392 units, right? To break even. For product N2, we do 1 out of what? 6 by the same 22,071, also. And that gives us what? 1 out of 6 by 22,071. That means we must produce what?
3,678. So 79.
You can round off or maintain because units, if you like.
Yeah.
I get it. So these are the units to break even. But what is the selling price? What is the selling price of these units? Sales to break even. How do we get the sales to break even? It's simply what? The break-even units times the selling price per unit. True or false?
That's true.
So if I take M, I know that the selling price for M was what? 7 cedis. So I multiply by the 18,392 units, and then you get it. And for N, I know that it's 15 cedis. I multiply by what? The 3,678 units. So once I'm done, I get my total sales at break-even. Make sense?
Yep.
So 128,744 against 15 by 3,678. That's 55,170. So you add your 55,170 plus 128,744. That gives you 183,914. And this is the sales at break even. Assuming the company wanted to make a profit of what? 50,000. What do? You are going to take what? The fixed cost plus what? The 50,000, right? And divide by the weighted average CS ratio. The weighted average what? Contribution. And then you are going to split it again using the sales mix, get the sales to make that profit. That's all. It was one hell of a ride, eh? So, but how was it? Has management accounting been opened up for you?
So please, what is the difference between the required 1 and the required 2? Requirements 1 and 2.
No, 1 is break-even point in units, which we got, right? That is the break-even point per product in the unit, this one and this one. And the one says what? Break-even in sales revenue, it should be in sales price. So we multiply by the selling price. That's it. That's
the very first one. Oh, that one is not part of the
that is the break-even point. That means not per unit. For
okay.
Like all the units, which we had 22071. So this is break-even point. This is break-even point per unit of each product. This is break-even point in sales. Right?
Okay.
Prof.
Yes, please.
What if they don't give you the sales mix?
Then you split it according to the contribution or the way the selling price is organized. It's still I use it. Like this question, like this, the diet it came, they didn't specify, right? But see, how do we get contribution here? Let's see. Contribution becomes what?
Selling price minus variable cost.
But you see, students forget that commission is also variable. So a lot of students a lot of students failed.
Oh.
Commission is variable now. Have you forgotten?
Okay, it's based on the number of quantities. So, yeah, okay. Okay.
Forget, you should come again.
Okay.
Yes. So what's the steps? We determine our sales mix, right? And in this question, they gave the sales mix to be 2:1:1, right? Assuming they didn't give, I will use the selling price and put it in this fashion to determine my sales mix, right? Because selling price is still in line with sales quantity. You get it? So I'll use the selling price as my sales mix, which will be 3:4:2:3:1:7. Then I add or then I use it to split still, right? At least it's closer. Makes sense. So now that is this, we know that our sales mix, if we are determining sales mix will be what? Let's work around this question. So contribution for this will be what? Let's just see. What will contribution be? So that's 3:4 minus this minus this, this minus this minus this, this minus this. What do we get? Subtract quickly. This one you are doing it on the face of the question. 3:4 minus 1:2 minus 80.
2120.
212 per car, right? Per motor.
The last one.
So 23 minus 1080 minus 60. We end up with 1160.
970.
You said the next one is 970.
970.
Okay. So 970. Okay, so we've got all of them. Now we need a sales mix, right? So for high will be what? 2 out of 4, right?
Yes.
Medium will be 1 out of 4. And then the other one will be also what? 1 out of 4. So let's multiply. Let's get our weighted average contribution. So weighted average contribution will be what? 2 out of 4 times our contribution of 2120, right? Plus 1 out of 4 times our 1116 also. Plus 1 out of 4 times what? 970. No be so. So let's put all together. I hope everybody's on point. 2120. It's the same thing we did in the plus 1 out of 4 times 1160 plus 1 out of 4 times what? 970, right? That's how much? 1592.5, right? Per motor car, right? Motorkin, sorry. So this is it. This is a weighted average contribution. But then they told us our fixed cost is 310,000. So what's the break-even point? So compute the sales mix, we have done. Unit contribution, we have done. Weighted average contribution, we have done. Break-even in sales and sales unit volume. What's the break-even unit? Break-even point. That's fixed cost.
For contribution per unit.
Weighted average contribution, right? Our fixed cost was 310,000 divided by what? 1592.5, right? And how many more tokens must we sell to break even?
195.
10,000 divided by 1592.5. That means we must sell 195 more tokens, right? 195 more tokens to break even. But this one must be split in the sales mix, right? To get how much for each product. So for more token high, how many more tokens? 2 out of 4 times what? The 195 must be sold to break even, right? And that's how much? So half.
98.
That means we must sell 98 motorkins, right? To break even for this guy. For medium and low, we must sell what? A quarter, right? 1/4 of what? The 195, right?
49.
That means we must sell 49 motorkins each, right? To break even for these guys. And they said how many motorkins must be sold to earn a profit of 15,000. So that one gives us what? Fixed cost plus what? The profit of 15,000 all over the weighted average contribution of 1592.5, right? And the same way, once we get it, we also split it in the same percentage again to get for each product. That's all. You have done very well. I like the kappa. Anyway, it was a fruitful session, right? So on my YouTube channel, you have all the areas on variance. I've broken it down, very simple questions, very detailed one, mixed yield with losses, investment appraisal, everything is there. Short videos. They are not very long, at least within an hour. Okay, so just take your time, go through those ones, and then you should be fine. I think the session was not bad, right?
Yes, sir.
No, sir.
Thank you.
Okay. So I've taken you through a marathon.
So,
Yes, please.
so this type of question is under exam question number what? 1?
Mostly you are going to get it under question 5. Or sometimes question 1, but it is under decision making, CVP,
Okay.
target profit decisions, cost behavior. So remember, high low, flex budget, these things, they are all around cost behavior, right? So you can get them. So just be prepared. May the Lord be with you and have a good night.
Yeah. Thank you, sir.
You're welcome. You are ever welcome. I wish to see you all in level 3 next night. Come and
In fact, I went to write corporate reporting this afternoon. I am so tired.
I understand.
Man, accounting is killing me level 2, so I have to be combining them like that.
You will combine and finish. Don't worry. You're in good hands. So I'll see you when you see me. Have a good night.
Good night, sir.
Okay. Oh, the YouTube.
Somebody
said the YouTube link. Okay, when I finish, I'll share the YouTube link on the pages. But go to Prof's Training Solutions and go to live, right? So Prof's.
Hello, sir.
Yes, boss. Prof's Training Solutions.
Yeah, please. Can we get the video on YouTube now?
Yes. If I end, you can get it on YouTube. Prof's Training Solutions. Just go to Prof's Training Solutions. On YouTube. And go to live, because this is live. You'll get it there.
Thank you very much.
You're welcome, sir. Also get the other videos you are looking for, like the sales mix and yield, work back variance, and all that. Right? Okay. So all the best. May the Lord be with you.